relaxed at this point?
Yeah, well, we've heard conversations over the last 2 days. We've brought the coverage about how Europe's trying to shake off that anti-innovation image and really try to invest in infrastructure around AI and build these world-leading AI companies. How easy is that? Well, let's find out with my next guest, Robert Lacker, founding partner at Visionary Club. Robert, we've spoken a lot over the last few days about Europe's position in AI specifically. The conversation seems to revolve so heavily around the US, around China. Europe feels sort of just left behind somewhat. Yeah. What's your take at the moment on Europe's position?
Yeah, look, to be honest, I'm a little tired of this talking Europe conversation. We're here today to bring leading entrepreneurs from the old and new economy together to just discuss how we get things better. And I think actually, if you look at the AI side, a lot of the discussion has been around foundational models. But right now in 25 it really starts to hit the application layer. And if you look at the European industrial economy, it's the biggest industrial economy globally. So I think it's the biggest enablement we can globally have for the application layer of AI, because everything that can be digitized across the supply chains will be digitized. And this is starting now. So I think in Europe, we actually have a huge opportunity to focus on the application layer. That's also where we think most of the profit will be made in the future. So if you compare it with iPhone and Google Android, 95% of the revenues are done by apps like Uber and the others. And if you compare that with the application layer and the iPhone as the platform at the foundational models, I think we're just hitting that era that we can shape in Europe.
So that's fascinating, because we've seen a lot of these model companies, like OpenAI, Mistral and others, raising astronomical sums of money at extremely high valuations as well. But you're saying actually the real value lies at the application layer. Is that there is this line of thinking that actually these models become commoditized very, very quickly. Are you of that thought as well?
I am. I mean, we don't know. We will hear today from Demis, who's the founder of Google DeepMind and the founder of Topic, and other people are taking the forefront of the foundational model layer. But I think DeepSeek was a great example why it can commoditize so fast. And we think there will be a few companies shaping the foundational model in the future. The valuations are not because those companies are already so incredibly valuable. It's a combination of projecting the future, but also the costs that go into it. So you're doing a seed round as a foundational model company, you easily need 100 million to put into NVIDIA chips. So that means you just need to be on a higher valuation to just be able to work. And I think this is something very difficult, of course, for European investors to shoulder. And that's why I think it's smart that we focus on the application layer here in Europe.
So there's a couple of space of thought here as well. You look at closed companies like OpenAI who are trying to create the application layer as well as the model layer. And then there's the open source debate. Is there a potential divergence here between those companies like DeepMind, like OpenAI, who are pursuing the application on top of their own models versus these open source?
100%. So we don't believe that foundational model companies will be able to cover all the application cases. If you look at software today, there are a few thousand software as a service companies, even a few million if you go into the long tail. The applications are so specific, go into the logistics supply chain, go into the procurement processes. So you need to build contextualized value around the foundational models. And this will be very difficult for the foundational model companies to cover in each vertical. So there's a lot of potential. Imagine, again, to come back to our Apple iPhone, any application that you have on your smartphone today. That's just not the case. So we think Apple is like the foundational model layer built by the OpenAI's Mistrals of this world. There will be a lot of application cases on top. However, I think open source is a really great discussion, because that's a huge potential, of course, for the foundational model companies to make their code more openly available, to really source application layer potential, basically making it an open platform and not a closed one. That will be very difficult if you're closed source to build all those applications.
And on the application layer as it stands, what is exciting you most? Where are you seeing some opportunities at the moment? Are there specific sectors, specific applications?
Yeah, look, if you look at Europe, the productivity gap to the US has become so large over the last 20 years, and application layer AI is at our industrial companies. It's anything from logistics to sourcing and procurement to marketing and sales. Everything that can be digitized in a company will be digitized by AI. And that's why we see massive profit pools actually to emerge from this opportunity. So we think the opportunity of AI is 10 times larger than the opportunity we've seen in software and cloud, which was just so much more focused on certain applications.
Robert, thanks so much for speaking to me today. That was a wonderful insight into where we stand right now in investment. Some fascinating things coming out of that conversation. Again, you heard it there. Sick of Europe being in that conversation. line out the US and China AI conversation, but also, as we've spoken about many times, the application layer is where many investors are seeing values, and of course that does raise question marks about the valuations of some of those companies. We've got some interesting conversations coming up this morning with Harvard Henriques, one of the co-founders of Wise, as well as an investor at Plural, as well as Tim Mackey, the Chief Legal Officer at SoftBank as well. So you don't want to miss those. Stay tuned here on CNBC. For now, guys, back to you.
Thank you very much for that, Arjun. Baidu is planning to release the next generation of its AI model, Ernie, in the second half of 2025, with big enhancements in multimodal capabilities, a source familiar with the matter told CNBC. The move comes as Chinese companies race to compete with US AI models amid sector disruption from DeepSeek. So let's just see what Ernie and DeepSeek can do.
Ernie's been used as a computer program for years.
Right.
Ernie, older British people will be able to tell you, people of my generation or older, that Ernie is it's an acronym for the electronic random number generator for the premium bonds. So if you hold a premium bond in the UK, which is a form of government bond where you do get into a lottery every month, that is the random number generator from decades back.
I'm sure Chinese audiences appreciated that as
I think they would have done. There you go, China. You've learned something today.
Let's push on and take a look at beer. Heineken reporting numbers today. At the same time a year ago, a little bit disappointing on the outlook, really relying on pricing to do the heavy lifting. What we've seen, a bit of a volume story coming through in the business. Revenue for the full year, 35.9 billion euros. EPS of 4.89 on net income of 978 million. Now the outlook here, and this is important, it's narrowed the range, it seems, in terms of what it's seeing for full year 2025. And this is where it was sitting at last year, is talking about 4 to 8% operating profit organic growth. Launching a 2-year 1.5 billion share buyback program. So again, returns the shareholders here. I want to tackle that volume story. It is small growth, but at least it's improving. The full-year beer volume, 1.6% organic growth. The Heineken volume up 8.8%. So it has seen an improvement there. Also extracting savings out of the business, 600 million euros worth, a 40 basis point operating margin expansion. So profitability key here. But one for the marketers out there, marketing and selling investment increased by 300 million euros, a double-digit organic increase. So they stepped up funding behind the digital and technology initiative here. So that is fascinating that they're spending quite a bit here in terms of that investment. Well positioned to further increase our investment in marketing and selling and behind our evergreen priorities in 2025. So that is one of the real drivers as we talk about increasing profitability. We're going to hear from the Heineken CEO, Dolf van den Brink. That is later this morning. Don't miss that first on CNBC Conversation. It is coming away at 7:15 London time.
How many times have we spoken about Siemens Energy as under a lot of pressure and having huge problems, especially with its wind unit Gamesa? Well, you take a look at the shares, ladies and gentlemen. They have had a skyrocket over the last 12 months or so. I think they were about a year ago. It's about 14 euros. They're currently doing 57. Massive rally. They look like they're putting the Gamesa behind it. Long work through, but they're still targeting break even at Gamesa in the fiscal year 2026. The net profit looks like it's wiped the floor. First net profit 252 million euros versus 130 million in the LSEG estimate. The order book rising to 131 billion. At the end of December was 123 at the end of September, and confirming the outlook for sales, net income, profit margin before special items. Karen.
Chair Jerome Powell eyes on Capitol Hill. Quizzed him on trade, Elon Musk, bank account safety, all that we'll discuss. Plus, looking out for SoftBank's third quarter earnings. We'll into those numbers as they cross the wires in about 15 minutes' time. And Annetta will be speaking to Stefan Leitner, the CEO of Deutsche Börse, on the exchange earnings. That is the first on Conversation, 7:30 GMT.
Want to jumpstart your side hustle? Learn a skill to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success story. Register right now at CNBCMakeIt.com/passive income.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Digital disruption.
I mean, this is life-changing technology.
CNBC The Edge, only on CNBC.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Frank Holland, Worldwide Exchange, CNBC.
A big thing stateside, still talking about tech, and you can see underlying the hood that some of the major movers are still technology names. To the upside, it was IBF for the Dow. To the downside, it was S&P 500. Apple, one of the big movers too for the major boards yesterday. So tech's still a big theme as investors are keen to some deep news and the big AI summit that we're talking about in Paris and the ramifications for key stocks. But there are other features here, and that is tariffs. It's keeping markets a little bit cautious at this stage, and a dose on top of rates yesterday as Jay Powell was out talking about there being no rush to cut interest rates. So with that backdrop, you can see we didn't stray too far on some of these features. The Dow, the most of it, up just over 1% versus about a third coming off the NASDAQ. To the dollar and the Treasury trade, this is how we look on Treasuries at 4.30. Next stop going to be CPI. We're closely tracking those numbers. They may have some impact. As you can see, we're perched a little bit higher coming up to the numbers today. Dollar as a result, this is how the greenback looks. We are tracking weaker versus the euro and sterling, a little bit firmer again versus the Japanese yen, and unchained versus the Swissy. So we are seeing a little bit more strength. Particularly look at that dollar yen trade. 7/10 up in morning trade. To the Asian markets, this is what we're watching across the region. There's been a lot of chatter about how much money is piling into Chinese tech, and that is porting some of the boys from China to Hong Kong, and you can see the Hong Kong market again up nearly 2% at this hour. Stocks elsewhere, again, tariffs impacting some of these big trades around steel and aluminium to cars. The Nikkei is still positive this hour. WTI, Brent and gold, as we take a look at the commodities, the trade is weaker right across the board this morning. So modest declines, 4/10 off WTI, and even spot gold seeing just a fraction of a drop in the morning session, over 1/10%, Steve.
Yeah, always pivotal to know where India is going to place itself geopolitically. And of course, with the war in Ukraine, it's had a more opaque stance, is that fair to say, compared with what the West would like to see. Anyway, India will cooperate with international sanctions, the country's oil minister told CNBC, as markets eye future U.S. policy under President Trump. Speaking at India Energy Week, Hardeep Singh Puri told Sri Jagaraja that India is playing by the rules.
There's no sanctioned country. First of all, it's a lot of misrepresentation that's taken place. Today, Europe still buys 25% of its gas from Russia. They buy other critical energy from there, so there's no sanction. So to say that India is buying tracks and there's no. So now I've had a chat with the American, the previous administration. They said, please buy as much as you like, that you buy it within the price cap. That's what we did.
Well, a fantastic conversation there. But another theme leading discussions at India Energy Week is nuclear. Ongoing resurgence with the IEA expecting global nuclear electricity generation to be the highest in history this year. Sri joins us with another guest. Sri, I'm loving your work out there. Really love that interview, by the way.
Good morning, Steve. Thank you. Thank you. And as he said, let's turn that conversation now at India Energy Week to S&P for energy. And we have heard a lot about the renaissance in nuclear, especially as the fuel of choice to power the AI data center revolution. And let's bring in Samar Bilbai Leon, now Director General of the World Nuclear Association. She joins me here in a new day at the India Energy Week. Samar, thank you very much indeed for joining me. Thank you. First of all, has nuclear overcome the perception problems related to safety?
Well, I think that governments, the public, the media, the finance community, they are all becoming very pragmatic. And we are recognizing that we need 24/7 electricity that is stable, that is clean, and that is going to be something that will allow us to meet the challenges that we have. And nuclear is definitely part of this equation. And we have seen how governments have changed their mind, how the public everywhere in Europe, in North America, in many countries in Asia, they also are looking positively at that.
It's still a very difficult thing, especially in this part of the world, especially in Japan, 14 years on from the Fukushima disaster. Is Japan right to maximize nuclear power?
Absolutely. Japan, as you know, they're moving forward with nuclear energy. They are accelerating the refurbishment of their existing units. They are extending the life of the units that are currently operating to all the way to 60 years. And I think that we will see soon projects for new nuclear in Japan. Japan doesn't have other energy sources, and nuclear is a good piece of that puzzle for Japan.
And a lot of the public acceptance, am I right in saying, down to the next generation, the new generation, and nuclear reimagined in the form of small modular reactors, SMRs? We hear a lot about this now. What has changed in terms of safety, reliability, and the efficiency of SMRs?
Well, SMRs are very exciting. Everybody is very excited about this new technology. So the technology is just as safe as the existing nuclear reactors. What is quite different is the delivery model, because these reactors are smaller and they're going to be fabricated essentially in series. It's going to be much easier, much faster to deploy them. The civil works are going to be much smaller. So what is very cool, they bring the opportunity to provide not only electricity but other energies on energy. For example, many metallurgical industries, oil and gas, siderurgia, they need high temperature heat for their energy. So that is where nuclear reactors, small modular reactors, will be instrumental.
What work has the World Nuclear Association done in terms of measuring or estimating how much nuclear energy and capacity additions and investment is needed to fuel this AI data center?
Well, AI data centers is just a little bit of the puzzle. I think that, as I said, the oil and gas industry, they are going to need to decarbonize, scope upstream, downstream, so that's very big. Metallurgical industry, aviation, shipping. There is many other industries that desperately need to decarbonize. So what we've been advocating since COP28 is that we at least need to triple global nuclear capacity by 2050. And as you know, we have 31 countries that have accepted this channel. They have signed a ministerial declaration to that effect, and we already have also 14 banks, global major banks and financial institutions that have also this pledge.
And if we could put a conversation to where we are at India and the India Energy Week, I understand that civil nuclear cooperation, and we've been hearing a lot about bilateral energy deals to ensure supply security, is going to be on the agenda when Prime Minister Modi of India and President Trump meet this week. Is a nuclear deal and nuclear energy going to be a big part of those conversations?
I think that nuclear already is very important in India. India has a very strong, very robust, very knowledgeable in nuclear industry. Nuclear has been a very important piece of the puzzle in India, and I think that what we heard last week from our finance minister in India, the goal of having 100 gigawatts of nuclear energy by 2047 is a big challenge. So I think that the projects that we have in India for perhaps realigning the Nuclear Energy Act, the liability laws, in order to incentivize public-private partnerships, perhaps to bring investors and private companies from international locations would be very important to help India accelerate their use of nuclear.
And I know it's the policy prescription and regulatory framework vary from country to country, but what are the most appropriate frameworks that are conducive, that are needed to really support, fuel a build-out and a renaissance in nuclear? Because let's address to our European audiences. We saw the mistakes that Germany made by withdrawing too quickly from nuclear, only for an energy crisis to eventually put them in a very difficult position. The right regulatory policy framework?
Well, you know, I think that every country does need to decide what the right energy mix is for. Is one, for other countries is a different one. In Europe, we are seeing how the majority of the countries in Europe, all the way to 16 countries, have joined the European Nuclear Alliance. Nuclear energy, the current fleet and future nuclear are an essential role. So what I think is essential for governments, for policy makers, is to put clear, transparent, long-term plans where investors, where the nuclear industry, where the supply chains understand what is the long-term plan. They can invest in themselves, they have clarity, they have transparency, and that is going to actually accelerate the role of nuclear. This is what we did with renewables. We gave them clarity, and obviously they have flourished, and I think that nuclear energy needs exactly the same type of visibility.
Fascinating conversation. We'll leave it there. Thank you very much indeed for joining me. Samar Bilbao y Leon there, who is the Director General of the World Nuclear Association. I'll go back to you in the studio, and we'll continue to bring you more conversations about the transition here at India Energy Week. Back to you now.
And I will love every one of those conversations. Thank you very much indeed for bringing us those. Right, coming up on the show, SoftBank numbers about to hit the wires. We'll take you through what you need to know next.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Ambition is in my DNA. My grandparents came over from China to give their children a better life. They opened up a laundry in Buffalo, New York. They raised 5 kids, and they sent all 5 children to college. They achieved their American dream, so I can have mine. It's a privilege to be able to have the platform to help viewers out there make better investment choices so that they can have a better life, so that their American dream. That's what ambition is all about.
Frank Holland, Worldwide Exchange, CNBC.
In the headlines, U.S. President Donald Trump orders government agencies to work with Elon Musk's Department for Government Efficiency on cutbacks as Musk hits back at critics of the project.
The people voted for government reform, and that's what people get. They're going to get what they voted for.
More bad news for UK Chancellor Reeves. Head of Oakley tells her she's run out of fiscal headroom in a first draft forecast. On the earnings front, Siemens Energy reports a record order book of more than 130 billion euros amid stronger demand for energy equipment as profit comes in at almost double expectations this quarter. The Heineken launches a €1.5 billion share buyback as annual profit comes in above forecasts. But the brewer warns this quarter might fall a little flat. We'll hear from Heineken CEO Dolf van den Brink later this morning. Don't miss that first on CBC Conversation, 7:15 London time. SoftBank is crossing at this hour. And just by way of background, SoftBank, Stargate, fortunes are linked now. SoftBank is going to be the financing arm of Stargate as we talk about one of the biggest compute build-out stateside. So just what these numbers look like could have some bearing on the ability of Masayoshi-san to go out to the marketplace and raise capital for that project. And don't forget, DeepSeek, of course, has changed that equation for how funding may be raised at this point. Now, SoftBank, 9-month group numbers, net profit 636.15 billion yen. This is versus a loss of 458.70 billion yen previously. It's tax for 1.27 trillion yen, and that is plus 381.3% for the 9-month basis. So those are the first we're getting. But when it comes to the third quarter, as we break it out down to that metric, with 369.16 billion yen versus a loss of 950 previously at the same point last year. So those are just some of the initial flashes. But to the point here around what happens in the business, because the company has quickly tried to catch up on AI, has a whole bunch of unlisted companies, and of course the performance of a couple of key players here did have an impact or having some bearing on the numbers today. There was Coupang and also Didi. Those are the two exposures we're looking out for. But I made the point around financing. I think that is very key because it doesn't detract from SoftBank. What sort of performance cut do they get in any Stargate financing from here? So is it a huge distraction for a business that has seen Masayoshi bet the house on technology in the past? So the numbers we're getting today, very, very key for that. And just to round it out, what we're getting on the dividend, that is still kept at 44 yen.
ABN AMRO has posted a 27% drop in fourth quarter profit. That represented a modest beat, supported by rising fee for the year ahead. The Dutch Bank says it expects net interest income to fall as much as $300 million. Ferdinand van Dragen is the CFO of ABN AMRO, and we welcome him to the show. Really nice to see you today, Ferdinand. I'm pouring through some of the charts in report as well. I tell you what, why don't you start off by telling us what the highlights were, and then we'll dig into it in more detail. Nice to see you, sir.
Yes, thanks for having me this morning. As you already alluded to it, a good finish to the year, 397 million in net profit, supported by continued high net interest income and also strong fees across all client segments, both compared to the same quarter the year previous, up more than 10%, and that resulted in an overall net profit of 2.4 billion for the full year and an ROE above 10%. If you look underlying cost, you see good cost control because we ended in line with our overall guidance of 5.3 billion. You do see some pickup in the second half of the year, but that was as expected on the back of hiring and a new collective labor agreement mid-year. Impairments, I think the good credit quality, and it was another year, the third year in a row, of almost no impairments, overall a net release. And then if you look at our overall capital ratio, Core Tier 1, it increased by 40 basis points to 14.5%, and we do expect the Basel IV to be reported in Q1 to be at similar levels. So overall, I look back to a good year.
Yeah, I'm going to dig under the hood in the fourth quarter. I see what you're saying about the full year figures, but there's a couple of charts I'd like to go through. Your return on tangible equity in the fourth quarter, whilst your 10% target was attained for the year, that was quite unimpressive.
Let's look at some seasonal effect. For example, we pay the annual banking tax, Dutch banking tax, in the fourth quarter in October. You need to look at cost at some incidentals of around 120 million. That was an update in legal fees and some recurring provisions. So you really need to take those elements into effect if you look at the overall chart of the fourth quarter.
Will, and I'll just do one more on when I think you might have answered my next question. Your cost-income ratio seriously going in the wrong direction, Ferdinand, at 72 compared with a year ago, or the first quarter, 57. Is that down to those legal and restructuring costs you just mentioned?
Yeah, it's some of the one-off costs. But I think it's also, as I said, the seasonal effect of the banking tax and in general taxes have gone up quite significantly. And number two, you always have the more volatile line in other income. I think it's better to look overall at the full year profit of 2.4 billion and an ROE which is above the 10%. So I think that's a better reflection than look in isolation just on the headline ROE for the fourth quarter.
Ferdinand, it's Karen jumping in. Good morning to you. I want to ask you about the government stake now, very large government stake still in terms of ownership of the bank, and that hasn't stopped you in terms of last year. You picked up a European neo-broker and of course this German private bank that you're talking about in a further update today. But given that the banking sector is consolidating seemingly more rapidly than it has in the past and just in the most recent 12-month timeframe thanks to UniCredit, what does that government stake mean? Is it something that blocks you from a takeover? Does it inhibit you from being more active in the marketplace?
No, indeed. I think it's good to see that the new government continues the full privatization of ABN AMRO. So the last program, as you say, announced in the fourth quarter last year to go down from 40% to around 30%. So far, I mean, the government or the foundation holding the shares have been very supportive for ABN AMRO's strategy, including the inorganic strategy of bolt-on acquisitions, as you refer to the acquisition of Bucks and Kaufhaus in Germany. So there's full support there, but it's also a signal with them selling down further that they're confident with the overall strategy. And we have a very well diversified shareholder base, so I also think an increase in liquidity in the shares is a positive signal.
Do further acquisitions make sense at this stage in the cycle, given that we've got really the best of times around the net interest income side behind us thanks to fall interest rates?
Well, it's always a question. I mean, we look at acquisition really where we can accelerate on our strategy. We have an organic strategy, but we look through three lenses. Number one is the strategic element. Our acquisition in Germany is really adding scale in wealth management, which is more fee income. We look through the financial lens, and also there the acquisition in Germany is financially accretive. And number three, always the most important, are you successful in integration and do you realize the synergies as you announced at the acquisition? As for we embark on any M&A. But as said, our overall strategy is an organic strategy.
Realistically, what's the year ahead expecting the banking, given we're talking about trade tariffs, retaliation, the US Federal Reserve in no hurry to cut interest rates at this point? What sort of year are you thinking is ahead?
Yeah, for us clearly important is the overall economy, muted growth outlook, and also for the Netherlands. I mean, the Dutch economy, clearly important for us, has shown to be resilient, and it's all wait and see what the full impact of tariffs are going to be. The Netherlands is an export economy, even more than the US. The German market is a very important trading partner for us. So clearly there are concerns. What we do expect from the trade tariffs that in the second order might have Europe, so that will mean that potential of faster interest rate cuts by the ECB is clearly there. And that is also, if you look at our guidance we provide for net interest income, the bottom end of that is related to the forward curve, which indicates that we will see some more rate cuts by the ECB this year.
Yes, it seems to be the view, doesn't it, Ferdinand? Lovely to see you, sir. Thank you very much for taking our questions on a busy day for you. Ferdinand van Dragen, who is the CFO of ABN AMRO, Karen.
And let's take a quick look at those markets stateside. Mixed picture for the boards. We saw the Dow improving, but the Nasdaq giving back some, and there is a position around big technology names. You could see yesterday IBM to the upside. For the Dow, it was Apple for both the S&P and the Nasdaq, but to the downside, you saw Tesla losing some steam. In terms of the big market action, it's still about tariffs and how disruptive that could be. Companies repositioning supply chains, what we're talking about in terms of inflation, the overall uncertainty. So that is impacting some of the markets under the hood. To Asia, the big theme is still really around technology and DeepSeek. We've seen that motor behind the scenes for the tech indexes, and it's also impacting the overall board you're seeing on Hong Kong and also in Shanghai, both managing to put on more speed. 2.2% on the Hong Kong market, 0.4 up on Shanghai, and you can see bookend by modest improvements for both Japan and South Korea. The only calls here in Europe, we're setting up for trade, chasing more green. We had fresh records yesterday on the stock Europe 600, but also on individual markets on both the FTSE 100 and the DAX, as they both track to fresh all-time highs. So we're looking to top up on some of those gains as we start off the trade this morning, Steve.
The Office of Budget Responsibility in the United Kingdom has reportedly followed the Bank of England in downgrading its growth outlook for the British economy. This, according to the Financial Times and Bloomberg, which say a first draft forecast delivered to the Treasury last week showed UK Chancellor Rachel Reeves incurring a small deficit. This after poor economic data and January's gilt market turmoil apparently helped wipe out Reeves's near £10 billion fiscal margin. Reeves, who has ruled tax rises, says her fiscal rules are ironclad, suggesting spending cuts are on the horizon in next month's spring statement. The UK broke last month's all-time record for gilt orders Tuesday with a sale of £13 billion in 10-year gilts. That was more than 10 times oversubscribed. The demand's there at 4.5, isn't it? As investors try to lock in those elevated yields, or you could just buy it in the market. No, anyway. The OPR will deliver its next economic and fifth outlook on March 26th. The American labour market is broadly in balance and not a source of significant inflationary pressures, according to the Fed Chair Jay Powell, who testified before the Senate Banking Committee on Tuesday. Powell told lawmakers the Fed doesn't need to be in a hurry to lower rates again, cut at each of its last 3 policy meetings. Well, Powell walked a fine line on the impact of policy coming out of the new Trump White House, including, of course, on tariffs.
The standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policies so that we can achieve our mandate.
Coming up on the show, we'll speak to Ahold Delhaize CEO Franz Muller as the retailer posts quarter results. That first on CNBC interview next.
CNBC. Live viciously.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in this complex matters for their lives today and in the future. That's what drives me. I love being part of this.
is no place in the world where we get the kind of access to so many amazing
to be able to solve problems at a scale that nobody's ever imagined.
This industry is going through as the sun.
How big a game changer is this?
Let's go.
Squawk is breakfast with the most interesting people in the world.
Ultimate pre-market morning news show. Squawk Box. CNBC.
Deutsche Börse beat expectations in the fourth quarter, posting a 25% rise in net profit. However, the German exchange operator warned it could face headwinds this year amid lower interest rates. Well, don't miss Annetta's interview with the exchange CEO, Stefan Leithner. That is the first on CNBC interview coming up at 7:30 GMT.
Just pouring through the numbers that have hit the tape from Ahold Delhaize, and Q4 net sales 23.3 billion euros, up 0.6%. Exchange rates up 1% at actual rates. Q4 comparable sales exiting at gasoline up 1.4%, up 1.4% in the US and 1.2% in Europe. Online sales, this is fascinating, up 5.8% in the fourth quarter. And when it comes to operating margin, that was 4.1%, a decrease of 0.2 percentage point. A couple of lines there. Let's get it out to Franz Muller, the CEO of Ahold Delhaize. Franz, just set it up for us. It looks as though you're seeing some strength in that online business in particular. How would you describe the quarter?
Yes, thank you very much. You already mentioned a few good numbers there. We came with a strong fourth quarter. We came out of the gates in a good shape into the 2025 year. You mentioned the numbers already, the comp sales and the profitability, but online was also a thing where we're very proud about. We had corrected for the fresh direct disposal in the US, but also there a double-digit growth in online, and same for Europe. For total group growth, a double-digit, which is a big part of our strategy. So I'm very happy with the fourth quarter, and in the run-up to our Growing Together strategy, which we announced for 25 to 28, I think we have a very good momentum, and also the start of the 2025 year was a good start, both in Europe and in the US, but also for online as well.
Franz, I can see the outlook statement that you're expecting margin of about 4%. What impact do you think trade tariffs may have on some of the numbers, whether it's getting your hands on goods from suppliers overseas, or whether that means there's border costs and that impacts the product at the end stage?
Yeah, thank you very much for the question. A completely understandable question, of course. We have a food business in the US, and that is a very local business. So the majority of our merchandise is sourced locally. But we will see that if you have fruit and vegetables coming from Mexico, products from Canada, that it might have some inflationary effect. But the majority of the food products are sourced locally. So that's very different than if you would sell general merchandise. 95% of our total products are food-related products. So we are pretty well protected there on that front.
Yeah, you have a huge presence in the United States. I think it's around about 60% of your revenues. You can correct me if I'm wrong there as well. You've got solid margins there compared to other areas, including Europe as well. Do you think those margins are going to be under threat? From what Karen just said there, of course, about the about traders, but actually the US consumer, we've all been waiting to see if and when a little bit last week really jumped up aggressively. How is the consumer there?
We don't see a big change in the economic strength of the US households at this moment, but we see consumers making choices for value, more healthy products, and also a switch to meal prepared products as well. We also that we have a strong private brand strategy. We are going to invest in the coming 4 years $1 billion in pricing in the US to be even more competitive. So we understand those consumers very well, and like you mentioned, 60% of our business is in the US and on the East Coast, where we on the East Coast have number 1 and 2 market positions there. So confident into the year, strong online proposition, and I think we have strong brand and very strong teams on the East Coast. So with a good start in the first period of the year, we look confident to our Growing Together strategy, where you said we going to grow 4% in the Grow Together strategy. We have a mid to high single-digit EPS planned for the strategy period. This year, we go to invest 2.7 billion euros to make sure that we are the best potential asset-based company, plus a very strong investment in digital, data, and online. And we will have a free cash flow of at least 2.2 billion euro for 2025. And last thing, for 2024, we propose a dividend of €1.17, which is up with 6%. And we also have, of course, started already our share buyback program of €1 billion.
Just going back to online, you're rightly very proud of the sales figures at digit levels. Can you just confirm something? I'm way behind the curve. Are you actually making money out of online now? Because we've had conversations previously where it's just been such a hard slog.
Yeah, you're not way behind the curve, but we got some improvements to report on. Overall in the US, we're not profitable yet in a fully allocated e-commerce calculation. We calculate honest towards ourselves, but we already have 2 out of 5 brands profitable now. So I think in 2025 we will see more profitable sales coming out of e-commerce, and in Europe we have a number of brands which are already profitable as well. But it's you should see this only isolated e-commerce. It's a total omni-channel proposition where we see customers going in store and online are in the end richer customers for us, more loyal, higher visits, and a bigger share of their wallet we get. So it's a strategy or omni-channel strategy where e-commerce plays a role, but we work very hard to get it even more profitable.
Frans, let me go more granular than that and take a look at the on-demand grocery channel, because you have this partnership over the past year with DoorDash, which is fascinating. I think a lot of consumers, they order food and then you get the option to add some extra grocery items into the basket when your takeaway is being delivered. What does that look like? Because you mentioned acceleration of 20% on orders, but is there a normalization point after this phase?
No, I'm pretty optimistic there. We have in the US, because we talk about the US and when we talk about DoorDash, we have 8.8% penetration of e-commerce in the total sales, which is the highest ever so far. We grow still with Instacart and with DoorDash as our partners, but also our in-store pick, our own click and collect product is also gaining share because we improved our software, picking software quite a bit also for customers, more digitally accessible. So optimistic about the relationship with those two companies, very optimistic double-digit growth. And that's also what we plan for in the 2025 year. And it's not so easy to be well organized for double-digit growth, but that has been the investment in the last 4 or 5 years to be a good online player. And of course, only food in our case.
Frans, lovely to see you, sir. Thank you so much indeed for taking all our questions. And we look forward to speaking to you again soon, sir. Frans Muller, who is the CEO of Ahold Delhaize. It's quite extraordinary how, for all these years, how tough online is to actually make money out of it. I mean, making great sales figures. A couple of big stories. This is a lighter story, okay? 200,000 Danes have signed an online petition. I think it's satirical, okay, so take it with a pinch of salt. An online petition by California. Yeah, the Danes want to buy California from the US. It's a satirical response, of course, to President Trump's bid to acquire Greenland from the Danish government. Some Republican politicians continue their push for the territory, with Georgia Representative Buddy Carter introducing a bill that would rename Greenland, you can't make this stuff up, that would rename Greenland Red, White and Blue Land. Yeah. But what I loved was the line from the from the Danes. They want to introduce bike lanes in Beverly Hills. They want smørbrød, which is kind of like a butter bread thing. But they also want to introduce hygge. And the whole world needs more hygge. That's H-Y-G. Hygge is basically the simpler pleasure in life. It's fluffy socks, candles, blankets, log fire. Just simplicity. Warm drinks.
Right.
I think companies would like that.
The problem is that organisers have the funding model wrong. So they're trying to crowdfund.
Oh yeah, they want $1 trillion.
They want $1 trillion to buy California, but they're only collecting signatures, not donations. The fund model seems to be a major flaw.
I think 10 out of 10 for the Danes when their sense of humour. And I hope my American friends take it in good spirit.
But I think what we learned is that fire with fire. We've seen that with Altman in his response in recent days about buying Twitter from Musk as...
So 9.7
exactly. So this is a very, very similar vein, I think, about getting the publicity stunt out there. Meet publicity with another publicity
stunt. It's better than everyone getting angry. So well done to the Danes on that one. Right, to come up on the show, Fed Chair Jerome Powell testifies on Capitol Hill, taking questions on trade, the aforementioned Elon Musk, and bank account safety. We'll discuss that.
1,500 movie. I don't want this flight to end.
Watch the Markets Open, brought to you by Emirates.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solve problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We haven't been to the table for the solution that we find together in this fragmented world, and music is always at the center of it.
Real lives, real stories, only on CNBC.
CNBC.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, weekdays, CNBC.
We'll act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action, and take action now.
Join the sustainable future, only on CNBC.
Welcome to the second hour of Squawk Box. I'm Karen with Steve Sedgwick, and these are your headlines. US President Donald Trump orders government agencies to work with Elon Musk's Department for Government Efficiency on cutbacks as Musk hits back at critics of the project.
The people voted for major government reform, and that's what people are going to get. They're going to get what they voted for.
SoftBank Post say third quarter loss of nearly $2.5 billion, massively underperforming expectations as valuations at its Vision funds side.
Siemens Energy reporting a record order book amid strong demand for energy equipment as first quarter profit almost doubles expectations. And Heineken launches a €1.5 billion share buyback as annual profit comes in above forecast. But the brewer warns this quarter might fall a little flat. From the CEO of Heineken, Dolf van den Brink. Later this morning, don't miss that first on CNBC Conversation. In fact, not later this morning, 14 minutes time. And more bad news for the UK's Chancellor of the Exchequer, Rachel Reeves, ahead of next month's spring statement as the country's budget watchdog reportedly tells her she's run out of fiscal headroom in a first draft forecast. President Trump has ordered federal agencies to cooperate with Elon Musk's Department of Government Efficiency to find ways to shrink the size of the federal labour force through identifying workers who can be laid off and functions that could be eliminated. The executive order also limits federal recruitment once Trump's hiring freeze ends, with agencies allowed to hire only one employee for every 4 who depart. But I guess it depends who's departing and what department and their role, doesn't it? It can't just be just in numerical. It has to be on, I don't know, there's other factors apparently. Law enforcement, national security and immigration enforcement roles are exempt from the curbs. Appearing alongside Elon Musk and another key advisor, his son, in the Oval Office, President Trump made a series of claims that federal funds were being misused, without offering any direct evidence, assertions that CNBC is not able to verify.
Billions and billions of dollars in waste, fraud, and abuse. And I think it's very important. And that's one of the reasons I got elected. I said, we're going to do that. Nobody had any idea it was that bad. They just want to try and stop us from looking for corruption, especially when we found hundreds of millions of dollars, much more than that, in just a short period of time. We want to weed out the corruption.
Elon Musk used the signing to hit back at critics of his own project.
The people voted for major government reform. There should be no doubt about that. That was on the campaign. The president spoke about that at every rally. The people voted for major reform, and that's what people are going to get. They're going to get what they voted for.
Let's get into the weeds on SoftBank Group. It did post a net loss of $2.4 billion in the third quarter as valuations at its vision fund slid. The investment arm posted a net loss after 2 consecutive quarters of profit. It's always the devil booked on Alibaba shares, 902.9 billion yen. It did have an offset here on a derivative loss on the same asset class, on the same Alibaba shares of 635.9 billion. So gave a lot of those gains back thanks to losses on derivatives. So a lot of financial engineering here. There was a win on T-Mobile shares. And the rest of the devil in the detail for me, very interesting around what it is investing in. And it's actually called out a couple of investments in the UK. So a bit of a win for the UK here. There is an investment in Wave Technologies. This is a UK autonomous driving platform here using AI. So that is one investment that was made. 426 billion yen tallied up in the numbers in terms of investments for SoftBank Group. Another acquisition, Graphcore, the company we've also spoken about, design of semiconductor chips in the UK. So that was another one. SPE Global solar power plants. That was also where SoftBank Group was pivoting its funds. This does remind me of the magician with the magic that keeps moving them around, and that's where it gets a little bit murky for the Vision Fund. Total investments of $1.63 billion. Primarily in enterprise and frontier tech sectors, but net of investments transferred from the company to the Vision Fund. That's where you've had some impact there. But interesting to see that it was enterprise and frontier tech that the Vision Fund has been focused on. And let's push on and take a look at what the US markets did overnight. A bit of a mixed bag. We saw the NASDAQ reversing. A lot of positioning again around tech names to the upside. Apple, for instance, driving the likes of the Dow, the S&P and the NASDAQ. Elsewhere, Tesla under some selling pressure. To tariffs, of course, so that is another big theme for markets, driving some of the uncertainty. And yesterday we had a dose of rate concern, as Jay Powell was again saying we're not in any rush to cut interest rates. So next up will be the CPI figures later on today. That could be a big driver, a little bit north, 4.30 at the short end. Again, a big driver for the dollar. The trade this morning, it was a firmer greenback as we checked on it last time. You can see that again versus the Japanese yen in particular, where it's marked higher by about 0.7%. Asian markets, big tech focus still around DeepSeek. They're drawing in international money to those tech trades out of China. That is bolstering the fortunes of the Hong Kong index as well. Shanghai market trades up, but quite that Shanghai, the Hong Kong trade of more than 2% now this hour. To European futures, we had record levels here on the stock strip 600 yesterday. 5 positive sessions out of 6. The FTSE 100 also at a record, and the DAX in that mix. So there certainly has been some momentum. We're chasing a little bit more this morning.
Yes, we are. Right. The American labour market is broadly imbalanced and not a source of significant inflationary pressures, according to the Fed Chair Jay Powell, who testified before the Senate Banking Committee on Tuesday. Powell told lawmakers the Fed doesn't need to be in a hurry to lower rates again after the FOMC cut at each of its last 3 policy meetings. Mr. Powell walked a pretty fine line, as we know he would, on the impact of policy coming out of the new Trump White House, including, of course, tariffs.
The standard is for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our end.
And where the logic can provide. Joins us now, global macro strategist, RBC Capital Markets. Peter, we saw a very, very specific commentary there from Jay Powell trying to keep the focus on monetary policy. And we know there's all sorts of distractions and potential distortions for the central bank. What do you think the job looks like now for Jay Powell and co. trying to keep rates on a steady keel this year?
I mean, in a way, he's in a comfortable but yet uncomfortable position, because when you look at sort of the underlying fundamentals of the economy, they're strong. The inflation has been coming down, but not as much that they potentially need to cut significantly. And he's been given a relatively steady message that, probably done. We actually think they're done, with small easing bias still in the market. And he can fall back on that, and he can sort of push away the whole tariff situation as he did, so masterfully yesterday.
The market and businesses had this gigantic hope that deregulation and tax reduction would be very supportive for business, and the atmosphere we saw on the back of the election. Now in the first quarter, it's been so disruptive on tariffs and megaphone diplomacy from the White House that businesses are in a state of flux about what their business model look like, and supply chains too. What does it mean in terms of confidence levels, at least from the first quarter?
Well, actually, business confidence is okay. Clearly, again, given that the fundamentals remain strong. We'll have to see what the retail sector is doing. I mean, we get retail sales later. And it's particularly sort of the lower income brackets that are struggling a bit. And I think this is also where the job with the Fed comes into play, because obviously as inflation remains elevated, and if we don't get a significant bump of wage growth, then this part of the economy will probably continue to struggle. And I think that's probably where it is. But on the business side of things, we'll have to see what comes out of the tariffs, of course, because that could really throw a spanner in the works. But so far, it's been holding up all right.
Hey, am I wrong to be hopeful about Europe? Because it's been a forlorn quest for most of my career. Because I'm actually quite excited about Europe seeing a problem, having a diagnosis for a problem, and actually getting itself into gear. I see a lot of positivity about what we're going to do, that we have a recipe. I think we're actually doing it, and actually this Trump episode will act as a further catalyst for Europe to improve.
Well, I mean, it's maybe a forlorn quest here, but I think you're right. Identify problems, and so particularly one of the problems that I see for Europe is that we have a productivity problem. But then the question is, what can we do about it? Particularly when it comes to these kind of problems, what can we do about it quickly? And I think that's the problem in Europe generally. But by and large, I tend to share your tentative optimism. I think consensus out there is pretty grim, and I think the reality on the ground is probably not quite as grim.
Yeah, and let's talk about Germany. I mean, it's going to start from Germany if we're going to get a broad scale rather than small scale response as well. I see nothing from either candidate that dims my optimism that either CDU, the SPD, plus their allies, or whoever builds the coalition as well, I see nothing that tells me they're not going to change the Schuldenbremse.
Oh, yeah. I'm absolutely certain.
So that's great news.
Yeah, I think
the Germans spend money, the ECB's cutting rates, the corporates are just desperate for it, and the Commission's talking about regulatory improvements. Win, win.
Well, first of all, I absolutely agree. I think there will be a fiscal loosening, and that they will reform the Schuldenbremse. The problem is, again, so when you look at the underlying structural thing that holds Europe back, and the UK, by the way, is that we simply have not improved our productivity outcome over a couple of years. And that's something that requires investment, that requires sort of probably a whole suite of changes, regulatory changes as well, to make it easier for business to invest. And these things just take time. So it's nothing that you can just flip a switch and off we go.
If we get signals, though, and that's what the European Commission is indicating, that will will be a change of direction for Europe. Does that have any bearing on monetary policy? Because for so long we've been talking about monetary policy doing the heavy lifting, and even this year, if it gets set up, growth looks very weak. It looks like the ECB might have to be more on the front foot in terms of cutting rates. Could there be something that changes direction slightly for the ECB, thanks to what the European Commission is talking about?
Well, I certainly am one of the proponents who thinks that the market is most of the time these days overestimating what the ECB will ultimately deliver. And I think you're absolutely right. It's not necessarily monetary policy that needs to do the heavy lifting. And in fact, when you look at the current setup, we're at a very different environment. Unemployment is very low, wage growth. I think the ECB is overestimating the drag to the downside of wage growth. And so I think there are quite a few things that can help that. And indeed, if you get sort of a drive to deregulate a bit, and if you get a bit of a fiscal stimulus, I think the story is even more powerful.
And you make me chuckle because you say the markets are over. Markets have called 30 of the last 5 recessions, as you well know, and stateside as well. What does this mean for rates? You are the rate. Well, just give us our views a little bit of something they can hang on to for the next trade.
So if we first of all, if we stay at the shorter end of the curve, the market is now pushing again the front-end rates for the ECB below 2%. We think the ECB could easily end up at 2.25%. So that's obviously higher than that. So from that perspective, I'll try to fade that a bit. At the longer end of the curve, when you look at it, I mean, our inflation expectations are still relatively low. And if you believe, as I do, that wage pressures are probably stronger than the ECB thinks, I think that's probably a drag to the upside. And then the term structure generally is low. So I think with Bund, around about 250, I think I want to be higher.
Could still be tight for Europe if neutral is 1.75%. That was a discussion I had with Madame Lagarde whether that could be a level. In terms of tariffs, and this is the mix that we're just adding into the cocktail that we spoke about, whether that's disinflationary or inflation, whether we get some pull here of a product coming into Europe because it's been rerouted away from the United States. If that's the case, what does price stability look like to the downside?
Well, first of all, this is one of my pet subjects here, if you allow me. So, I mean, the ECB is obviously saying 175 to 2.25 is sort of their range. Now, when you look at where that comes from, they estimate sort of a real level and then slap 2% on top of it, typically. But, do we get to 2%? That's what they say. I think the risk is that we stay higher here. If then add tariffs, of course, everyone I'm speaking to basically says if the US slaps tariffs on China, all the goods are coming to Europe, that's disinflationary. I think that's the consensus story out there. But then Europe had a huge problem with the way how China is acting, how the Chinese firms are basically bringing their products into the key markets for the Europeans. And we've seen already last year that the European Commission put a tariff on China as well. I could see a scenario where the US administration is coming over to Europe. They don't have to do a lot of arm twisting to get the Europeans to follow what the US is doing too.
How dare those Chinese bring in better quality, better technology, cheaper products into Europe? Goodness me, we should have the more expensive, less technologically adept European product. That's what we could have at a higher price. We're going to leave it there.
Peter, thank you very much for joining us.
Thank
Peter Shaffer with us, Global Macro Strategist, RBC Capital Markets. Ahead on the show, Heineken posts a net profit beat for the full year on stronger than expected volume growth. We'll be speaking to the CEO, Dolf van der Brink. That is next.
CNBC. Live ambitiously.
We have 25 member carriers and they have their different priorities, different strategies, different business models. And so for us, the core focus is to find consensus on key issues that are important to the carriers, but ultimately that are important to customers. Collaboration to me is all about bringing companies together, creating an environment that allows people to put their ideas and recommendations on the table without fear of criticism, without fear of being judged, because ultimately that's where the solutions come from. The core role of leadership is it's about everyone around you. People rely on you disproportionately. Demonstrating very strong levels of humility is a very, very important part of leadership. And if you get that right, you'll get very deep loyalty and commitment from people that will deliver upon things in ways that you wouldn't otherwise expect.
Hi, I'm Kevin.
and I'm the Chief Strategy Officer at Ritter. Companies like mine are proof that an AI-powered future is already here. And if you want to experience that future firsthand, there's only one place in the world you need to be.
Live from the New York Stock Exchange, Halftime Report, CNBC.
Siemens Energy saw a record order book in the first quarter amid strong demand for its energy equipment. The company posted a net profit of 252 million euros, almost double expectations.
Heineken has posted a net profit rise of 8.3% for the full year, ahead of analysts' expectations and its own guidance. The Dutch brewer saw beer volumes rise 1.6% on the year on an organic basis and announced a 1.5 billion euro buyback program over the next 2 years. We always learn something speaking to Dolf van den Brink, and he joins us now, the CEO of Heineken. Dolf, excellent to see you today. Look, we've been waiting for Evergreen to really show the shoots of all the labour you've been putting into it. Is this the sort of number where it starts to really come together?
Good morning, Steve and Karen. Thanks for having me. Yes, we do believe. We're very proud of our results of last year. Very solid, with broad-based growth across all 4 regions. We saw a volume growth, 5% revenue growth, 8.3% operating profit growth. What's also very important in our volume performance is the quality of the performance. So it was low single digits, up 5%. The almighty Heineken brand up 9%. And actually our 0.0, which is not a priority for the company, up 10%. So very pleased with these results overall. And we believe it's also a consequence of the continued investments in growth that we're making. Last year we increased our marketing and selling expenses by 300 million, growing at double the rate of revenue. And we really believe that that's starting to pay off.
Dolf, but if I look down the beer volume breakdown, the organic growth, right, I mean, look, the US is lowish, 0.8%. Sorry, the Americas, the broad Americas. Great growth in Asia Pacific, great growth in Africa and Middle East. Europe, though, it looks painfully hard work, sir.
It is, but we were actually pleased to see stable to slightly up volumes across Europe. In a very important market like the UK, we saw our volumes up. We're gaining share both in the off-trade and the on-trade. We launched a new brand, Cruzcampo, who's really scaling very fast. So we're really seeing green shoots. But in the aggregate, after a lot of input cost inflation in last year's, consequently a lot of pricing, we really believe last year was the year of stabilization across the European markets. We also deliberately kept our pricing moderate to really allow the consumers to re-engage with the category. And again, pleased to see the moderate volume growth across the region. And indeed, in some of the other regions in our emerging market, Latin America, our performance, Brazil, Mexico, the African markets and APEC markets really coming through strongly.
Dolf, can I come back to the premium versus the non-alcohol segment? Because to me, when I looked at the premium numbers, up 5%, it says premiumization is still key. But if we look at the zero alcohol trend, up 10%, it suggests that innovation actually trumps premiumization. Would you agree with that?
Yes, and we have been, we believe, a pioneer of the 0.0 segment. When we launched Heineken 0.0 back in 2017, the global segment was in a way dormant, was not growing fast. Every single market where we've launched Heineken 0.0, which is now more than 115 countries globally, we've really seen the segment taking off. We are the global leader in the segment. And according to our calculations, since launching Heineken 0.0, we have captured more than 40% of the global absolute growth of the 0.0 segment. So it's very important to us, and we will continue to invest. And that's part of innovation, as you were saying, but Heineken 0.0 itself remains very important. And we're really making the investment to make 0.0 beers cool and to make them socially acceptable. And we're doing that, for example, with our Formula One sponsorship platform, which is fully dedicated to Heineken 0.0.
Dolph, I want to ask you a little bit about pricing, because this time a year ago pricing was doing some of the heavy lifting, but I can see volumes have picked up across the jurisdictions. What does pricing look like? What sort of headroom do you have to pricing in this consumer environment?
Yeah, basically what we're seeing, as I said, for example, Europe, we deliberately kept our pricing more moderate. We have other countries, for example, across Africa, where you still are faced with very high local inflation, where you really need to make sure that you price accordingly. That's why you saw very high price mix in the Africa, Middle East region. Across the board, what we are aiming for is balanced growth between volume and value, and we really believe that last year we have been able to deliver that.
Dolph, you put a positive spin on the investment in the brands, but that marketing spend of 300 million euros is still quite high, and you've promised to spend even more. What's the breakdown here? What is moving the needle when you spend that sort of money in terms of getting the revenue up?
Yeah, it's basically investing in your most important brands, global brands like Heineken, Moretti, Desperados, investing in our big legacy local brands like Kingfisher in India or Tecate in Mexico. We're also really investing in digitizing our go-to-market, what we'll EB2B. We're now capturing 13 billion euro gross merchandising value in digitally generated revenue. So not one thing, it's across brands, across categories, across marketing and sales. And we try to be very efficient about it. The fact that we're increasing it by big numbers doesn't mean that we're spending it lightly, but we're also there investing a lot in data to really make sure that every euro of that investment counts. And again, looking at our results, looking at our market share results globally, we really believe that those evergreen investments are starting to pay off.
Dolph, I know that you've done a lot of work with the pubs over the years, and helping support them during COVID as well was absolutely pivotal. But having said that, you know, as I, a lot of them are struggling at the moment. Your recent price hike, somewhere in the region of 2.97%, that's a tough pill to swallow for a lot of pubs as well. Do you think necessary?
Yeah, and again, we really try to strike the right balance. Our salaries are going up by percentages are higher than that. Energy cost has been up higher than that. So we really try to find a balance between making sure that partly we pass on some of the inflation that we're seeing on our own input costs, but at the same time keeping it moderate. As you were saying, we have been investing hundreds of millions of pounds in our pub estate. We operate around over 2,500 pubs in the UK, and actually we are outperforming the category. We're very pleased with our results in the UK, as I said earlier. It is also not just the investments in the pub, we also believe it's the power of the portfolio, with Moretti now the largest lager brand in the on-trade, Beavertown being the largest craft brand in the country. We see a lot of growth in premium cider like Inches and Old Mout. So quite pleased in general, I would say, with the performance in the UK.
Yeah, and I guess you'd never have that problem that some people have of running out of 0.0 just before Christmas. But we won't name any rivals on that one. In terms of the buyback, yeah, I bet you love that. I bet you, actually, do you know, did you like that story? Let me, before I ask you a sensible story. Did you like that one, or was it just marketing?
Look, we have a lot of respect for the brand that you're referencing, but again, we're super proud of our portfolio, and as our share and top line performance shows in the UK, we're quite pleased.
Yeah, fair enough. That's as much as I'm going to get out of on camera and all that. Look, still, what about the buyback as well? As much as these are a good set of numbers as well, the shares have been underwhelming. You know that as well. Is the buyback just a little bit of a boost for those shares at this point that the investors are asking for?
No, we have a very clear hierarchy of our capital allocation principle. Start by investing in the organic growth of the company. As I was mentioning, the investments we're making in marketing and selling. We're building right now 3 greenfield breweries, new breweries in fast growth markets like Mexico, Brazil and Dubai. So that's always our first priority. It's really about the optimal capital structure. We really want to be below 2.5 times EBITDA. We always will look at good inorganic opportunities like what we did in India and South Africa recently. But then if we have surplus cash, we do want to make sure that we return them to capitals. We're very happy with the step up in our dividend, 7.5%, more now than €1 billion, as well as indeed the share buyback, 1.5 billion over a 2-year period. But it's really a clear and consistent hierarchy of capital allocation. We had very strong cash flow generation last year, up significantly, passing the €3 billion mark, which allowed also our leverage to drop to only 2.2 times EBITDA, which really maneuvered us in the position to consider and decide on the share buyback.
Dolf, let me come back in on tariffs, because you shrugged off the impact of those aluminium tariffs, the 25% that we're talking about from Trump. If there are no carve-outs here, how does it not have the maneuvering from other major players in getting around any increase?
Yeah, so one thing to know about the beer industry, and in particular for Heineken, that the beer industry is capital intensive and is very local. So in over 70 countries we have local breweries with 80-90% local sourcing, operated by local people, selling to local consumers. So as such, it's an industry that's a bit less susceptible to disruption in international trade flows. On the tariffs, yeah, we like to joke internally, we have green bottles, we don't have crystal bottles. You know, we don't know more than you do. We keep following things attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there. But again, we keep following it, but given our footprint and our local structure, for us the impact is at this moment assessed to be relatively manageable.
Dolf, I think that's a message for consumers about pricing for this year, isn't it? Thank you very much for joining us. Dolf van den Brink with us, the CEO of Heineken. A quick look at how futures are shaping up, and we've been mentioning the records we've seen on European stock prices in the past 24 hours. The stock 600, FTSE, the DAX, all at record levels. This morning we are chasing a little bit more for the DAX in particular, seen up by about 0.25%.
For a brand to be truly authentic, it needs to first define clearly what is their mission. What problem do they solve, and under what brand promise? Only this will enable them to govern all their decisions. Without it, you cannot actually go to the market. You need to be authentic, and consumers can spot immediately if any collaboration or brand partnership is inauthentic. That's the only way to truly be united into serving and solving consumer pain points. Delivering meaningful innovation for consumers is starting with truly understanding consumer needs. I think the key to a human-centric brand like Electrolux is putting the consumer in the front and serving truly their needs.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses they're used to.
Is never enough.
Someone who has the social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fought for them.
I believe in getting justice.
American Greed on CNBC. Before they talk to Wall Street, they talk to John Ford and Morgan Brandt. Closing bell overtime.
welcome to Squawk Box. If you are just joining us, here are your headlines. Heineken moves higher in early Frankfurt trade as it launches a €1.5 billion share buyback, and annual profit comes in above forecasts. CEO Dolf van den Brink is optimistic on the impact of tariffs.
We will keep following things attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there.
Siemens Energy reports a record order book amid strong demand for energy equipment as Q1 profit almost doubles expectations. SoftBank posts a third quarter loss of nearly €2.5 billion, massively underperforming expectations as valuation at its Vision Fund slides. Bad news for UK Chancellor Rachel Reeves in next month's spring statement, as the country's budget watchdog reportedly tells her she's run out of fiscal headroom in her first draft forecast. Let's take a look at the Asian markets. It feels as though lights on technology assets in China in recent weeks, and of course that was DeepSeek. It's had an impact on the sector, but also on the major boards, and you're seeing Hong Kong up 2.4% today. Another bounce for the Shanghai Composite up more than 0.8%. So green across those regions. Still a big threat around tariffs, and that is keeping some of the industries a little bit cautious, even on the Asian markets. Cars, for instance, you can see Japanese stocks up 0.4, Cosby up a little bit less than that. European futures, where there has been momentum of late, and this is again opposed to that US exceptionalism story we are seeing across on European markets. Fresh records on the Stocks Europe 600 yesterday, particular markets, the FTSE 100 in the UK, and German stocks also at a record. So this morning we are looking a little bit cautious on the FTSE. However, we are chasing higher ground again on German stocks, up by 0.25%, which is fascinating, as of course we also count down to a German election, Steve.
Delhaize is posted weaker than expected in profit of €200 million in the fourth quarter. Sales for the period came in marginally ahead of analyst expectations. The company says it has seen volumes recover in the United States. ABN AMRO has posted a 27% drop in fourth quarter profit. That represented a modest beat compared with expectations. You can see the shares there have had supported by rising fees. It was fascinating speaking to the CFO actually about the cost increase and the profit decline compared with previous quarters, and he says a lot of it's down to restructuring costs and other factors there. But for the year ahead, the Dutch bank says it expects net interest income to fall as much as $300 million. Shares of TeamViewer are higher pre-market after the software developers' full year revenue expectations up 9% on the year to €671 million. The company also outlined mid-term targets following the completion of its acquisition of IT firm 1E, forecasting revenue between 1.03 and 1.06 billion euros for 2028. Karen.
Let's talk about, we're going to talk about the German stock market, I think, and we've got stocks at fresh records on the DAX, which is incredible. We've spoken to a lot of the German companies about how they're powering ahead with earnings, even in spite of regulatory changes that would be useful for the business that they haven't come through yet. So is there more upside for German stocks, German companies, and does it carry the Deutsche Börse
I
forward?
hear you, but I think that our mindset is thinking market, IPOs, M&A activity, stocks and shares. I think, and I'll be fascinated with Annetta's interview, which is coming up now.
Aren't you?
Yeah, I am, because I think that's where changes and others are going. I think that's where it's at, I really do. Deutsche Börse has beat expectations in the fourth quarter, posting a 25% rise in net profit. However, the German exchange operator warned it faced headwinds this year amid lower interest rates. Well, Annetta has a very special guest. Hello, Annetta.
Good morning, Steve. Yes, indeed. I'm joined by the CEO of Deutsche Börse, Stefan Leitner. Though, thank you very much for joining us this morning. Just said that you had a record year and the shares are at a record high. We're seeing a little weakness pre-market. So, but where do you stand and what's the outlook?
Well, thank you very much for having us. It's a great sort of day today to report our results. We had a fantastic overall outcome for 2024. We have seen a 15% increase of our net revenues, a 15% EBITDA increase. Our EPS has grown 16%, so a fantastic year. It's a continuation of our strategy. Our strategy is very much, we see the big trends and we look forward therefore very confidently into the new year.
We see a certain kind of decoupling. The market is rallying, storming ahead from one record to the other, whereas the economy is doing so poorly. Why is that, and can that keep on going over for this year?
Well, first of all, there is a number of geopolitical events that certainly are influencing the markets. So we have seen overall, however, that the underlying sort of growth has very much been intact in the parameters that drive our own business. Those are the financial markets parameters, those are the number of transactions. This is in the overall context, the trends, the mega trends that are shaping sort of a bigger investment in Europe, and that's very much going on.
So are you confident that this can also stay like this if we see, for example, tariffs being enacted? So is there a risk that international investors might actually lose to invest in German blue chips?
Well, we've seen over the last few months, actually, that many have seen that Europe has bottomed out from a valuation perspective. Or we have seen the share prices in Europe outperform relative to other indices. You see it for the year of 2024, or negative talk, and the underlying economic issues. Let's be clear, those are significant. There's big change that is needed in Europe, but the capital markets have the role to play in that context. So that will continue to drive, in particular, our own business.
I'm sure you talk to international investors, international financial community. So what's their perception of Germany as an economy and also a place to do business?
Certainly an enormous number of challenges or that they feel are untackled at this point. That's why the impetus, the discussion that is going on around how can the German transformation momentum be really strengthened is a very important discussion to come back and have a strong equity story for Europe and for Germany. And many of the German corporates are doing actually pretty well. You know, that's a big split between what is the reality of very agile companies that have adapted to many of the geopolitical changes, while on the other side, the underlying sort of economy environment in Germany itself.
Yeah, it seems that German corporates are big at investing abroad, though. Is that a concern to you as well? Because clearly, if there's more and more investment moving away, then there's less capital market activity here.
Well, on the first hand, it is important that the companies react to the geopolitical changes. German companies have always been very good in being adapting. The agility that comes with the German Mittelstand connotation is a very powerful and positive development. At the end of the day, there's only a strength in that and not a weakness. Now, the point about the investment amounts that happen in Germany versus internationally, some of that is obviously a result of the fracturing of the geopolitical value chains that is going on. So that requires a stronger localization for German companies, and that's what is actually happening by them investing in the US, in Asia, in new locations.
Let's look perhaps at the upcoming election. It's only 2 weeks to go until we know who is actually winning. So what are your hopes pinned to the election results, and what should the new government do to change the atmosphere?
Well, the first one is we all are very confident and very much pushing towards a strong participation in the election. It's critical that we see a strong democratic turnout. That is a critical sign for German democracy, for the country to have a spirit of momentum. The key actions are pretty obvious in terms of what are some of the big transformational tasks. What we would really want to emphasize is that the capital market play a critical role. It's underdeveloped in Europe. It doesn't have the investor base. So one of the key themes that any new government should really tackle is old age pensions, the demographic change, and therefore, address some of the shortcomings that we have both in building a capital base, but also really creating value for future generations and having them participate in the value creation which German companies are actually doing day in, day out.
What needs to change that German corporates who want to go to the market, want to go public, actually choose Germany as the place and not elsewhere?
That there's strong German or European investors that are interested to buy their shares on day one. That's what it takes. Today we are too dependent on international capital flows, and therefore there's not enough baseline interest. There's not enough baseline investment. Institutional investors are often constrained from investing into German, European, but also international stocks. They're overinvested cash deposits.
I have to ask you about the IPO backlog because there's a lot of hope. I think that 2025 will see a bit more IPOs than last year. So what's installed?
I think we're at the place where it's going to happen. You will have our bell ringings down here on our floor. We look very much forward. We're ready for it. There's no question that the infrastructure is intact and we're able to handle those. I think at the end of the day, much will depend on shorter-term market dynamics, as always in these IPO situations. A lot depends, but there's no question that there is a big backlog. There's many of the financial investors that have been holding companies for too long now. They really have to move on. And at the same time, there's a number of the corporate situations where, young and upcoming companies are now ready for the market. So we are actually very positive, but it will depend on ultimate market dynamics.
Mr. Leitner, thank you very much. Stay there. Well, with that, I'm sending it back over to you. You see there are loads of challenges for the economy, but I think it is actually quite interesting to see that momentum building up because it reminds me of your early 2000s when there was this economic malaise as well, and that politicians finally had enough political will to actually enact changes despite them being perhaps harmful for them. So let's see.
You stick around long enough, Annette, you see enough momentum. Coming up, though, SoftBank books a net loss in the third quarter as valuations at its vision fund slide. More after the break.
Interactive Brokers pays up to 83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best we can possibly be. More often than kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
LGBTQ rights and our acceptance.
And force the solution that we can find together. This fragmented world, in music is always the center of it.
Real lives, real stories, only on CNBC.
Scott Wapner from the NYSE, Closing Bell, CNBC.
Well, there's a pompous name for a very important body within the UK. It's called the Office for Budget Responsibility. The OBR has just done something quite big, we think. They have reportedly followed the Bank of England, downgrading its growth outlook for the British economy. Why is that important? It's according to the FT and Bloomberg Solar, which says a first draft forecast delivered to the Treasury last week showed that UK chance of the Exchequer Rachel Reeves incurs a small deficit. Now, this comes after poor economic data and January's gilt market turmoil. Apparently, helped wipe out Reeves' near £10 billion fiscal margin. So this is a government that said growth, growth, growth. You remember it? As they came in before the election, after the election, we all waited for the budget. It's gone. The fiscal elasticity is gone. Reeves, who has ruled out further tax rises, says her fiscal rules are ironclad. suggesting cut on the horizon in next month's spring statement. The UK broke last month's all-time record for gilt orders, though, on Tuesday. This is really interesting. It's a sale of £13 billion, right, of 10-year gilts. How many times oversubscribed do you think it was? And if you're watching early, you know the answer, because I told you. Directors watching, 10 times, or he's certainly reading my prompt, 10 times oversubscribed. I mean, a lot of demand. Investors trying to lock in those elevated yields. Now, the OBR will deliver its next economic and fiscal outlook on March 26th.
There's been a lot of AI news in the last 48 hours or so, and the US and UK have refused, to sign a communique at the Paris AI Action Summit calling for the open and ethical development of artificial intelligence. The British government said it declined over national security and global concern. The US Vice President J.D. Vance has told the audience earlier on Tuesday that international regimes must, quote, foster the creation of AI rather than strangle it. Around 60 countries have signed the communique, including France, India and China. I think AI could have done that really better than me at that point. And let's move on to the sidelines of the AI Summit, because French telco group Orange said it is partnering with Mistral AI to develop large-scale network infrastructure in France. Arjun caught up with the Orange CEO Crystal Heidemann, who said AI could help boost Europe's standing in the global market.
We know we've lost competitivity in Europe, and it's not just, AI is just a new wave, but it's because of the cost of energy. It's because indeed of the fragmentation of Europe. Europe is 27 member states with different rules, and it's true that we've been adding industries and on top of national regulation. So that's slowing us down, especially when you think of the potential of the European market. We are a large consumer market, but it's very difficult for one company that starts to innovate in one country to expand and to better. US and China, it's one language, one country. We don't have that in Europe. Now maybe AI actually is going to help us reduce some of the barriers.
OpenAI sparked a frenzy in the artificial intelligence space. Really? No, it's true. With others trying to catch up, but it's not the only player. Now, the UAE's AI minister told CNBC. The minister gave his views on what the surprise bid from Elon Musk's backed group for the company set up the state of the global AI race.
I don't know how Elon feels. I can't comment on his sentiment, but you have to think about it. He was the major shareholder for $50 million at one point of time. So I'm not sure how he feels, but I'd love to ask him about that.
How do you think the battle for OpenAI is going to play out? You could argue that this is probably the most important strategic artificial intelligence asset globally today as it stands. How does this battle between Musk and Altman end in your view?
So I don't think that the only conversation we need to be having is OpenAI. So even if you look at, for example, today, the potential of OpenAI, if you look at internet traffic, Google's at least, if I'm not mistaken, 12 or 13 times that of OpenAI as it currently stands, maybe even more. So there's still a long way to go. And I don't think Google is going to just sit there and wait for it. I think they're going to innovate. I think they're going to iterate. They're going to improve. So it's a bit early. What OpenAI and ChatGPT was able to do is it was able to spark a sort of frenzy that others are trying to catch up right now or pivot towards what they were able to do. You see the new reasoning models are actually quite impressive, and the deep research models as well that OpenAI has announced are actually quite impressive. But the time to emulate and deploy something similar has been reduced drastically. So I don't know how long this advantage is going to be maintained. Now, sometimes when we ask these questions, we identify OpenAI as the only player. I think they are the only player. I think we will have emergence of other companies that are going to be as important, and especially in very specific.
OpenAI CEO Sam Altman has told staff in an internal memo seen by CNBC that the company has not received an official offer from Elon Musk for the purchase of its non-profit arm. It comes after news broke that a consortium led by Musk is vying to buy control of OpenAI for just under $100 billion. And as Arjun asked yesterday, why didn't he go to $100 billion rather than 97.4? Anyway, in the memo, Altman says OpenAI is structured so that no single individual can take control of the company, adding that Musk's offer was aimed at weakening it. Well, Arjun spoke to one of the two protagonists himself, Sam Altman, at the AI Action Summit in Paris, where he claimed, that's Mr. Altman, not Arjun. He claimed that the motivation behind Musk's bid was purely to slow down a competitor.
Musk bid for OpenAI? Yeah. How seriously are you taking it?
Not particularly.
Not particularly. Why do you think he's doing this?
To slow down a competitor.
And Stargate?
What
do you
about
have the funding?
I'm not the one who tweeted from the Insecure. I just actually try to show up and, build the thing.
Sam, just a quick one.
Endgame, Mr. Rome. What is the endgame
Just a
of
quick-
Elon Musk?
I don't know. I'm curious. I think it's to slow down a competitor and try to catch up with his thing, but I don't really know.
Yeah, but you know it well, right?
To the degree anybody does, yeah.
Well, there's another would-be investor in OpenAI, might be a more serious investor, and that is SoftBank. It's been talking about making an investment. The company posted a net loss of $2.4 billion in the third quarter, weighed down by declining valuations at its vision fund. The investment arm posted a net loss after 2 consecutive quarters of profit. The Japanese conglomerate has recently expanded its investments into AI, reporting talks to invest up to $40 billion into OpenAI, with part of that funding expected to be used for OpenAI's commitment to Stargate, according to. And let's get out to Arjun. He's at the Visionaries Unplugged in Paris. And as we talk about the Unplugged, it's SoftBank that is meant to be plugging in Stargate and OpenAI to financing. As we look at the numbers today, I think it suggests that there's going to be a lot of magic still in Masayoshi Son's ability to raise funds.
Yeah, one of the big questions I think around SoftBank and its involvement in Stargate, also given the fact there were a lot of questions of whether these funds were available, is given Masayoshi's more recent track record in terms of some of the bets he's made, etc., does he still have the ability to pull in the capital for investors for these mega projects? It seems at the moment like he still has that allure, he still has the sort of pull for some of those investors, and we'll see if that $500 billion figure is eventually met. But that's a big point, and he continues to invest in SoftBank. I think just want to go back to the Musk-led bid for the non-profit online about this. It's important to note that the bid is for the non-profit part, and what's happening right now at OpenAI is this company is trying to transition into almost a more traditional for-profit structure. And one of the debates happening now is how much is the non-profit part of OpenAI worth. Now, over the past few months, there have been numbers floated around somewhere around $30 billion to $60 billion. And there are questions now about whether Elon Musk's motivations around putting a bid in for the non-profit portion of that complicates matters about how OpenAI now goes forward to value what is the non-profit portion, and whether that messes that transition into a for-profit organization. That will of course have implications for investors like SoftBank and some of the others in there. But what Elon Musk certainly has done is thrown a bit of a spanner in the works here, even if his bid isn't necessarily serious.
Harder for SoftBank raising funds. We've got now, as you just see from this AI summit, it's a global environment. It's not just the Americans, it's the Chinese. He's very aggressively challenging the Americans at a lower cost. You've got Europe trying to get up to speed as well. Of course, there are other jurisdictions too that want AI. That means a pull of funds globally, not just going to one place in the United States. And Masayoshi-san has got to come up with a huge amount, $500 billion almost, in 4 years to fund the United States, as well as the Vision Fund and everything else he's got going on. That's a huge challenge, isn't it?
Yeah, you're absolutely right, Karen. I think SoftBank has had troubles with the Vision Fund too. There wasn't the same demand for investors as there was for the original Vision Fund. And again, I think it goes back to some of the big losses, the bad bets that SoftBank has made. The likes of WeWork, for example, is a prime example of that. And I think going forward, there's a lot of questions actually, how does SoftBank raise the money for this Stargate project and for some of these other big investments? Now, there's a number of question marks. Look, already SoftBank has been selling over the past couple of years its stake down in Alibaba. It, of course, still has the majority ownership of ARM. So several analysts are saying, well, if SoftBank's going to get anywhere near the funding it needs for these projects, it will inevitably have to sell down some of the stake in ARM. The problem with that is, if SoftBank signals to the market it's going to sell down some of its stake in ARM, that could negatively impact the share price of ARM, and therefore make SoftBank's ownership of that less valuable.
How do you break up the non-profit from the profit now?
That's a great question, Stephen. That's something I need to ask some lawyers about. because it's incredibly difficult. They're trying to turn into what's known in the US as a public benefit corporation. Structurally, I don't know how exactly that looks like and how that breakup happens. It's messy, it's complicated, there's valuations to be worked out on the non-profit side, which is ultimately the controlling entity of the current for-profit. It really is very complicated.
Should we get Microsoft on the line too, Arjun, just to weigh in on their 2 cents as to what cut they're still going to get out of the business thanks to its contract with the company. Arjun, thank you very much. And for more on Europe's AI ambition, you can check out Arjun's article on cnbc.com. A look at how futures are setting up minutes out from the open. Again, a lot of earnings out here in Europe this morning. We've also had some momentum. We've been at record levels on the STOXX 100. German stocks look to be doing more heavy lifting this morning, chasing fresh peaks, up about 0.25% pre-market.
CNBC. Live ambitiously.
Elevate your portfolio with JP Morgan's Equity Premium Income ETFs. Now more flavors, global equities, US equities, and technology stocks. Discover now. Search JP Morgan Income ETFs.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary. CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
NATO is, of course, about security. For the biggest military superpower in the world to lead the biggest military alliance in the world, I think it's in the vested interest of the United States. And on top of that, NATO is cheap for the United States.
I think it's more important that Ukraine can be involved in the peace talks from a strength position. So I'm also hoping and expecting the American and the US are still also contributing financially for the military support for Ukraine, because there have to be strength from at the front.
Our principles are very clear. No agreement on Ukraine without Ukraine, and no agreement on European security without Europe. And in this line, in this regard, of course, Spain is always committed to provide security for our allies and, of course, for our member states.
The greatest thing about Squawk Box is we talk to some of the brightest, some of the smartest, some of the most people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing hot time.
Squawk Box, weekdays. Before they talk to Wall Street, they talk to John Ford and Morgan Brad, closing bell overtime.
Welcome to Squawk Box. It's 8 a.m. here in London, 9 a.m. CET, and stock markets across Europe are opening up for trade. We start out the session at fresh records. The STOXX 600 climbed to a fresh peak yesterday thanks to big drive on the FTSE 100 and the German stock market, the DAX. Pre-market as we digest earnings, still a lot of tariff in the news in the backdrop, and of course technology, one of the big engines. We are chasing again upside the German stock market, again one of the big drivers, up about 0.1% early on the STOXX 600, Steve.
Yeah, it doesn't make anyone completely confused, because you think about it, the tariff noise has been ratcheted up to tariff action from the administration. There is no doubt about it. They look like they're intent on putting on these blanket tariffs on product, and with more to come, according to the president in the last 24 hours. And yet, look, markets are like, we didn't care. Is that complacency or cold, hard rationale of actually the effects of tariffs? Or is everyone already factored in? Would we be even higher if there wasn't the tariff threats out there as well? And it's actually confusing to a lot of the macro strategists, the ones who are trying to input geopolitics into their investment decisions, because at the moment, if you you were more circumspect, if you were holding off from a market weight position or even a long overweight position in the market, if you were holding off, you'd be wrong at the moment, because as Karen just pointed out, a lot of these markets are touching, or certainly very near, record levels as well. To the left of me, food and beverage. I wonder if that's Heineken, because I said to Dolph van den Brink earlier on, this feels like a pivotal set of numbers. Your shares have been for a long while. Strategy's been out there for 3-4 years now, this evergreen strategy. It's the best set of results I've seen from it as well, and as Karen quite rightly pointed out, within premiumization, you've got 0-0 trend, and it's a big trend, ladies and gentlemen, and it's affecting all of these companies. In fact, Diageo, which had a horrible update last week, was one of the few bright spots, was their 0-0 offering. So technology, premiumization, plus buybacks, I reckon that is why. I reckon it's a Heineken. I haven't seen a print. I'm just standing in front of the camera like you. I reckon that's why Heineken is trading higher. Household goods, well, that's pretty much a lot of luxury going on there as well. Retail doing well as well. So look at that. Consumer-facing stocks, food and beverage, household goods and retail, responding to hope that the sector and the cost increases and the margin decline, the worst of that is behind as well. So banks also putting on 0.4%. Shall we hope there's any sectors in negative territory? Oil and gas down 0.7%. Healthcare under a little bit of pressure as well, but that's about it. Okay, well, what does that mean for the major bourses? We'll have the FTSE 100 is trading flat. The Z DAX is 0.2% higher. Over in Italy, the FTSE MIB at 5% higher. I want to look at the Dutch exchange. I want to look at Amsterdam. Let's roll forward, Will. Let's do this together, everybody. The Dutch exchange trading flat. So I'm standing here. I haven't genuinely seen what Heineken's doing yet, and yet the Dutch market there is pointing flat. Am I wrong? Is it not the big catalyst? I genuinely haven't seen.
I can't see, but the reality is Heineken Holding Company is up close to 9%, so huge pop there, but it's ranked with FEB, InBev and Carlsberg, and we've heard from some of these other players in recent times. So what we're hearing from the company today, it was a very strong set of numbers that the investment, the marketing costs actually paid off in terms of revenue gains, and shrugging off some of the tariff impact on aluminium. I think there's been a real concern that may have some impact on the cost for some of these brewers, but the comments instrumental today. 3 brewers at the top, something to toast to at this early hour. Karen, let me try that next. We were talking yesterday about the company trying to draw a line in the sand on some of the weakness in the business, and the reality is we still could be in for more poor numbers in the first half, but a huge communication from the company that that's it, that they're resetting the business, the incoming creative director, they're trying to steer the company forward. That's really on the stock now for 2 days. To some of the big losers, what we're seeing, again, earnings having some bearing here. Ahold Delhaize losing steam. The retailer we spoke to this morning shedding more than 3% on the market thanks to numbers. We had Aker on here a moment ago, also in reaction to its numbers, Randstad down 4.8% in the recruitment business. So let's get up to speed with the Heineken numbers and what we're seeing. It's posted a net profit rise of 8.3% for the full year, ahead of analyst expectation and its own guidance. The Dutch saw beer volumes rise 1.6% on the year on an organic basis and announced a €1.5 billion buyback program over the next 2 years. Well, we spoke to the company this morning. The CEO, Dolph van den Brink, told CNBC he's optimistic the company is well insulated from trade tensions.
Beer industry is capital intensive and it's very local. So in over 70 countries we have local breweries with 80-90% local source, local consumers. So as such, it's an industry that's a bit less susceptible to disruption in international trade flows. On the tariffs, like joke internally, we have green bottles, we don't have crystal bottles. You know, we don't know more than you do. We keep following things attentively. It could have impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there. But again, we keep following it, but given our footprint and our local for local structure, for us the impact is at this moment assessed to be relatively manageable.
We've got a 0-0 on the stock at the moment. This halted currently. We saw the holding company on the move, but pre-market indications as the stock itself is slow to open up could bounce about 12 So that is what we're watching very closely for you around the repositioning here. AB InBev, you can see rivals Carlsberg, and they're all on the move at this early hour as investors are playing stocks in the basket this morning. Look to Siemens. Siemens Energy has reported a record order book in the first quarter amid strong demand for the energy equipment. Now, the company posted a net profit of 252 million euros. That was almost double expectations, stock losing some ground. And Deutsche Börse also on a today as we spoke to the company. It beat expectations in the fourth quarter, posting a 25% rise in net profit. However, the German exchange operator warned it could face headwinds this year amid low interest rates. Always fascinating to talk to the exchange on a day where you again have fresh records on the index, with the stock itself up 1.75%. The tone you're hearing from the company?
The company CEO outlook and also about Germany as such, and he's saying there are many challenges which are not yet tackled. So to him, I had to ask him as well how long he thinks that rally can continue while Germany as an economy is doing so poorly. The DAX, the general market, is doing so well. So obviously there's a mismatch between the two. And the reason for that is that international very interested in putting the money to play into German corporates. So I asked him how long will that last in his opinion, and what needs to change to actually put Germany on a more sustainable footing. Take a listen.
Many have seen that Europe has bottomed out from a valuation perspective. We have seen the share prices in Europe outperform relative to other indices. You have seen this for the year of 2024, albeit all the negative. And the underlying economic issues, be clear, those are significant. There's big change that is needed in Europe, but the capital markets have to play the role to play in that context. So that will continue to drive, in particular, our own business.
I'm sure you talk to international investors, international financial community. So what's the perception of Germany as an economy and also a place to do business?
It's certainly an enormous number of challenges that they feel are untackled at this point. That's what impetus the discussion that is going on around how can the German economy and the transformation momentum be really strength story for Europe and for Germany. But many of the German corporates are doing actually pretty well. You know, that is a big split between what is the reality of very agile companies that have adapted to many of the geopolitical changes, while on the other side, the underlying sort of economy environment in Germany itself.
So there are lots of hopes as well from Deutsche Börse pinned on the new coming government that they improve capital markets conditions, so that it's more attractive for investors to put their money into play here as well in the German or European market. And that also would mean there's more IPOs coming here to Frankfurt as a place to actually list the companies. What we're currently seeing is that some companies actually biotech companies are traditionally always going to the States because they're larger investor base. But as well, Linde was like, I think, the most prominent and biggest defection, which of course, as you know, went to London. So that, of course, in the future should be prevented, and that is what the mission of the new CEO of Deutsche Börse, Stefan Leithner, is quite adamant about the fact that things have to improve.
Annette, thank you very much for that. I'm just going to take the audience back to Heineken stock, which is now open. It was halted, and you can see a big spike in the share price, up about 12% as it's seeing a response to the earnings today that some are describing as excellent. The bounce you're seeing, don't forget, it counteract what has been a deep dive in the stock. It has been around one of its lowest levels in about a decade at the back end of last year and into this year, very much on a slide. So the earnings today really resetting expectations on the stock.
Yeah, people love 0-0s, as you pointed out when you spoke to him. Chanel is co-head of multi-asset at Pictet Asset Management. Can you talk individual stocks?
Not today.
Don't worry about it then. Don't worry about it. But I mean, I will talk around that. And Heineken's a great example of a company that's been bombed out. Just put that chart up again if you would. Thanks, Will. A stock that's been bombed out, but actually the potential, once it turns in some solid, I mean, they were good numbers. They weren't like spectacular, but they were good, solid numbers as well. Just shows you the kind of outside reaction we're getting from some of these stocks.
Yeah, absolutely. Negative
negative sentiment around some of these areas have been pretty dire. I mean, even if you think about the brewer segment, you know, the trend in consumption has been well flagged. Now, companies can do things to adjust for that. And as we've heard, that these strategies are starting to work, and coming in with really depressed earnings expectations, we see some positive surprise, and we see that through Europe.
It's amazing, isn't it? And I'll talk around this subject a bit, but, you know, flavours of the day in the booze sector at the moment is premiumisation, which has been around for quite a while, and the late, great Ivan Menezes used to speak to us a lot about that, God bless his soul, and 0.0. But before that, it was, we're going to buy all these craft brands, and we're going to do, and then we're going to have to consolidate. So actually, this is a sector which it seems quite stable and staple in terms of what it's offering. But my goodness me, the trends have changed aggressively within that. You've got to stay on top of that, haven't you?
Absolutely. I think this is a market for stock pickers and people that really understand what these business strategies are. And we've seen that dispersion in performance across, but not just sectors and regions, but also at stock level.
Well, yeah, just, I mean, again, you're not going to talk about stocks, but Diageo last week, Howler, Heineken this week, similar kind of stuff. Excellent.
But to me, don't forget the brewer conversation. It looks so much more challenging than the mixed drinks business. But I wonder whether that's now swapped because of the 0.0. You've got zero alcohol that's coming quickly into the beer market, but not necessarily elsewhere into the broader alcohol space.
Yeah, absolutely. These kind of companies can adapt and have adapted to the changing tastes. And I think, again, that means that for analysts who are looking at these stocks, they can look at the being put in place and say, well, actually, we can differentiate within the sector, and that differentiating is a source of alpha.
Talk to us about sentiment, because yesterday, even in carrying stock, it felt as though investors took a leap of faith that they've got worse numbers yet to come, but because there was an update from management saying it wasn't good enough, people piled back into the stock. What are you seeing in terms of sentiment in Europe, where investors are willing to take a leap of faith on earnings at this point?
Well, valuations are clearly very low now, and so those expectations have corrected so much that any chance a credible earnings story can be put together is being rewarded by the market. We see that not just in Europe, but even in Asia, where we see any diffusion of, let's say, the AI technology coming in at lower prices for more companies means that even Asian stocks are starting to perform very well. So what we are seeing more globally is this dispersion of returns, this diversification of returns this year, which is really encouraging.
What do you see in terms of further momentum going towards some of the Asian stocks? Because I think there was a bull market described in the past 24 hours for those big tech names in China, up about 20-odd%. And that seems minuscule if you look at the magnificent performance in recent years. Are we still early doors in terms of international investors allocating to Chinese tech?
I think it's important to know that the fundamentals remain in some of these areas like in Asia, but we can see that the sentiment is so low, positioning is so low, and any good news, any positive news is that China is not so far behind the US in terms of its AI adoption, and therefore multiples can rise.
Talking about gold, record levels. Karen and I had mild disagreement about when it rallies and why it rallies compared with stock markets earlier. Why don't you tell us what you think?
Well, it's one of our biggest positions in portfolios for clients.
What does that mean? I mean, because it's normally just a smaller part of the hedge position. How big?
It's the maximum we've been in several years. So we're talking about close on 10% for some clients.
Wow. Why?
And this is an asset we think is a currency in effect. Where we see the machinations of trade tariffs, geopolitics, it performs really well relative to other currencies. We think it is a strong ballast for a portfolio, particularly today when we have this volatility going on in markets.
So when would you consider cashing in that position? What would be the catalyst for that?
I think when we see some depression in how markets are treating this geopolitical volatility, or if we get much better situation in terms of fiscal discipline around the world. I think one of the issues we see around the world is the fiscal issue is getting worse.
Shanil, we've got to go. Thanks for joining us with thoughts on the market. Shanil Aramji with us, co-head of multi-asset at Pictet Management. Ahold Delhaize posted weaker than expected net profit of €380 million in the fourth quarter. Sales for the period came in marginally ahead of analysts' expectations, with the company saying it has seen volumes recover in the US. CEO Franz Muller told CNBC
we have a food business in the US, and that is a very local business. So the majority of our merchandise we source locally. But what we will see that if you have fruit and vegetables coming from Mexico or paper products from Canada, that it might have some inflationary effect. But the majority of the products are sourced locally. So that's very different than if you would sell general merchandise. 95% of our total products are food-related products.
ABN AMRO shares are at a two-year high despite posting a 27% drop in fourth quarter profit. That represented a modest beat and was supported by rising fees. For the year ahead, the Dutch bank says it sees net interest income falling as much as $300 million. The stock, though, trading higher today as the CFO, Ferdinand van der told us he now sees the year ahead unfolding in a certain fashion and that the impact that tariffs could have on inflation and monetary policy in Europe.
What we do expect from the trade tariffs that in the second order might have a more deflationary impact on Europe. So that will mean that potential of faster interest rate cuts by the ECB is clearly there. And that is also, if you look at our guidance we provide for an interest income, the bottom end of that is related to the forward curve, which indicates that we will see some more rate cuts by the ECB.
Look no further than the UK housing sector, really volatile. Barratt Redrow, one of the big players in there, has surged to the end of the forecasts. Amid solid bookings this year, the British home builder announced a £100 million buyback, with the CEO David Thomas highlighting a recovery in demand amid stabilising political and lending environments. Wow. Elsewhere, TeamViewer's full-year revenue came in ahead of expectations, up 9% a year. The company also outlined midterm targets following the completion of its acquisition of IT firm 1E, forecasting revenue between 0.3 and 1.06 billion euros for 2028 and an adjusted EBITDA margin of up to 45%. Coming up on the show, we're going to delve into M&D investments, big bet and private markets. Delighted to say the CEO, Joseph Pinto, will join Karen and myself. That's coming up next.
Launched the branding campaign for the country, and that is Love the Philippines. Love the Philippines is anchored on 4 pillars. First, to attract the world's attention to our award-winning islands and emerging destinations. Second, to put focus on our immense diversity, being one only 18 megabiodiverse countries in the world. We are also focused through Love the Philippines on our festivals, our cultures, our heritage and history. Through this global marketing campaign for Love the Philippines, we are able to penetrate markets from our top source markets to our opportunity markets.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them a pair of questions in which their answers are important. I could not imagine covering anything else.
Frank Holland. Worldwide Exchange, CNBC.
Markets have enjoyed strong growth in recent years, but cautions that fundraising has become more difficult with mid-sized and small players bearing the burden. Joseph Pinto is the CEO of M&G Investments, and it's lovely to see you, Joseph. So thank you very much indeed for joining Karen and myself. Before we start, we should remind viewers, you can't talk numbers because you're in the closed period as well. But you have made a recent investment in a leading private credit business. That's quite a pivot for M&G. Just talk to us why you're doing that.
Well, I would not say it's a pivot. We already manage 73 billion pounds of assets in private markets, of more than 215 billion pounds in all asset classes. Within private markets, we already manage 19 billion pounds in private credit. We do have some few, what we call product gaps, and effectively the acquisition will help to close the gap, invest more internationally, companies that we bought in Sweden, and become even more international than we've been so far. So it is part of the growth plan we've had.
Why are private credit markets more exciting than public credit markets?
I think they are both exciting, I have to say. We see more and more demand into private markets, into private credit in particular. When you look at the role of banks, role of lendings from banks, US versus Europe, in US, probably 80% of the market is disintermediated, played by asset managers, private credit players. 20% is loans done by banks. In Europe, we are still at the opposite ratio, 35% by intermediated, 65% by banks. The potential to grow private credit is just massive.
Are you, like the Andrew Orchells of this world, trying to get ahead of changes in regulation, changes in ways that the market raises money? Because actually Europe has talked very good about getting more innovative in the way that credit is raised and actually creating more opportunities.
Well, we have a whole spread of private credit products, I have to say, from traditional private credit, sponsored. Now we are entering what we call the unsponsored ones, where we lend money to entrepreneurs. That's the capital partner we are buying, and also structured credit and other strategies. That whole breadth is really much what the clients want ultimately. Yes, it's about innovation ultimately.
But is it about the changes that are coming as well?
Absolutely.
Yeah.
I want to talk to you about the huge demands for AI funding. It feels as though the private markets are doing a lot of heavy lifting here. And there's a much smaller share of private capital in Europe. Does that hamper the funding of AI in Europe?
No, not really. I think Europe will play its own way. There's a lot of debates these days between US, China, Europe. I think it has to find its own way to finance it. France announced massive investments into it. I do believe that the market will play onto it as well. We have to effectively support technology at large, AI in particular, in Europe. I'm quite positive on it.
There's a little bit of soul searching as to how funding models should look for AI in future. I think there's been all sorts of creative solutions about putting chips up as collateral. There's now stuck thanks to DeepSeek. A very interesting narrative, I think, that the collateral might be worth very little if the investment requirements should be a lot lower than what they have been. How do you think about how this funding model could be upended by DeepSeek?
Well, it's an excellent question. It's part of the way we do it in private credit space. You can do asset-backed financing, which is effectively what you are referring to, and it's up to us to be as creative as possible and provide those solutions to end investors. Yes, all of this is being looked at.
So when we talk about what just happened in Paris in the last 48 hours, huge initiatives from Macron trying to unlock capital markets to fund the rollout of infrastructure, how big a role do you think credit plays versus private equity in this space?
I think they will all play a role. You need private equity, sure. You need equity, but you also need private debt behind to support those initiatives. They will play hand in hand, in my view, to support effectively that growth.
Joseph, meteoric changes needed in the returns from a lot of active managers out there as well. You are looking at diversified strategies across the board, whether it be real estate funds, whether it be ventures in ETFs, which has been talked about with M&G as well, and of course this private credit market investment in PCP as well. Is your company changing dramatically, or is it by and large going to stick to the same practices it's always done, and these are just side bets?
We're rather on the second than the first. We are an active manager. We are very strong at it. We deliver superior investment performance to clients. It's up to us to keep demonstrating it in the future, and we want to stick to it. That's why the private credit acquisition we've done recently to support that one. Both in public and private market, we want to provide superior returns to clients. That's who we are.
Joseph, there are lots of moving pieces internationally, tariffs having impact on uncertainty around what interest rates are going to do from here. And of course, if we feels like every time interest rates come down a little bit, animal spirits get unlocked, and then suddenly everything gets moving in credit markets again. Are you worried that tariffs, the interest rate expectations could towards a little bit of a tail to 2025?
There are effectively tailwinds in the market. Now, many of those events have been priced. The good and the bad news have been priced into the bond market in particular. What's good for us is, as we are active managers, when we see volatility out there, that's exactly the time where we can shine for our clients.
Interesting. Very dynamic strategy there. Joseph, thank you so much for joining us.
Thank you.
Joseph Pinto with our CEO of M&G Investments. Coming up on the show, we're speaking to the Austrian National Governor and Governing Council member Robert Holzmann as policymakers grapple with growth concerns and the impact of trade restrictions. That is the first on CNBC Conversation next.
CNBC. Live ambitiously.
In a world brilliant, we've been navigating change for 125 years, all looking forward, anticipating risk, and trusted to manage over $1 trillion in assets worldwide, solving for the needs of investors today and tomorrow. That's the power of Nuveen.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities
I thought that was the end of it.
to the C-suite.
I started on the factory floor, and here I am 35 years later.
The constant a lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation, CNBC.
Live from the New York Stock Exchange, Halftime Report, CNBC.
I started investing a little money from my dad, and I got bitten by the bug. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it's the greatest job in the world.
A warm welcome to Squawk Box with Karen Sher, myself, Steve Dedrick, and these headlines. Heineken, well, they looked good, didn't they? And we were right. Good. Look at this, 11.2% higher as the group has one of its best day in more than 3 years, and 3.5 decades, actually, on the back of better than earnings. The CEO, Dolph van den Brink, tells Karen and myself he's optimistic on the impact of tariffs.
We keep following things attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged. We'll see an impact there.
Siemens Energy's record order book fails to impress the market with shares in the red despite a mammoth profit bid. But ladies and gentlemen, look where they come. Look where they've come from. 290% higher 1 year. SoftBank posts a third quarter loss of nearly $2.5 billion, massively underperforming expectations. Valuations at its division fund slide. Oh, and more bad news for Rachel Reeves, UK Chancellor of the Exchequer, ahead of next month's spring statement. The country's budget watchdog reportedly telling her she's run out of fiscal headroom in a first draft forecast.
And let's take a look at European markets 30 minutes into the session. The DAX still providing some heavy lifting, that ammunition coming through from the German market, taking a fresh record, and the stock show 600 inching ahead another 0.1%. Fresh record yesterday as well. So some of these markets again seeing further momentum. The FTSE not quite doing it in terms of more gains today. It was at a fresh record yesterday, but very cautious today. In terms of the sectors, a lot of earnings across the board, but it's really the brewers standing out today thanks to Heineken, which is delivered a big set of numbers thanks to zero alcohol beer. Who would have thought we would have been having that conversation if we cast our eyes forward? And it's other brewers also getting into the mix now, the likes of Carlsberg, AB InBev. They're all on the front foot, driving the sector forward. Real estate, Barrett Redrow doing some, providing some of those gains today, and you can see almost 9/10 up for the sector as stock reports today. Resources, household goods, the gainers carrying the Onoguchi, again seeing further gains today too. To some of the losers, where we're seeing a little bit of red across the board, trapping some of the fortunes of broader benchmark. It's oil and gas, energy giving back 0.8%, and healthcare a little bit underwhelming. That is one sector settling in the red this morning. Steve.
Right, I think we get the message now. Rachel Reeves has run out of fiscal headroom. Now it's the Office of Budget Responsibility. The OBR has reportedly followed the Bank of England in upgrading its growth outlook for the British economy. We kind of knew this was going to happen, but it was reporting from the FT and Bloomberg, which says a first draft forecast delivered to the Treasury last week showed UK Chancellor Rachel Reeves incurring a small deficit. This comes after poor economic data and January's gilt market turmoil apparently helped wipe out Reeves's near £10 billion fiscal margin. Reeves, who has ruled out further tax hikes, says her fiscal rules are ironclad, suggesting spending cuts on the horizon in next month's spring statement. The UK broke last month's all-time record for gilt orders, though, on Tuesday. This is big. Sales of £13 billion worth of 10-year gilt. They were 10 times plus oversubscribed. Everyone wants a bit of 4.5% at the moment, don't they? They're worried about the UK economy as investors try to look in those elevated yields. The OBR will deliver its next economic and fiscal outlook on March 26th.
ECB Executive Isabel Schnabel has warned that interest rate cuts alone cannot solve the, quote, structural crisis facing the European economy. Speaking at the German Institute for Employment Research, Schnabel said it should consider its trade-focused growth model in the face of geopolitical fragmentation. I'm pleased to say Robert Holzmann joins us now, Governor of Austrian National Bank and also ECB governing. But thank you so much for joining us, Governor. Let me get into what we saw recently from your ECB statement that the disinflationary process is well on track. Can I ask you, now that that train is in motion, whether it speeds up towards a disinflationary process at a higher speed thanks to tariffs that we're hearing about on steel, aluminium, but also retaliation prospects from the Europeans?
Well, my take is that this event will speed up the speed to fast disintegration, because the models I know and we use and what I hear is that an increase in trade frictions which uses growth, that's true, but on the other hand it also increases inflation, so we will have to be more cautious.
Fascinating comments, Governor. Can you just talk to us about the pathway then that you see for interest rates? Because the market is on a page that we're going to have much steeper rate cuts from the ECB than what we're going to have from the US Federal Reserve that spelled it overnight, that we're just not going to be in any race to cut rates. What does that mean for the ECB? Are there consequences to that pathway?
That the US remains higher is clear because they have a higher growth rate, they have a higher natural rate of interest, and the result of it, they have to decrease the rates. On the contrary, given the inflationary path there, they may have even to increase it if things happen. In Europe, however, we have also the threat of high inflation given the changes on tariffs, and the result of it, my take is we have to be very cautious. Because reducing rates in order to support growth is not the way to go. This is what you also framed when you called national level. She also said it's not the way to support restructuring with lower rates.
How quickly, though, do you think we need to get to neutral, even if you're not providing accommodation, just getting back to the neutral rate? Because conversation I had with Madame Lagarde in recent weeks that 1.75% would be the low end of neutral. Is that a prospect you see rates getting too soon?
As we know, the range of relative rates neutral rate wages quarter. In some cases, it goes up to 3%, not only to 2.25, which was the restriction Madame Lagarde put there. And if we have the 3, which is part of the main range, 1.75 to 3%, then how to say we have a different discussion there, which means, yes, we want to come close to the neutral rate. Where it exactly is, we don't know. And for this reason, we use other information as well in order to get it. What we currently have is some indication in what direction it moves, but it's not the rate on which we base alone our decision.
Hi, Robert. Really nice to see you again, sir. What happened to the Robert Holtzman I used to know, who was quite a hawk and who was very concerned about all those rate cuts as well? Of all those factors, that it was over a year ago, Robert, we sat outside, we were chatting Davos as well. Of all those factors that led to you being more hawkish, have they dissipated now?
Have dissipated. On the contrary, with the arrival of this threat of tariffs, they emerged there. Before there was something looked like moving slowly towards lower rates. What we have now is the threat of higher inflation rates, and for this reason, we have to be careful.
Yeah, we have to be careful. And also, Robert, there's even a chance that Europe might do two things which seem extraordinary to all three of us. One, the Germans might adapt the Schuldenbremse to actually start spending some more money. And two, we may well, under this commission, get some form of regulatory reform according to the what Letta and Draghi have been asking for. We might actually have rules that are fit for purpose in the 21st century. All of that's very inflation, isn't it?
Definitely yes, but I don't think it will happen tomorrow because this will take time to implement. But of course, if the more credible an announcement of a reform waiver, the earlier it may create effects. This afternoon, I will fly out to Brussels with the Commission in order to get more information where things are. For the time being, I have seen a number of announcements, but I'm not aware and know where the work actually is.
Yeah, Robert, that's Europe all over, and you know better than I do. We see a lot of announcements. We don't necessarily see action under the hood. We don't see engine purring. Do you think it's different this time?
Well, I hope it is different because we don't have too much else like that. And from what I heard, we had recently also Madame von der Leyen for a dinner where we discussed issues there. She seems to be determined, but she has a new group of people around her. Many of the commissioners are new, and it takes some time to get the whole team together. I do hope, and I hope I get this impression over the next 2 days, that Europe had understood the message, so they're really beefing up. If this is the case, then we can hope something. If it is not the case, then we may be in the same situation as we are now.
Governor, I know that the ECB has been very focused on wages. That's still been a bit of a thorn in the side because the negotiations have been somewhat lagging the CPI levels. And if I look at the most recent ECB wage tracker, a peak of 5.4% seen for last year, seen falling to 3.2% this year. Is that an empty promise then? If you're thinking that inflation is going to be a threat this year thanks to tariffs, does that mean fading negotiations around CPI is just an empty promise? In fact, we're going to have more heat in wage negotiations.
I think on the wage side, we are moving towards more rationality. This have at least the latest figures on newly negotiated wages shown. So the wage part did to decrease, and it seems to come at a level of about 3%, which is consistent with 1% offer productivity and 2% inflation rate. Of course, the question is whether we will be able to have this 2% of productivity in order to allow this inflation rate to come true.
No, we've had a lot of discussions with Governing Council members like yourself about the prospect of 50 basis point rate reduction, that perhaps the ECB is behind the curve. I know you're sounding very hawkish, but not all members see the situation that way. They're very concerned about the growth profile. If you're wrong, and if inflation doesn't materialize and growth is a greater concern, would you be in favor of 50 basis point reduction this year?
I think this would not be a good decision because our job is to deal with inflation. And result of it, reducing the interest rate in order to initiate a higher growth is not the way how that should work and how they're working.
Robert, we look at a lot of political risk over the last, 12 months, say, and in Germany there's still upcoming, in France, concern about the power of Monsieur Macron, of course United Kingdom, and certainly, as we've alluded to, on the other side of the Atlantic. Closer to home, though, you've got a very interesting government formation going on as well, with the Freedom Party and the Conservative Party trying to work out who would get what ministry as well. Do you feel that the political threats are still clear and present in Europe alone, let alone what's going on in Ukraine, let alone what's going on in the United States?
No, we definitely have a high level of political uncertainty, given after the election, before the German election, in front of, as you mentioned it, France. So we have much more uncertainty politically we had in the past. And the hopes are that after the German election, also with the formation of our state government, which is still open, we have more certainty. And in France, we've seen so far Bayrou as acting Prime Minister was able to somewhat tame some of the diverse effects. So I remain optimistic, but I'm not so sure whether it is a very rational position.
But one thing that seems very clear, Robert, that the centre is holding, certainly it did in the European parliamentary elections last year, but the right has a degree of ascendancy across Europe as well. How concerned are you about the adherence to any form of fiscal discipline that we are getting from some of these rightist parties who have a very frosty relationship, of course, with Brussels as well?
Well, my understanding is you've taken out the Austrian discussions. One of the first things what the new potential coalition did was decided in 3 days on a path in order to bring in Austria the fiscal path back to the ECB norms and the EU norms. So this was one example that a coalition of middle and middle political parties can also be very much stability oriented.
Governor, just finally, can I just turn the conversation to growth before we let you go? Because as we caught up on the eve of the election stateside in DC last year, you thought a soft landing was guaranteed for Europe. However, now we've got to trade tariffs, and of course we don't know what threat looks like exactly at this point. Is a soft landing still guaranteed under Trump policies?
The second is inflation, and on both sides they move in the wrong direction, even as you introduce tariffs there. But the question is, the tariffs have not been decided. We don't know how comprehensive they are, but very likely is, yes, it will reduce our smooth path towards normality. How much disruption happens, this is still to be seen.
Robert, we're speaking to you. Really nice to see you from one of my favourite cities in Europe as well, Vienna. Lovely to see you, sir. Thanks for joining Karen and myself. Robert Holzmann, Governor of the Austrian National Bank. It also says here, Österreich National Bank as well, so, well, badly. The American labour market is broadly in balance and not a source of significant inflationary pressures. This according to the Fed Chair, Jay Powell, who testified before the Senate Banking Committee Tuesday. Powell told lawmakers the Fed doesn't need to be in a hurry to lower rates again after the FOMC cut it to each of its last 3 policy meetings. Powell walked a fine line on the impact of policy coming out of the new Trump White House, including tariffs.
The standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Coming up on the show, SoftBank books a net loss in the third quarter as valuation at its vision fund slide. We'll have more on this after the break.
those who see the correlation between predictability and probability. Those who manage risk by anticipating each movement. Flawless execution, timing, and accuracy. Identify the goal, match power with precision, reach new heights. CME Group, where risk meets opportunity.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CMC, because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side, report on the news. I love bringing transparency to complicated topics. I think it's so important for us to deliver the right numbers to our audience so they can make better investment decisions. San Francisco was built on ambition. Believe that one can disrupt any industry and change the world.
Before they talk to Wall Street, they talk to John Ford and Morgan Brandt. Closing bell overtime.
President Trump has ordered federal agencies to cooperate with Elon Musk's Department of Government. Look, can you see under the strap? Can I view? Oh, they can't see it. Oh, that's just such great pictures underneath. Anyway, we'll cooperate with Elon Musk's Department of Government Efficiency to find ways to shrink the size of the federal labour force through identifying workers who can be laid off and functions that could be eliminated. The executive order also limits federal recruitment once Trump hiring freeze ends, with agencies allowed to hire only one employee for every 4 who depart. But surely it matters, excuse my ignorance, but let's say 4 anchors left. And there was, I don't know, I've got to be careful here with the team. But what I'm saying is, it depends what those workers are doing, doesn't it? It can't just be, you lose, I don't know, say a £250,000 worker or 4 £250,000 workers and you can only replace them with a $50,000 worker or vice versa. It really matters what they do. It seems a bit crude. Anyway, law enforcement, national security and immigration enforcement roles are exempt from the curbs. Appearing alongside Musk, and this is what I wanted to show you, but I don't think I can see you in the pictures, and his son, a really cute little boy, Musk's son, in the Oval Office. President Trump made a series of claims that without offering any direct evidence, assertions that CNBC we just aren't able to verify. Let's listen to him.
Billions and billions of dollars in waste, fraud, and abuse, and I think it's very important, and that's one of the reasons I got elected. I said we're going to do that. Nobody had any idea it was that corrupt, and it seems hard to believe that judges want to try and stop us from looking for corruption, especially when we found hundreds of millions of dollars worth, much more than that, in just a short period of time. We want to weed out the corruption.
Going to say it again, just we haven't as a channel been able to verify that there are hundreds of millions and billions of corrupt practices going on in the federal government. It would be very interesting to see the evidence, I'm sure. Elon Musk used the signing to hit back at Quick project.
The people voted for major government reform. There should be no doubt about that. That was on the campaign. The president spoke about that at every rally. The people voted for major government reform, and that's what people are going to get. They're going to get what they voted for.
I see the same thing. There's a little doll in the corner.
I'm asked the direct something which I should know. The bit below the strap here, is that going out on telly? Oh, it's not. Oh, the viewers can see it. Because what's going on is you've got Musk, you've got Trump sitting at the desk, and then you've got the absolute cutest kid who's one of Elon Musk's sons.
There was a doll there, wasn't there?
Are you having a laugh? That's his kid.
That's a kid.
That's his son.
Dog.
He's so cute.
Looks like a dog.
But on the video that we're showing, he's
the bottom left-hand corner.
Bottom left-hand corner. That's a kid.
I thought that was a dog.
What kind of dog do you think would be in the Oval Office?
Oh, I don't know.
Anyway, he's really cute.
Well, we're not playing. Has told staff in an internal memo seen by CNBC that the company has not received an official offer from Elon Musk for the purchase of its non-profit arm. It comes after news broke that a consortium led by Musk is vying to buy control of OpenAI for just under $100 billion. In the memo, Altman says OpenAI is structured so that no single individual can take control of the company, adding that Musk's offer was aimed at weakening it. Arjun spoke to Altman at the AI Action Summit in Paris, where he claimed the motivation behind Musk's bid was purely to slow down a competitor.
Bid for OpenAI?
Yeah.
How seriously are you taking it?
Not particularly.
Not particularly. Why do you think he's doing this?
To slow down a competitor.
And Stargate?
What
do you
about
have
it?
funding?
I'm not the one who did funding secured. I had to show up and build it.
Sam, just a quick one.
What is the end game, Mr. Roman? What is the end game of Elon Musk?
I don't know. I'm curious. Yeah. I think it's to slow down a competitor and try to catch up with his thing, but I don't really know.
Yeah, but you know it well, right?
To the degree anybody does, yeah.
The SoftBank Group posted a net loss of $2.4 billion in the third quarter as valuations at the Vision Fund slid. The investment arm posted a net loss after 2 consecutive quarters of profit. Big links to the story just before. How is SoftBank going to fund any investment? And only in over 4 years. What has been discussed in the media is project financing, something similar to what you've seen in the oil industry over the years. We fund the business through cash flows, and it does require a little bit of equity, a big portion of debt as well. So SoftBank's CFO Goto is saying we plan to raise the funding for the Stargate project mainly through project finance. The total size of investment for the project is large, but the amount we put up to equity is limited. And this was something we were just discussing with M&G CEO about whether some of the collateral that's been pledged, GPUs, chips, whether that will be used in future, because don't get the value of those chips in future. So Arjun, we're getting a few pieces of the jigsaw puzzle here around how these massive projects are going to be funded.
Yeah, and SoftBank really trying to play down fears around how exactly it's going to fund the project, because coming into this there was a lot of talk about the fact that SoftBank still has very high net debt levels, perhaps raising new debt financing may not be something that will be seen as favorably for its shareholders. On top of that, it still has a very large stake in ARM, so there were talk about whether actually SoftBank might have to sell down some of that ARM stake, and if it signals to the market it's going to do that, that can actually potentially reduce the share price of ARM and reduce the value of SoftBank. So a lot of different things here. Clearly, just looking at the commentary from the CFO on the press conference, he is trying to play down some of the fears and saying that actually, as you mentioned, it will consist of a series of projects. Bank will contribute a bit of equity to that and lead the financing for the remainder. I think the question you asked previously, Karen, was a good one. Does SoftBank still have the ability to raise money? Does it have enough investment and big backers that are confident in its ability to back these projects? And I think that's still a question mark after some of Masayoshi's track record on bad bets, and that's, I think, going to be a key question going forward for the remainder of these Stargate projects.
Arjun, there's also a line here around SoftBank and OpenAI, the investment that Masayoshi-san is meant to make into the ChatGPT company, saying, this is from Goto, saying, I was surprised to see the news that Elon Musk offered to buy OpenAI, but how to respond is up to OpenAI. So a lot of politics here.
Yeah, for the non-profit portion of OpenAI, but the problem now is OpenAI signaled that it wants to turn into a for-profit structure, and the question is, has Elon Musk thrown a banner in the works about how to value the non-profit part of OpenAI, which is ultimately the controlling interest in the for-profit company? I think that's what's happened. Sam Altman says, well, the motivation is around trying to slow down a competitor, but potentially there's other motivations at play here as well.
Arjun, thank you very much. Someone needs to create a dinner party and get all these names together, from Musk to Masayoshi-san to Altman, to see what happens. I mean,
it's a party from hell, isn't it? We've got some PI later on, ladies and gentlemen. Absolutely pivotal data. That is due at 8:30 Eastern Time. Have a lovely day.
and a chartered global private bank where your life's work lives. Squawk on the Street, CNBC.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. Ambition starting out is to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You learn a lot here at CNBC. It's also a lot of fun.
AI is one such example that Kevin sees integral to his work.
These are the data we have collected today. What I'm supposed to do is to ensure the clarity of images and then to make sure that between the first image and of course the second image. Once this is done, we will go into a software where we make use of AI to pick up defects. The traditional method for post-processing wise, they are supposed to screen through individual images and to pick up defects.
So no AI involved?
No AI.
So just eye power?
You can imagine the amount of effort and time being wasted. We just have to ensure we touch on the privacy issue, safety aspect, the last one is practicality. So these three main points will kind of help to educate the users.
The climate crisis is a gun to our head, so we better get our act together.
We need those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that comes with generations. It's very important we pass on living soil for future generations.
There is hope for the future, but
only on CNBC.
Good morning and welcome to Street Signs. I'm Juliana Tattlebaum and these are your headlines. Heineken raises a glass for drinks makers in early European trade, lining up its best day in more than 2.5 decades on the back of better than expected earnings. CEO Noel Vandenbrink says he's optimistic on the impact of tariffs.
We keep following things attentively. It would have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there.
ECB Governing Council member Robert Holtzman tells CNBC U.S. tariffs against Europe will move both inflation and growth in the wrong directions, but rules out accelerating the pace of rate cuts in response.
This would not be a good decision because our job is to deal with inflation, not with growth. And the result of it, reducing the interest rate in order to initiate a higher growth is not the way how we actually work.
U.S. President Donald Trump orders government agencies to work for the project.
The people voted for major government reform, and that's what people are going to get. They're going to get what they voted for.
And And SoftBank posts a third quarter loss of nearly $2.5 billion, massively underperforming expectations as valuations at its Vision Fund slide. A very good morning to you and welcome to the program. Let's kick off with a look at European markets. We're about an hour into the trading session and we are in greens. Let's take 100, the main benchmark, up 0.2%, adding to yesterday's advance. We saw a similar gain yesterday for the main benchmark, hitting another intraday high in the session, a record intraday high. So European stocks continuing to move from strength to strength. Now, in terms of the markets today, the forces, this is the split, what we're looking at in Europe. You've got the up about 3%, similar gains for the CAC 40 over in France. FTSE MIB up 0.4%, and the FTSE 100 here in the UK lagging somewhat, but still in the green. We are going to now take a look at the sectors. The sectors leading the gains this morning. We've got food and bev up 1.5%, and today it is all about Heineken. We're going to give you all the detail in just a moment, but that beverage maker bringing optimism to the broader sector, and we're seeing a lift across all of the beverage names. Real estate also doing well, up 1%. Basic resources rebounding after suffering some losses of the tariff concerns. That sector up 0.8%, and chemicals also doing well this morning, up about 0.8%. On the downside, the laggards in Europe. We've got oil and gas down at 0.7%, healthcare and industrials, but clearly it is a morning that is tilted to the upside, so an overall strong start to trade. Now let's dive into Heineken, because this has got a ton of attention this morning. Shares were actually halted in early trade after the company posted a net profit rise of 8.3% for the full year ahead. That was well ahead of analysts' expectations and its own guidance. The Dutch brewer saw beer volumes rise 1.6% on the year on an organic basis and announced a 1.5 billion euro buyback program over the next 2 years. You can see shares up nearly 12%. But look at where we have come from. The stock is down nearly 20% over the last year, so it is really a strong bounce, and I would assume there is a bit of short covering taking place this morning. That's part of where we're seeing a jump in the stock. Now, we had a chance to speak to Dolf van den Brink, CEO of Heineken, and he told us that he's optimistic the company is well insulated from trade tensions.
Beer industry is capital intensive and is very local. So in over 70 countries, we have local breweries with 80-90% local sourcing, operated by local people, selling to local consumers. So as such, it's an industry that's a bit less susceptible to disruption in international trade flows. On the tariffs, we like it internally. We have green bottles. We don't have crystal bottles. You know, we don't know more than you do. Keep following attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're almost fully hedged, so we don't see an impact there. But again, we keep following it. Given our footprint and our local structure, for us the impact is at this moment assessed to be relatively manageable.
Now let's talk about what's happening in the consumer space with John Cox, the head of European Consumer Equities at Kepler Cheuvreux. John, thanks for joining us this morning. I've got so much I want to get through today around the consumer space, but let me just kick off with the story of the morning, and that's Heineken, the company delivering a strong set of numbers relative to what the market was expecting. It seems to me there's a lot of short covering taking place in this stock, but we are seeing a rally across the beverage space today. What's been particularly encouraging about what we heard?
Yeah, I think there's different things going on, but certainly the consumer space has been heavily shorted over the last couple of years. A lot of turmoil from what has truly been very long-term compounders, which have suddenly struggled, and Heineken's amongst those. All the brewers, all the food companies, all of the sort of home and personal care companies as well. And I think what you've seen over the last couple of sessions today, Coca-Cola yesterday, McDonald's in the last week or so, maybe the corner has turned after what has been a pretty dramatic couple of years in the consumer space. Now, for Heineken specifically, obviously very strong cash flow generation, although the buyback was pretty much expected, but certainly the organic revenue growth of 5% ahead of expectations is a positive. and hopefully a sign of things to come as we move into 2025, not just with the brewers, but also across the consumer staples space.
Well, John, that's exactly where I wanted to go next, around volume expectations for the broader staples space. We've got Nestle, we've got Unilever, and I think one of the key questions, speaking to investors, is around volume growth and what we're going to see. So what is your take on where it stands now in terms of that organic growth for the staples?
I think what you've seen in the last couple of years was that very high price increases the whole industry put through to offset rising input costs. At the same time, because they were trying to defend margin, maybe there wasn't a lot of investment in innovation and marketing, etc. And what we saw last year was actually then the pricing disappeared, but there were no volumes. So that's why typically across the Indian consumer staples, we saw pretty poor organic sales growth. Now going into this year, we should see a more normalized pricing environment. But in addition, a lot of these guys now are investing more in new product development, bigger, bolder innovations, and at the same time, marketing more extensively than they have. And so hopefully, as a result, some of the share losses they've had against private label in the last year or two can be reversed. We're actually going to see volume growth accelerate as we go through the year. But certainly, low-income consumers remain under pressure. There's a lot of interest in private label, and the MDGs need to get their acts together to encourage some of those consumers back into the branded space.
Well, so John, I guess on the positive then, we may be in for restoration of volume growth. But then on the flip side, I know there's a lot of concern around margins, in particular as a couple of key inputs have seen dramatic price increases over the last year. And I've been looking at cocoa and coffee in particular. Cocoa prices hitting a record high in December. Coffee prices up nearly 20% in the last couple of weeks. And these are pretty key inputs for some of these staples companies. To what extent is that going to exert margin pressure for the food companies?
Yeah, I think it will. Just to come to Nestle, for example, about a third of its portfolio is in coffee and confectionery. You know, I assume they need to put through double-digit price increases in those businesses this year, and that's going to have an impact on volume. And it'd be interesting to see what the company says about that tomorrow. Laurent Frixie, his first full-year results as CEO since he was appointed, in something of a surprise move midway through last year. But certainly that pricing is not helping him trying to reboot growth. On the other hand, because of that pricing going through in coffee and chocolate, you may find Nestle's sales growth is going to be better than the market anticipates for 2025, but volume growth could be subdued as a result. And then the question is, how does the market view that? There has been a lot of pressure on companies where they haven't delivered on volume. Something more strong.
We've also got Unilever coming up tomorrow, and Unilever has been quite a turnaround story, or at least one that investors hope would be a good turnaround story. New management at Unilever in the last year, and it seems like investors have become more bullish on Unilever. They like the way the company is being run. Now they've done a lot of change on the portfolio already. They're in the process of trying to spin off ice cream. What's your take on Unilever in terms of where they are in that turnaround journey, and what are you going to be watching more closely in tomorrow's results?
I think Unilever are further ahead compared to some of the other players in the sector. You saw that with a pretty decent stock performance last year, one of the better performing stocks in that European consumer staple space. We assume more of the same through this year. What it benefits from is obviously the exposure into the more personal care. Its beauty business, its personal care business. These are growing faster than in the food space. In addition, it has that emerging market exposure as well. So, you know, we assume they're going to reiterate the 3 to 5% like-for-like growth along with a higher margin in 2025. We'll be watching, you know, what's happening with the ice cream business. It looks like that's going to be offloaded, and that has accelerated in the last couple of quarters as well. So news on ice cream, that could be pretty positive. And ultimately, more and more Unilever has just become more of a pure play home and personal care company rather than that mix of personal care, home, and then a big food business. Ultimately, maybe that rest of the food business may as well.
Right, and then maybe may see some multiple uplift as a result. John, lastly, the GLP-1s, what is the latest in terms of the impact that these new weight loss drugs are having on food consumption and in turn these food companies?
You know, this is such a big deal, and if the food industry is well aware that the average, somebody taking GLP-1s is going to be consuming less calories, particularly in things like snacks, salty snacks, because the average basket size is down pretty dramatically for a GLP-1 user. I assume GLP-1 users are already up to around 10% of the US population, and this is the reason why the US market has really been the nadir of the weakness in food over the last year or so. I think that trend's going to spread into Europe and elsewhere in the world over the next couple of years. Personally, I think the European food companies are better placed. They have healthier portfolios. We actually like Danone. Half of its business is in specialty dairy, namely protein dairy, gut health dairy. These products are currently booming from those GLP-1 users, and I expect that to continue well into this year and for the foreseeable future.
Equity research at Kepler Cheuvreux. Now, continuing with earnings this morning, Siemens Energy saw a record order book in the first quarter amid strong demand for its energy equipment. The company posted a net profit of 252 million euros. That's almost double expectations. ABN AMRO has posted a 27% drop in fourth quarter profit. That represented a modest beat and was supported by rising fees. For the year ahead, the Dutch bank says it expects interest income to fall to just $300 million. And Ahold Delhaize posted weaker than expected net profit of 380 million euros in the fourth quarter. Sales for the period came in marginally ahead of analyst expectations, with the company saying it has seen volumes recover in the U.S. That stock, though, down more than 5% this morning. Here in the UK, Barrett Redrow has surged to the top of the FTSE after announcing it expects annual earnings to come in toward the top end of its forecast amid solid bookings this year. The British home builder announced a £100 million buyback, with CEO David Thomas highlighting a recovery in demand amid stabilizing political and lending environments. And that stock up more than 7%, nearly 8%. For all the latest market news, you can check out our website. We are going to take a quick break, but when we come back, we're going to be monetary policy. ECB Governing Council member Robert Holtzman says policymakers need to be cautious as trade threats ramp up. We'll bring that conversation and more reaction out of Europe. We'll hear from the former ECB president, Jean-Claude Trichet. That's coming up next.
CNBC. Live ambitiously.
In a world full of ever-changing possibilities, global leaders unite to drive innovation and growth. The new CNBC franchise Converge brings together pioneers across business, entertainment and sport. Dive in as we explore leadership, innovation, sustainability and powerful people who are uniting ideas, inspiring solutions and shaping a better future. Converge. Only on CNBC.
When you think about Singapore, it has become an innovation role model. A lot of multinational companies that are growing up here are a wonderful set of partners for companies coming in who then want to grow in the rest of Southeast Asia.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Makeit's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, have our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Energy is set to be one of the hottest topics this year as the artificial intelligence boom, global geopolitical strife and US President Trump's return to office all put oil and energy alternatives in focus. Join me at India Energy Week, live from New Delhi as we explore the future of energy only on CNBC.
Welcome back to Street Signs. The American labor market is broadly in balance and not a source of significant inflationary pressure, according to Fed Chair Jay Powell, who testified before the Senate Banking Committee Tuesday. Powell told lawmakers the Fed doesn't need to be in a hurry to lower rates again after the FOMC cut at each of its last 3 policy meetings. Powell walked a fine line on the impact of policy coming out of the new Trump White House, including tariffs.
The standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Austrian National Bank FEB Councilman Robert Holtzman says policymakers must act carefully given the threat of trade curbs from the U.S. administration. Speaking to CNBC, Holtzman said the central bank should not be focused on boosting growth through rate cuts.
We have also the threat of high inflation given the changes on tariffs, and the result of it is we have to be very cautious. Because reducing rates in order to support growth is not the way to go. This is what you also framed when you called Madam. She also said it's not the way to support the structural rates.
How quickly, though, do you think we need to get back to neutral, even if you're not providing accommodation, just getting back to the neutral rate? Because conversation I had with Madame Lagarde in recent weeks that 1.75% could be the low end of neutral. Is that a prospect you see rates getting to soon?
As we know, the range of relative rate, neutral rate ranges quite a lot. In some cases, it goes up to 3%, not only to 2.25%, which was the restriction on Lagarde put there. And if we have the 3, which is part of the main range, opened 1.75 to 3%, then how to say we have a different discussion there, which means, yes, we want to come close to the neutral rate. Where exactly is, we don't know. And for this reason, we use other information as well in order to determine it. What we currently have is some indication in what direction it moves, but it's not the rate in which we do our decision.
Hi, Robert. Really nice to see you again, sir. What happened to the Robert Holtzman I used to know, who was quite a hawk and who was very concerned about his rate cuts as well? Of all those factors, that it was over a year ago, Robert, we sat outside, we were chatting in Davos as well. Of all those factors that led to you being more hawkish, have they dissipated now?
They have not dissipated. On the contrary, with the arrival of this set of tariffs, they re-emerged there. Before they were somewhat dissipated because we looked like moving slowly towards lower rates. What we have now is the threat of higher inflation rates, and for this reason, we have to be careful.
Governor, we've had a lot of discussions with governing councilmen like yourself about the prospect 50 basis point rate reduction, that perhaps the ECB is behind curve. I know you're sounding very hawkish, but not all members see the situation that way. They're very concerned about the growth profile. If you're wrong, and if inflation doesn't materialize and growth is a greater concern, would you be in favor of a 50 basis point rate reduction this year?
I think this will not be a good decision because our job is to deal with inflation, not with growth. And the result of it, reducing the interest rate in order to initiate a higher growth is not the way how we should work and how we are working.
Well, we're very fortunate this morning to have Jean-Claude Trichet with us, former governor of Bank of France, former president of the ECB. Thank you so much, sir, for joining us this morning. I'm very keen to get your on the state of play in the Eurozone. Latest data shows that growth is very slow, very sluggish in the economic region. Very disappointing manufacturing data coming out. I'm curious if you've seen any green shoots that stick out in the Eurozone or if it's all pretty downbeat.
Well, as you say, growth is very low, obviously, and much lower than in the US. That's absolutely clear. Nevertheless, if you want me to see some kind of rays of hope, if I may, the last PMI for the euro area, the composite, indicates the first sign of expansion since August last year. So it's very, very miserable. It's 50.2, but it's higher than 50. So I mentioned that en passant. But it is absolutely clear that we still have a growth which is hampered by the environment, which is hampered by the war in Ukraine, by our handicap in terms of the price of energy in comparison with the US, in comparison with the rest of the world. So we have big issues there. Still, it seems to me that in terms of growth, we are helped a little bit by the disinflationary process, which is, I would say, going on. And it brings me to say that the central banks on both sides of the Atlantic did a very good job in comparison with what they did a long time ago in the time of the first shock in 1973, when they were practicing benign neglect. They did not practice benign neglect this time. And it is rejoicing in a way, because of course, if you are in a disinflationary process, it helps also balancing demand and growth, because you are redistributing, if I may, to your fellow citizens some kind of purchasing power.
So no major policy mistake, and very fair point that, you know, so far the ECB and the Fed, they have kept a handle on things, but the Eurozone, excuse me, is sitting here with extremely sluggish growth for all the reasons that you cited. And yes, maybe we're seeing a little bit of hope in the latest PMIs, but that is all before the tariffs come into the picture and the looming threat of even more tariffs between the EU and the US. So from Europe's perspective, how would you characterize the risks to growth from these tariffs? And then we'll get on to the inflation picture.
Yes, of course. So tariffs are a killer, obviously. They are playing against growth, and they are playing against inflation, for inflation, if I may, against price stability. So this is really very, very grave. I am told by the fact that coming from the United States of America, we have this idea that trade are a zero-sum game. What you are earning and gaining is lost by the partner, and that is not reflecting the reality, in my opinion. So what I would say as regards tariffs and possible tariff wars is that the Europeans should respond tack for tack to the other countries concerned, in particular the US, if the war is triggered by the US. So I have to say that we should be on the European side. I'm speaking as a citizen, as determined, and when as aggressive as the US might be. That's as simple as that. But I hope very much that after a while, everybody will recognize that the trade between partners that are respecting the rules are a positive sum game. And I echo a little bit what Jay Powell said in the Senate. It seems to me it was more or less the message, even if he said we have no say, of course, in the trade negotiation, which is clearly the case of all the central banks.
In terms of the inflation impact of these, you know, the ongoing trade war, how do you think about the consequences for Europe? You know, on the one hand, you could argue that this raises inflationary pressure if we see a rise in prices across the globe as a result of these tariffs coming into play. But on the flip side, for Europe specifically, if we see other countries divert goods, for example, that would have ended up in the U.S., they come to Europe, that could have a disinflationary impact on prices.
Well, I mean, it's a very complicated situation. We don't know yet, of course, what are likely to be decided, what is likely to be decided by the United States. I would only say that in any case, it's bad, because again, as I said, it's against growth, and it's against the appropriate level of price stability. And let me remind all of us that we have the same definition of price stability on both sides of the Atlantic, namely 2% in the medium run, which is something which is very, very important. I expect, of course, the central banks, even in an environment which will be a little bit more difficult, to stick to this definition. And by the way, when you look at the reaction of our fellow citizens vis-à-vis price stability, clearly they are incredibly attached to price stability. You can interpret the changes, political changes that happen in the US and in many countries, many advanced economic countries and also developing countries, as a reaction against the hump of inflation that we had 3 years ago. So again, central banks in their job to deliver price stability, whatever happens, whatever are the decisions taken as regards tariffs, is backed by our fellow citizens. It's very important. Central banks are backed on both sides of the Atlantic by their fellow citizens.
Sir, we are going to have to leave the conversation there. We could talk for much more time, but we'll hopefully have you on again. Jean-Claude Trichet, former governor, Bank of France, and former president of the ECB. Let's get out now to Arjun, who's in Paris for a look at what's coming up next. Arj, good morning.
Good morning, Juliana. I'll be speaking to one of Europe's most prominent entrepreneurs turned investor about where he's putting his money in 2025. Stay tuned.
Welcome to Reinvented with Accenture. Today I'm here with Margherita Della Valle, CEO of Vodafone. You were employee 25 in Vodafone Italy. Today you're the CEO of Vodafone. What is your strategy and vision for the future?
We are changing our culture. Change is hard, but if people understand it's for the right reason, then you get the power of the organization with you.
Good money.
Everything will seem legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence, the laundering, $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, all of them.
He ain't getting justice.
American Greed on CNBC.
Ambition is in my DNA. My grandparents came over from China to give their children a better life. They opened up a laundry in Buffalo, New York. They raised 5 kids, and they sent all 5 children to college. They achieved their American dream, so I can have mine. It's a privilege to be able to have the platform to help viewers out there make better investment choices so that they can have a better life, so they can achieve their American dream. That's what ambition is all about.
Before they talk to Wall Street, they talk to John Ford and Morgan Brandt. Closing bell overtime.
Welcome back to Science. I'm Juliana Tattlebaum, and these headlines. Heineken raises a glass for drinks makers in early European trade, lining up its best day in more than 3.5 decades on the back of better than expected earnings. CEO Dolf van den Brink says he's optimistic on the impact of tariffs.
We keep following things attentively. It could have an impact on the aluminium pricing, but for this year, at least for 2025, we're all fully hedged, so we don't see an impact there.
Tariffs dominate the conversation as we get.
We have also the threat of high inflation given the changes on tariffs, and the result of it, my take is we have to be very cautious.
Tariffs are a killer, obviously. They are playing against growth, they are playing against inflation and for inflation.
And U.S. President Donald Trump orders government agencies to work with Elon Musk's Department of Government Efficiency on cutbacks as Musk hits back at critics of the project.
The people voted for major government reform, and that's what people are going to get.
Loss of nearly $2.5 billion, massively underperforming expectations. Well, European equity markets this morning holding up pretty well. We are seeing another day of green, at least to start the trading session. FTSE 100 up 8 basis points. You've got the Zetra Dex up 0.3%, the CAC 40 and the FTSE MIB. Obviously, the magnitude of those moves higher fairly contained, but it is the direction of travel that's worth noting. We have been advancing for weeks now. The stock 600 yesterday, the main benchmark added about 0.2%, hitting another record intraday high. And this morning, we are just continuing to move higher. Heineken performing very well this morning, up about 12%, lifting the drink space. That is the sector to watch this morning. Now, stateside, it is a slightly different picture. Looking at pullback for Wall Street, fairly contained as well, so fairly muted trade on both sides of the Atlantic there. No doubt a bit of a holding pattern with that US CPI due to be released today, and it comes at a time when inflation have resurged amid these tariffs and higher than expected wage growth in January, so that number are going to be very closely watched. Right now we're looking about an 80-point drop at the Dow, the NASDAQ and the S&P also looking to pull back at the open. President Trump, meanwhile, has ordered federal agencies to cooperate with Elon Musk's Department of Government Efficiency to find ways to shrink the size of the federal labor force through identifying workers who can be laid off and functions that can be eliminated. The executive order also limits federal recruitment once Trump's hiring freeze ends, with agencies allowed to hire only one employee for every 4 who depart. Law enforcement, national security, and immigration enforcement roles are exempt from the curbs. Appearing alongside Musk and his son in the Oval Office, President Trump made a series of claims that federal funds were being misused without offering any direct evidence, assertions which
in waste, fraud, and abuse. And I think it's very important. And that's one of the reasons I got elected. I said, we're going to do that. Nobody had any idea it was that bad, that sick, and that corrupt. And it seems hard to believe that judges want to try and stop us from looking at corruption, especially when we found hundreds of millions of dollars worth, much more than that, in just a short period of time. And we want to weed out the corruption.
Elon Musk used the signing to hit back at critics of his project.
The people voted for major government reform. No doubt about that. That was on the campaign. The president spoke about that at every rally. People voted for major government reform, and that's what people are going to get. They're going to get what they voted for.
Quite defensive remarks from Elon Musk there. Now, OpenAI CEO Sam Altman has told staff in an internal memo seen by CNBC that the company has not received an official offer from Elon Musk for the purchase of its nonprofit arm. It comes after news broke that a consortium led by Musk is vying to buy control of OpenAI for just under $100 million. In the memo, Altman says OpenAI is structured so that no single individual can take control of the company, adding that Musk's offer was aimed at weakening it. Arjun spoke to Sam Altman at the AI Action Summit in Paris, where he claimed the motivation behind Musk's bid was purely to slow down a competitor.
Bid for OpenAI. How seriously are you taking it?
Not particularly.
Not particularly. Why do you think he's doing this?
To slow down a competitor.
And Stargate?
What about
the funding?
Actually try to show up and, build the thing.
Sam, just a quick one.
Endgame, Mr. Rome. What is the endgame
Just a quick
Musk?
I don't know. I'm curious. Yeah. I think to slow down a competitor and try to catch up with his thing, but I don't really know.
Yeah, but you know well, right?
To the degree anybody does, yeah.
The U.S. and U.K. have refused to sign a communique at the Paris AI Action Summit calling for the open and ethical development of artificial intelligence. The British government said it declined over national security and global governance concerns, while U.S. Vice President J.D. Vance has told the audience earlier on Tuesday that international regimes must, quote, foster the creation of AI rather than strangle it. You would have heard that yesterday if you're watching Street Signs. We heard directly from J.D. Vance. Now, around 60 countries have signed the communique, including France, India, and China. Arjun joins us now with a guest from Paris. Arjun?
Hi, Julian. I told you we were going to speak to one of Europe's most prominent entrepreneurs turned investors. Let me introduce him, David Henriques, who is the co-founder at Wise and a partner at Plural. David, let's talk about AI then. We're trying to understand here where the investment case lies. A lot of the attention, a lot of the capital, a lot of the high valuation have gone into those foundational model companies. But are we missing something? Is the value, as other investors have told me, in that application layer next?
I'm very excited about what I'm seeing where the most ambitious entrepreneurs are building AI applications. And we look at companies, for example, like Helsing using AI to build real-world defense systems, looking at Proxima using AI to accelerate the build-out of fusion power plants. And additionally, there are a bunch of other European companies, Synthesia, 11 Labs, maybe Lava, who are using AI to generate voice, audio, code. So I think there is so much excitement about the applications that are being built. Maybe there are more headlines going to the models. Change around the models is happening so rapidly, and companies coming up with 10x better models. And I think the carpet may get pulled out, but application, I think we're seeing real value being created by lots of entrepreneurs.
Is that where you think the profitability for AI businesses will be? Because when you look at the models, there's a lot of debate about whether they become commoditized, whether open source models eat the lunch of some of those closed models as well.
I imagine that on the model side, we're going to see probably both. We'll see a lot of open source solutions. So there will be proprietary ones as well. I'd probably still be more bullish on the profits in the long term being on the application side, because I think these can be more defensible with proprietary data, and I think we're seeing lots of progress there as well.
Fascinating. What has DeepSeek done to your investment thesis, if anything? Because the excitement around DeepSeek, we saw a knee-jerk reaction in the public markets, and the debate was about whether this means we're overspending on AI with all these multi-billion-dollar infrastructure projects, and whether actually some of the valuations these model companies have garnered should be called into question. Has it done anything to change your investment thesis?
I have kind of 10x better products for a very long time. And I think the way to look at DeepSeek is 10x advantage on the model side, which shows how innovation is happening, which means that the business cases are much harder to make on the model side. Kind of hence why we spoke about applications before, that I think applications could be in a much more sustainable and defensible position today.
David, before this interview, we were sort of debating the geopolitics of tech, and during this AI summit over the past few days, the geopolitics, I think, was laid bare. The US and the UK didn't sign up to this AI communique at the summit. We heard from US Vice President J.D. Vance, who sounded very critical on Europe's regulatory approach, etc. What does the geopolitics mean as you think about investing in tech, given it feels that there are more and more silos being created and each region or country needs to sort of fend for itself?
And we are living in a brave new world, and maybe when even a year ago we could think about China being kind of getting separated on an island, I think maybe now we need defense companies in every country. We're going to need foundational models. We're going to need data centers. So I think that for political reasons and for resilience, we will need to build up a lot of the same things in Europe, which maybe a year or a few ago we didn't really think so, but I think it's a great use of also the funding that's been announced at the summit here. So, I would assume that we will need to build more of the things, kind of duplicates in some ways, just to give us resilience.
Almost OpenAI for Europe, Palantir, Anduril for Europe, this kind of thing?
And I think we're seeing that happening. I mean, I agree with you.
Yeah. What is it, and for your investment, you are focusing on a lot of European companies as well. Does that create new opportunities as you see it? So when you look at some of these AI companies, perhaps in a world where there was closer collaboration between the US and Europe, perhaps that company wouldn't have been as prominent. But now, given the situation you're laying out, actually there's more opportunity there.
And we are already seeing it. I mean, for example, with Helsing building a defense AI company, there is probably a US equivalent of this. Same thing, we're looking at Proxima building fusion energy power plant. There are fusion energy companies in the US, Proxima being, we believe, the best technology using the stellarator approach is going to be a European champion building a globally needed product. So I think we're going to see this happening in more and more of the kind of more fundamental and more in in areas which need a lot of resilience.
In terms of valuations as an investor, Tavet, you've seen the model side of the equation and we've seen astronomical valuations there. Are you seeing the same hype and valuations happening in the areas you're investing in on the AI application side?
I've seen a few cycles happen in the tech world, and every time in a cycle you get some companies that are showing amazing traction and are able to generate these huge headline valuations. I think what we really care more about is the valuations we're going to be seeing in 5-10 years from now. Oftentimes we see some of these companies may run a little bit ahead, they're going to correct later, so it's just a little bit too early to say.
And in terms of Europe's position in this, we've spoken about the geopolitics of it all, but Europe has had its own challenges, and there's continued debate whether there's too much regulation, whether Europe has invested in enough infrastructure. One of the things that it seemed that President Macron of France was trying to do during the summit was shake off this image as Europe as anti-innovative, over-regulatory. But as an entrepreneur and as an investor, are there still some big challenges Europe needs to overcome? And are there some things that should change for Europe to really compete in the AI realm on a global stage?
I think when it comes to regulation, we are seeing a changing kind of landscape. And I think it was quite symbolic to see that the summit has gone from the AI safety to more AI acceleration. What I wish is that we're going to see a more level playing field across the world. If the US is dealing with ripping out regulation and Vance is talking about opportunity in AI, then in Europe we're not going to go that far if we add more regulation on top of it. So I think Europe has to think about this as how do we create a level playing field for the great entrepreneurs to compete. If we look at the ingredients, we have a lot of talent in Europe. So there is a huge portion of are coming from Europe. We're seeing more and more. We just need to make sure that there's a level playing field and we do not shoot ourselves in the foot.
Just a final one from me, Tavet, on the use of AI. There is this debate about, I promise I won't get into this, but now we're here, scaling laws and how AI is going to become more efficient, and actually whether it's going to become more ubiquitous, more used across consumers, across enterprise. How are you looking at that potential growth of the use of AI, or is there still a lot of challenges in terms of implementation in businesses and for consumers as well?
I think we're definitely going to see accelerated usage of AI across all areas. I think sometimes the hype goes a little bit ahead, but if we're looking at user numbers, they are growing in a very nice way. I'm excited about DeepSeek is making it cheaper. There's also many news now about people using $400, $50 to train a model. So I think if it becomes cheaper, there's going to be a lot more usage, and that's actually a good thing. That's a good thing for everyone, and it's going to help entrepreneurs. We're going to have more impact this way.
And does that mean more infrastructure and compute will be required? Because this is a big question.
I would not bet that we need less infrastructure.
Thanks so much for your insight there. Fascinating conversation there into the state of AI and how we need to start thinking even more across geopolitical lines when it comes to technology. That was Tavet Henriques, the co-founder of Wise and a partner at Plural. For now, Juliana, back to you.
Arj, thank you so much for that interview. For more on Europe's AI ambitions, do check out Arjun's article on CNBC.com. For now, we'll take a quick break. Stay with us.
Live ambitiously.
1,500 movies? I don't want this flight to end. This is the game changer. Look, it even comes with binoculars.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation,
and startups from one place. CNBC.com/technology.
Learn how to use AI to be more successful with CNBC Make It's new online course.
We'll give you examples that help you master AI tools.
Go to cnbcmakeit.com/AI and register now.
Ambition doesn't always look like you think it look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that tell the world is going. I want to democratize access to that high-level information and help explain to every single person out there why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Welcome back to Street Signs. As we approach the end of the program, here are 4 things to get you up to speed ahead of the Wall Street Open. Traders are closely watching today's CPI print stateside, with the annual figures seen holding steady from January. Fed Chair Jerome Powell heads back to the Hill for a second day of testing after signaling the central bank isn't in a rush to cut rates. Earnings season continues with Reddit, Cisco, and Robinhood among the names reporting today. And we'll get a check on the crude markets with OPEC set to release its monthly oil market report this afternoon. OpenAI sparked a frenzy in the artificial intelligence space, with others trying to catch up. But it's not the only player in the game. The UAE's AI minister told CNBC, the minister also gave his views on what the surprise bid from Elon Musk and his consortium for the company says about the state of the global AI race. Take a listen.
I don't know how Elon feels. I can't comment on his sentiment, but you have to think about it. He was the major shareholder for $50 million at one point of time. So I'm not sure how he feels, but I'd love to ask him about that.
How do you think the battle for OpenAI is going to play out? You could argue that this is probably the most important strategic artificial intelligence asset globally today as it stands. How does this battle between Musk and Altman end in your view?
So I don't think that the only conversation we need to be having is OpenAI. So even if you look at, for example, today, the potential of OpenAI that people are talking about is the potential that it has to disrupt Google and Google search. If you look at traffic, Google is at least, if I'm not mistaken, 12 or 13 times that of OpenAI as it currently stands, maybe even more. So there's still a long way to go. And I don't think Google is going to just sit there and wait for it to happen. I think they're going to innovate. I think they're going to iterate. They're going to improve. So it's a bit early. What OpenAI and ChatGPT was able to do is it was able to spark a sort of frenzy that others are trying to catch up right now or pivot towards what they were able to do. You see the new reasoning models are actually quite impressive, and the deep research models as well that OpenAI has announced are actually quite impressive. But the time to emulate and deploy something similar has been reduced drastically. So I don't know how long this advantage is going to be maintained. Now, sometimes when we ask these questions, we identify OpenAI as the only player. I don't think they are the only player. I think we will have emergence of other companies that are going to be as important, and especially in very specific domains.
SoftBank Group posted a net loss of $2.4 billion in the third quarter, weighing on declining valuations at its Vision Fund. The investment arm posted a net loss after 2 consecutive quarters of profit. The Japanese conglomerate has recently expanded its investments into AI, reportedly in talks to invest up to $40 billion into OpenAI, with part of that funding expected to be used for OpenAI's commitment to Stargate, according to CNBC sources. Let's get back out to Arjun. SoftBank, it feels like this morning, the focus is not necessarily on the numbers themselves, but still around how it funds these investments into AI, how it plans to fund its involvement in Stargate. Do we have any more color?
Yeah, that's such a key question at the moment investors are pondering, because there is a lot of talk about whether SoftBank is going to have to raise more capital, issue more debt, or potentially sell down some of its stakes in, companies like Arm, which it's still the majority owner in. Of course, the problem with that is if it signals any selling of Arm, that could reduce the pressure or put pressure on Arm shares, could reduce massive value in it as well. So lots of questions there. However, you have the CFO, Yoshimitsu Kato, speaking this morning, and he was saying that the contribution Stargate is split between 4 partners, so the burden won't be so great. They're trying to play down some of the fears around SoftBank having to raise capital or issue more debt as well. He says in the project finance, the amount of equity required depends on the project, but it will always be the minority, and Stargate will consist of a series of projects as well, and for each of these will equity and lead the financing for the remainder. So trying to say this is not just all in one go, we're going to throw in all this capital, this is project by project depending on what needs to be done with that. Really what SoftBank's position is at the moment as it relates to Stargate. Of course, I think there's questions around the investment and raising that capital and where that money's coming from will continue for the near future.
Art, thanks for the color on what's happening at SoftBank. Now, let's talk about what's going on in D.C. President Trump has ordered federal agencies to cooperate with Elon Musk's Department of Government Efficiency to find ways to shrink the size of the federal labor force through identifying workers who can be laid off and that could be eliminated. Let's get to Alice Barr, who joins us now with more on this developing story. Alice, I think this has a lot of people on edge, this new communication from the president and from Elon Musk. What agencies are in focus, and what is the message for workers at those agencies?
Yeah, Juliana, this has been kind of a steady march across agencies within the federal government where Elon Musk and his Department of Government Efficiency have been going in and making really massive cuts in a number of cases. And what President Trump has indicated is that the next up in the crosshair, the Education and the Department of Defensive Education, President Trump long said on the campaign trail that he actually wanted to get rid of, and there's been some reporting that that could be something that his administration is moving toward, and moving education decision back to the states. The Department of Defense certainly is an area where President Trump has not indicated a lot of desire to pull back in the past, so it will be interesting to see where Elon Musk and his team may say that they're finding fraud and waste and abuse, which is what they've been saying across other agencies, and how the president and Republican members of Congress may respond to cuts, particularly to that agency, the Department of Defense.
In terms of the response, give us a little bit more color on what Congress is saying about this and what we can expect in terms of a reaction from the Democrats.
Yeah, Democrats have been trying to sort of sharpen up their response and come up with a means of trying to slow the roll, basically, of the Trump administration as it's been going agency by agency. They've talked about trying to set up sort of a streamlined process in order to get complaints up to the court system. That's been really the main means of trying to throw up roadblocks. And there have been a number of successful cases, successful at least thus far, that President Trump has been objecting about. He, in fact, in the Oval Office yesterday said that he is going to abide by court rulings and appeal, but he also noted that he thought it was time to take a look at some of these judges more closely, that he is certainly frustrated with the fact that, for instance, an appeals court yesterday rejected the Trump administration's efforts to reinstate a partial funding freeze. A federal worker buyout program is on hold. So a lot of what Democrats have been doing to try to push back has been through the means of trying to draw attention to the courts and to slow things down that way. Republicans, for the most part, have that they think this is what the American people are for, to have major changes in downsizing the government, and you haven't heard a lot of vocal opposition from Republicans as far, again, things like the Defense Department could potentially tip that.
Alice, a very similar message to what we heard from Elon Musk in the Oval Office yesterday. Thank you so much for giving us the latest. We're keeping an eye on that story here in Europe. We'll give you a last check on European markets before you hand you over to our colleagues stateside. We're holding on to those early gains, green across the board. Got the DAX 0.3%, similar gains over in France. U.S. futures are still in the red. You've got the Dow looking to pull back about 70 points at the open. The Nasdaq and the S&P also looking to open weaker. All eyes on that U.S. CPI report due out later this afternoon. But that is it for Street Signs. I'm Juliana Tattle. Worldwide Exchange is next.
Elevate your portfolio with JP Morgan's Pretty Premier Income ETFs. Apple flavors, global equities, US equities, and technology stocks. Discover now. Search JP Morgan Income ETFs.
The power plays are here, breaking down markets with updates and deep dives. What's moving now, and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Embrace digital disruption.
I mean, this is life-changing technology.
CNBC Tech, The Edge, only on CNBC.
What made you want to do robotic surgery?
When I was training to be a urologist, robot surgery was one of the most exciting and developing space. I can show you around. This is the console. Basically, it's like the flight deck where I use my hands to be able to control, to maneuver the instruments in various directions and even move like a wrist. The pedals below looks a bit like an organ, so you must be able to use both your left and right feet all at the same time to control various instruments, the various energies you use to cut or to stop bleeding, etc. And also to control the movement of the camera. You're able to have stereoscopic vision. So you're
But what if the robot breaks down? Yulam credits much of the heavy lifting to his team of nurses. Both surgeons and nurses in Singapore are trained in countries like Japan and the US to operate and troubleshoot the Da Vinci robots.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show, Squawk Box. CNBC. Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, CNBC.
It is 5 a.m. here at KBC Global Headquarters. Welcome to Worldwide Exchange. Here is your 5-5. Jay Powell doubles down on the Fed pause. We look at the impact on Wall Street.
We do not need to be in a hurry to adjust our policy stance.
Investors now focusing on day 2 of Powell's testimony with the latest inflation report before the open. In Washington, Elon Musk joins President Trump defending the Department of Government Efficiency.
People voted for major government reform. There should be no doubt about that. That was on the campaign. The president spoke about that at every rally. The people voted for major government reform, and that's what people are going to get. They're going to get what they voted for.
Plus, the one Mag 7 stock win streak, what retail investors are doing now. And later, the super micro roller coaster, it just rolls on after a critical update. It's Wednesday, February the 12th, 2025. You are watching Worldwide Exchange right here on CNBC. Good morning. Thanks so much for being here with us. I am Frank Collins. Get you ready for the trading day ahead. We begin with the major averages coming off a bit of a mixed day. The S&P basically flat, the Nasdaq lower. Following Jay Powell's comments on Capitol Hill that the Fed was in no rush to cut rates. Taking a look at futures, you can see in the red across the board, the S&P down more than 7 points, but basically flat, pretty close to flat, fractionally lower. The Dow looks like it would open 60 points lower. The Nasdaq also just fractionally lower right now, down about 10 points. Want to take a quick look at the S&P 500 market laggards. We're going to start with the laggards this morning. You see right here at the top of the list, NetApp, those shares down about 3.5%, followed by Arista Networks, Eversource Energy, Lennar, the home builder, and Iron all on the bottom of the S&P 500 in the pre-market. And we want to take a look at the gainers as well, the stocks that are leading right now. We're seeing Supermicro. We're going to talk a bit more about that stock in just a second. Gilead Sciences, Edwards Life Sciences, NXP Semiconductors, and Mohawk Industries on the top 5 right now. So we continue to watch stocks tied to tariffs on aluminum and steel. This morning, we continue to see movement in the pre-market. Nucor up fractionally. Cleveland Cliffs also up fractionally. The big gainer this morning, Century Aluminum. Those shares up about 2.5%. Alcoa, another big aluminum producer, also up fractionally right now in the pre-market. We're also tracking 2 stocks that are very closely tied to the AI trade. Let's start with one of the big winners here. You can see just a clear upward trend when it comes to this stock. Right now in the pre-market, up almost 0.5%. It's the longest daily win streak ever. Over that time, up just about 18%. And then also we're looking at Supermicro. So we tell you a little bit more about that. Really surging in the pre-market this morning. We showed it to you, up about 6%. After saying it will meet a deadline to avoid being delisted from the Nasdaq, also highlighting a full-year sales guidance that came in way above estimates, with management saying it's, quote, being conservative. Take a look at shares this morning. You can see up just over 6%, almost 7% right now, about 6.5% or so. Week to date, a lot of volatility. See kind of the moves, some concerns about it being listed, a lot of volatility here. But week to date, shares up over 13%. We're going to take a look at the Treasury market right now. Bond yields. Look right now, the benchmark at 4.54, moving a few basis points. But since the inauguration, a lot of announcements that people thought may be inflationary. We've actually seen bond yields ease a bit, about 5 to 8 basis points. Different story when it comes to the short end of the curve, though. The 2-year Treasury basically at the same level it was on inauguration day. And we're going to take a look at oil, on pace for a winning week this week, despite some concerns about tariffs hitting demand. Right now, back. WTI crude, the U.S. benchmark down about 1.25%. Brent crude, the international benchmark, falling about 1%. Similar story for natural gas, falling about 0.75%. All right, that is your setup. Let's now see how Europe is shaping up as this trading day gets underway. Juliana Teitelbaum is in our London newsroom with a look at the early action. Juliana, good morning.
Frank, good morning. Well, so far in Europe, we're off to a positive start. European equity moving modestly higher, building on yesterday's gains. We hit another record intraday high for the main benchmark, the Stock 600 yesterday. You can see here every major region is trading higher this morning. FTSE 100 in the UK, the Xetra DAX in Germany, the French market, and the Italian equity market. We're watching the drinks makers quite closely this morning, Frank, and lately we've been talking all about how people aren't consuming as much alcohol lately. The younger generation, it's been a story on both sides of the Atlantic. Today, a very different story out of Heineken, and very different in fact, in the sense that the company beat expectations after 7 quarters of missing analyst expectations. So this morning, Heineken posted a net profit rise of 8.3% for the full year. That was ahead of forecasts and its own guidance. The Dutch brewer saw beer volumes rise 1.6% on the organic basis, and they announced a 1.5 billion euro buyback program over the next 2 years. And my, oh my, shares have been rewarded for it. The stock is nearly 12%. It was actually halted in early trade, and it's having a spillover effect on the other drinks makers. We're seeing strong demand for the likes of Carlsberg this morning, AB InBev as well, with the share prices of those big names. Now, it's not time to get overexcited, but certainly a bright spot in what has been quite a dire period for these companies. Frank?
Juliana, thank you very much. Juliana Teitelbaum, I'm loving our newsroom. Time now, we're checking on some of this morning's top corporate stories. Silvana now is here with those. Silvana, good morning.
Hey, Frank, good Wednesday morning to you. Well, let's start with Citadel CEO and Republican mega donor Ken Griffin sending a stern warning over the negative impact from President Trump's approach to U.S. trade policy. Speaking yesterday at the UBS Financial Services Conference in Florida, Griffin told attendees, quote, "From my vantage point, the bombastic rhetoric, the damage has already been done," adding it's a huge mistake to resort to this form of rhetoric when you're trying to drive a bargain that tears into the minds of CEOs, policymakers, that we can't depend upon America as our trading partner. California regulators say they plan to impose a $1 billion special assessment on private insurers to shore up the state's insurer of last resort. That's also known as the FAIR Plan, following the devastating LA wildfires that could end up costing insurers an estimated $75 billion. State Commissioner Ricardo Lara says the assessment is necessary to continue paying out claims to fire survivors. And the Wall Street Journal reports are discussing plans to consolidate federal banking regulation without congressional consent. Now, according to the report, Trump advisors and allies are looking at ways to collapse the FDIC into the Treasury Department and combine the agency's role with the Office of the Comptroller of the Currency. The reported move follows the dismantling of the Consumer Financial Protection Bureau last weekend. The Journal adds staff inside the FDIC and OCC expect to hear from DOJ in the coming days, Frank.
All right, so thank you very much. See you a bit later in the show. All right, we're going to turn our attention now to Washington. And usual scene in the Oval Office late yesterday, Tesla CEO and Department of Government Efficiency head Elon Musk, he joined President Trump for an executive order signing, further empowering DOJ's oversight within federal government agencies. And more in this story from Washington.
Agency for International Development, firing the humanitarian aid group's inspector general, a day after the independent watchdog filed a report warning of dangers from the agency's massive cuts. That's according to a letter obtained by NBC News. USAID an early target for cost cutter Elon Musk, who joined President Trump in the Oval Office.
The people voted for major government reform, and that's what the people are going to get.
President Trump signing an executive order giving Musk and his Department of Government Efficiency more power over the federal workforce, even as the group's work faces mounting legal challenges. Yesterday, an appeals court rejected the Trump administration's effort to reinstate a funding freeze, and federal worker buyouts are on hold. The president saying he'll abide by rulings and appeal, while noting,
we want to weed out the corruption, and it seems hard to believe that a judge could say, we don't want you to do that. So maybe we have to look at the judges. Very serious.
President Trump and Musk saying he's found billions of dollars in fraud and waste, but not providing specific evidence. While 3 administration officials tell NBC News 2 top officials in the ICE Enforcement Division have been reassigned because the White House is frustrated migrant arrests and deportations aren't moving quickly enough. The Trump border czar asking Senate Republicans for more funding to speed one of the president's top priorities.
And as he defended his team's cost-cutting moves, Elon Musk also rejected concerns about conflicts of interest from his businesses, massive federal contracts he said that he expects to be fully scrutinized. Frank?
All right, Alice Barr reporting from Washington. Alice, thank you very much. Turn our attention back to the markets. They're gearing up for today's CPI data, giving our first look at inflation in 2025. The core rate's expected to have slowed very slightly, just a basis point since last month. Investors will also be watching Fed Chair Jay Powell. He's back on Capitol Hill for another day of testimony on the economy. Powell's second day, it wouldn't normally get as much attention, but lawmakers, they could ask for his reaction to CPI. Yesterday, the Fed chair told the Senate Banking Committee the Fed is in no hurry to lower its rates.
If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly.
Joining me now is Gene Goldman, Chief Investment Officer at Cetera Financial Group. Good morning. Great to see you.
Hey, good morning, Frank. How are you?
So, Gene, I'm looking at my notes right now. You say the Fed's not as good of a friend as we kind of thought it was before, but I want to ask you, doesn't a good firm tell you the truth? I think Jay Powell's been very forthcoming. He's been transparent. Isn't that good friendship, at least on the investor side of this, because it can help you make your decisions about
Yeah, I mean, that's a great point. You know, one of our bigger themes last year was the Fed goes from being a foe to a friend. They go from raising to cutting interest rates, and they cut by 100 basis points. This year, though, as we laid out 2025, we said the key things about the Fed, they're a friend, but not a good friend. They're a friend because they're not raising rates. Definitely, they're not going to raise rates rates as much as they said they would last year. So if you look at market projections, the Fed is actually following the market. The market follows the Fed. So if you look at year projections, the market is saying 0 to maybe 1 rate cut this year. You look at the end of the year rates expectations, it's around 4% or so. The Fed said in December they would cut rates twice this year. In September, they'd cut rates 4 times. But you've got the Fed saying, higher inflation, you have the economy, you have uncertainty with the Trump tariffs. You take this together, plus recent Fed speak, Hammack yesterday, Williams yesterday, Powell yesterday, all saying that the Fed is likely on hold for a long time. Our theme for this year is none and done. No rate cuts for 2025.
Okay, you don't see any rate cuts coming. That's a very interesting thesis, because let's go to the new trade that you came up with. I actually enjoy acronyms. You came up with a new one. The trade. It's small caps, healthcare, AI, and quality. I'm a big fan of Shaq himself. By the way, Shaq, if you ever want to come on, open spot. But if you don't think there's any rate cuts, I want to ask you about the S in that Shaq trade, the small caps. Doesn't that kind of break down the idea that small caps are going to benefit or be a big winner this year? Because the whole thesis is leverage with the idea that the rate cuts will be able to take advantage of some of the leverage they have.
Yeah, no, it's a true point. And again, going back to Shaq, the NBA All-Star game is this weekend. And I love Shaquille O'Neal, especially when he came to play for my Celtics. And our best investment ideas are Shaq, small cap healthcare, artificial intelligence, and quality. Small cap we like a lot because you have cheap valuations. Yes, they tend to do really well when rates do come down, but rates are not rising higher. And we saw the small business sentiment survey that came out yesterday. The numbers were pretty good. Optimism and especially business sentiment has improved since we've seen the Republican administration come into Washington. We like small cap. Again, there is really attractive given advances in biotech, personalized medicine, health solutions, and then quality. Quality is key. Buy quality names.
All right, so I want to stick with this Shaq trade theme right here. By the way, you mentioned healthcare. Obviously, healthcare is seeing a big rebound this year after it was kind of a laggard last year. But a key part of that in your thesis is biotech, which is supposed to benefit from rate cuts. But I just want to go back to the idea of AI. Isn't AI right now, the trade at least, very similar to Shaq on your Celtics? I don't think you have a good memory about this, but that Shaq couldn't perform the way it used to and was having a lot of problems just kind of getting going. It seems like the AI trade is very similar to that. If you look at the Mag 7 this year, it's not leading, it's lagging along with the rest of tech. So a lot of parallels to Shaq on your Celtics. Are you getting concerned about the AI trade and some of the thesis there, whether it's chips or the fact that this is a safety trade when we're not as clear about the Fed? Seems to be breaking down, at least in the early part of this year.
And please stop bashing my Celtics. They won this championship last year. But AI, within AI, artificial intelligence and automation, I think AI, you need to be very selective. I do believe, given the fact labor market uncertainty, immigration, you take this, especially those industries that are very labor intensive, healthcare, logistics, finance. I do think artificial intelligence and especially automation is going to be so very important. We are in a data revolution. We're getting so much data out there, but we need large language models to go and sift through this data to make it much more productive for us to use. There's going to be some volatility. There'll be some uncertainty today, but I do believe there's some opportunities here still.
All right, Gene Goldman, great to see you as always. Thank you very much.
Thank you. Thank you.
We got more worldwide exchange, including housing stock, the housing stock investment that one investment manager says is worth buying on the way up. But first, down on one of the most sought-after stocks when it comes to retail investors and what that means for the broader markets. Plus, Bill Lee from the Milken Institute is here looking ahead to the first CPI report of 2025. And then later, lawmakers are struggling to keep pace with President Trump's policies and his agenda, but some have taken a key first step today. We have a very busy hour still ahead when Worldwide Exchange returns.
To me, ambition is dry. It's the fire in your belly. I didn't go to college right after high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. Once you do your dreams, you have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
How much would you pay for luxury travel? Almost $270,000.
On the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that one can't buy.
This is First Class, only on CNBC.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today. Live from the New York Stock Exchange, Halftime Report, CNBC.
hour, here's a check of a few big stories that we're following this morning. Citadel CEO Republican mega donor Ken Griffin sending a stern warning over the negative impact from Trump's approach to U.S. trade policy. He's calling the president's rhetoric bombastic, adding damage has already been done. California regulators say they plan to impose a $1 billion special assessment on private insurers to shore up the state's insurer of last resort following devastating LA wildfires. The state commissioner says the assessment is necessary to continue paying out claims to fire survivors. The Wall Street Journal reports White House officials are discussing plans to consolidate federal banking regulation without congressional consent. According to the report, the plan to collapse the FDIC into the Treasury Department and combine the AC's role with the Office of Comptroller of the Currency is now being discussed. OpenAI CEO Sam Altman telling employees the AI startup has not received anything official from Elon Musk regarding a potential bid. In an internal memo obtained by CNBC, Altman added that Musk, quote, has a history of making claims that don't hold up. And a group of U.S. airlines are asking the Department of Transportation to abandon a Biden-era review over whether carriers should be required to pay passengers compensation over flight disruptions. A trade group representing American, Delta, and United, they argue the potential requirement would drastically boost airlines' cost and hike ticket prices. All right, turning back to the markets, investors are preparing for CPI, the latest read on and Fed Chairman Jay Powell's second day of testimony to Congress. Taking a look at futures, right now we're seeing the Nasdaq just fractionally higher. The Dow actually hitting its lows in the morning, looking like it would open about 7 points lower. The S&P just fractionally lower, about 6 points lower right now. For much more on the trading day ahead, let's bring in Josh Wine, portfolio manager at Hennessy Funds. Josh, good morning. Good to see you.
Morning. Good to see you, Frank.
Josh, I want to ask you, what's your word of the day? How do you see today shaping up?
My word of the day, it's a great question. It's periscopic. So I think, we talk about tariffs. You're talking about India and perhaps some good news there. I think, the tariffs is such a distraction because, it's really this negotiating tool and we don't know where they're going. We know that the word's going to keep coming up. I think when I think of periscopic, it's kind of earnings season. Like, let's look at what's straight ahead of us and not what's around us. Let's look at, what companies are saying and what they're not saying.
You're mentioning tariffs right now, and also we have CPI later today. This will be the last read of inflation before the period where the tariffs actually kicked in. I want to play the soundbite from Bill Lee, the chief economist of Milken, who's on the show just a bit ago. What he had to say about tariffs and inflation is your take.
Tariffs are really serving a sort of like a multifaceted role in the Trump administration this time around, and I don't think we're going to see a lot of impact on inflation.
Well, Josh, again, Bill Lee's saying that the tariffs he doesn't believe will be as inflationary as many people fear. Do you agree with that take? And how do you see just inflation and tariffs playing out for the rest of the year, not only impacting the Fed, but the economy?
Yeah, so inflation, I mean, in terms of tariffs on inflation, I think we've had tariffs before, and no one was really talking about those being the cause of any inflation that we've seen over the last several years, during the Biden administration. I would agree. I think that if there's any inflation, it's a momentary step up in price levels, and then things adjust, above trend inflation. If anything, it's a step up. I don't see it being material. I think, I think inflation numbers themselves, irrespective of tariffs, I think that we're in this interesting area where I'm thinking a lot about, is there ever a point where they talk about a range for inflation instead of this 2% target that's, somewhat arbitrary or very arbitrary. But no, I don't think tariffs is
okay.
So far. The market's not concerned, I would say.
All right. I see the market being that concerned. I want to ask you, what's your stock pick for us today, and why are you making this pick?
Yes, it's holding in our Hennessy Cornerstone Midcap 30 fund. It's Redfin. So, existing home sales hit a 30-year low last year. Interest rates or mortgage rates, more specifically, are starting to come in just slightly, not enough to kickstart a lot of activity, but, it's certainly on the horizon. So I think that Redfin offers a compelling value for sellers with their 1% listing fee. They're in about 80 markets. You have a great kind of technology backbone and web presence that's been driving traffic. I think it's an under-the-radar name that could really benefit from any pickup in home sales.
By the way, stocks moving higher on a new partnership. Shares are up about 6% for people listening. I do want to ask you, with a lot less clarity about the Fed's rate path forward, and Jay Powell also saying in no rush, wouldn't Redfin be the beneficiary of that? Are you concerned about the fact that we don't have that much clarity when it comes to rate cuts for this name?
Right. Yeah. I mean, it looks like, at best a rate cut later this year. I don't see, I think that I think there is a little bit of clarity. I mean, they're not going to be going down 3 or 4 times like I think a lot of people had thought a year ago. But I think that it's enough to know that, perhaps a cut, people aren't going to wait for all the cuts. I think that there's this issue of, the reverse of inflation where people are waiting, for the right time. So I think, rates are not historically that high. So I think people will have to get used to a new reality.
All right. Fair enough. Your pick for today is Redfin. Josh, always great to see you. Thank you very much.
You too, Frank.
Before we let you go, here's what to watch today. We get CPI and weekly mortgage applications ahead of the open, and Fed Chairman Jay Powell is back on the Hill testifying to members of the House this morning. Also, a number of earnings. That's going to do it for us. Squawk Box starts right now.
Good morning. President Trump ordering federal agencies to work with Elon Musk's Doge to slash workforces. We'll show you what they said in the Oval Office yesterday. Disney, Goldman Sachs now. The latest company's rolling back some DEI initiatives. Straight ahead. So we'll bring you some key inflation data at 8:30 a.m. and this comes just ahead of Fed Chair Jay Powell's next round of congressional testimony. It's Monday, February 12th, 2025, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Andrew Ross Sorkin. Snowy out. We made it in. It's okay. Things are easing down a little bit. Only a couple of inches here and north of here. Down in Washington, D.C., almost 6 inches. So the snow is impacting things on the northeast here today.
It's been snowy this year, but we haven't had
snow like this in a
we
while.
haven't had the
Not in Boston. Boston is having a snow
DC
drought.
was-
DC had about almost 6
yeah,
inches. Yeah, so we're watching that pretty closely. There's Times Square, nice picture of things. It's warm and cozy inside, though. And the U.S. equity futures this morning look like it's shaping up like a mixed picture so far. That's the same story we saw yesterday, a mixed bag between what you got with the close. Dow this morning indicated off by close to 45 points. S&P futures down by about 3. The NASDAQ indicated up by about 13. Yesterday, the S&P was up for the second day in a row. The NASDAQ was down for the second day in a row. They did see some small gains were eked out for both the Dow and the S&P 500. NASDAQ saw just a slight decline. We're also watching interest rates after this comment by Fed Chair Jay Powell in his congressional testimony yesterday.
With the policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
No hurry means that Treasury yields rose. This morning, the 10-year sitting at 4.53. The 2-year is at 4.29. Jay Powell went out of his way to really just explain that we're not going to move down anytime soon. We're not going to move up anytime soon. And we want to watch this very closely to make sure that we're monitoring both of their mandates that they have, too. It seemed like there was some extra language kind of added in, almost interest rates for dummies to kind of sleuth in maybe on the political, expecting a little bit of political pressure. But we'll be watching data today. We get the CPI today, and that's going to give us a big indicator.
Those are the data points that they can give all of us. That's an idea into whether are we more at risk of an eventual slowdown or more at risk of resurgent inflation.
If inflation numbers come in as the expected, I think up 3.1%, then you're probably talking about the slowing of progression, at least in terms of trying to get it back to the 2% target. So we'll see what happens as we get closer.
It feels like the way we're thinking and the way the economy, we're all in this sort of period between administrations where we're trying to find our footing. What does all this mean? This crazy, all the action coming from the Trump administration crystallized exactly what, it's not a constitutional crisis. There's other presidents have taken some similar measures, maybe not to the same extent, but President Obama at one point said, "Sue me if you don't like what I'm doing." Presidents do what they want, but classifying them into 3 groups: stuff that he's definitely probably able to do, stuff that's a little bit questionable, and stuff that is clearly that he wants to be revisited to the Supreme Court because he thinks the original cases were wrong in the first place. But it is aggressive, no doubt. But I think we're like rudderless right now. I don't know what.
I don't know if it's.
Are you bullish?
I don't know if it's.
No, I feel rudderless. I don't know about the economy. I don't know whether we're ready for a slowdown, or I don't know how tariffs are going to affect things. I don't know how government, all the cuts in government spending. I don't know whether that slows the economy. I don't know whether all the deregulation is going to spring load the economy. I don't know whether tariffs are already still ready to come back.
But basically, you're like Jay Powell at this point. We are data dependent. We are going to watch every day.
And we haven't gotten any data.
No.
Yeah.
And this is, look, this isn't even a clear Trump administration number because we're looking at January's numbers.
Right.
Trump didn't come in until January 20th.
But we do know we're at 6,100, basically, or just beat it on the S&P. So nothing's happened to give us any clarity there. The 10-year,
453.
Yeah,
and
that was like, oh, wow. That's
Treasury Secretary Bessent would like us to start watching the Treasury notes maybe as a report card for the administration, too. But this number today is going to be important. Tomorrow's number for PPI will also be pretty important. And we'll see where we go from there. It's interesting. We have seen presidents who have tried to pretty aggressive cuts before. Ronald Reagan wanted to, but he didn't have one house of Congress. So he couldn't do it as effectively. Don Rumsfeld wanted to do this when he came in as wanted to go into the Pentagon and really cut into things, but then 9/11 came along, and that kind of got brushed away too.
Right.
I'm talking about cutting things. Let's talk about the guy who's in charge. Well, he's not technically in charge of cutting things. He's technically in charge of finding the things to cut. President Trump signing executive orders in the Oval Office yesterday, and he was accompanied by Elon Musk and his son. Imagine you've seen the pictures, if not the video. President directing agencies to work with Musk's DOJ department to sign workforces and limit hiring to essential positions. According to the White House fact sheet, agencies are going to be permitted to hire no more than one employee for every 4 workers leaving the government. That's with exceptions made for law enforcement, national security, immigration, and public safety roles. Now, Trump spoke to reporters about the cuts to government.
Billions and billions of dollars in waste, fraud, and abuse. And I think it's very important. And one of the reasons I got elected, I said, we're going to do that. Nobody had any idea it was that bad, that sick, and that corrupt. And it seems hard to believe that judges want to try and stop us from looking for corruption, especially when we found hundreds of millions of dollars worth, much more than that, in just a short period of time.
It's not optional for us to reduce the federal expenses. It's essential. It's essential for America to remain solvent as a country, and it's essential for America to have the resources necessary to provide things to its citizens and not simply be servicing vast amounts of debt.
Two men also spoke about transparency and accountability. They were asked about Musk's DOJ department.
All of our actions are fully public. So if you see anything and you say, wait a second, hey, Elon, that seems like maybe that's, there's a conflict there. It's not like people are shy about saying that. Transparency is what builds trust, not simply somebody asserting trust. So not somebody saying they're trustworthy, but transparency, so you can see everything going on. You can see, am I doing something that benefits one of my companies or not? It's totally obvious.
And if we thought that, we would not let him do that segment or look in that area. We thought there was a lack of transparency or a conflict of interest, and we watched that also.
About how he said, look, I'm going to make mistakes. I don't know if you saw that part of the interview. He said nobody bats 1,000, but it was asked in the context of something that actually then went viral. I think this goes to the questions about social media and everything else. Where
I didn't think it did. The condoms?
Well, what was interesting?
Because I agreed with him that number one, I have no idea what $50 million worth of condoms looks like.
Well, they figured out per
big
person what it was.
That's a big number. So it didn't go to Gaza. It went to Mozambique. But I thought that the core finding was what are we sending $50 million worth of condoms anywhere for? And I guess It
was for HIV in Mozambique, but it wasn't
for
but it wasn't saying to Hamas.
No.
But I'm saying we can debate whether they should be sending them or not. That's a different question.
But it's a lot. 50 minutes. I just can't imagine what
I'm not here to defend the
total lot number. Of condoms.
I'm just suggesting that when somebody of his influence says something that is as factually, because effectively it was originally put in the context of
bombs
of Gaza, of Gaza in Palestine. It was in the context of Hamas. It was in the context of Israel. By the way, it created all sorts of rumors and speculation that the United States was trying to control the population of the Palestinians. By the way, that's what happened as a result of all this. And so when you get things that are that incendiary and that wrong in the social media space, even if you ultimately 2 or 3 days later, or even 10 hours later, land up in the community notes.
It doesn't shut off.
It doesn't shut off the sort of fire
but this is the
hose
world
of
we live in,
wrongness.
and we've seen conspiracy theories that are crazy, and we've seen conspiracy theories that eventually came true.
What they said yesterday in the Oval Office was so sound, it's hard to disagree with anything that they were saying. I wish that was the level of discourse that was there all the time. Elon's right. If you disagree with them, you bring it up. But
I think that's what they're trying for.
But sometimes when you disagree and you bring it up, you get called an idiot. If it were a more civilized discourse all the time like that, then of course this is exactly what we should be doing.
Well, it's a work in progress. I noticed that.
I'd also say one other thing about this. Most of the stuff that we're finding out about Doge and what they're doing, we're finding out because reporters, journalists are actually doing work. That's how this was found out. That's
the Mozambique thing.
But there's lots of examples of what's been happening inside Doge that's happened as a result of journalists. At the same time that those journalists, I'm sorry to say, have been targeted in some cases either by the administration or by Musk himself. And so that's a
It's
problem.
a civilized discourse. If you could have civilized discourse and transparency where this was exactly what was happening, that's great. But they said yesterday, I don't disagree with any of it.
I think that that's what the reason the press exists is for things like this. I just wish it was applied evenly and that the press hadn't taken 4 years off. I've said that again and again. But I do think the press needs the media needs to pace themselves. It's going to be 4 years. I mean, their heads are going to explode. I like X's coat is what I thought. It was like a little man's like trench
and his
coat.
hair kind of combed over.
But he's like, if that had been me, I remember sort of what I was like back then when, like I told you, when I'd be hearing President Kennedy and it's like,
that's what I was going to say.
Who is this guy? Why is he boring me with this? So he's in the Oval Office with the President of the United States and the richest man in the world. He's like, these guys are just so boring. Will they ever shut up? When can I go?
When he's sitting on the ground.
Right, and he's digging for gold.
It's like JFK Jr. pictures under the desk.
But it was, exactly. Remember, but it was kind of, I happened to be watching the whole thing, and it was pretty, learned a lot from watching. Coming up, we're going to get you ready for the key inflation data. January CPI due at 8:30, and it comes just ahead of Fed Chair Jay Powell's next round of congressional testimony predictions next. Then later, former House Speaker Kevin McCarthy joins us on the cuts to the federal workforce, the government funding fight brewing in Congress, and much more. Box. We'll be right back.
CNBC. Live ambitiously.
The climate crisis is a gun to our head, so we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
Initiates every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil of the generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future, only on CNBC.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CNBC, because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side reporting on the news. I love bringing transparency to complicated topics. I think it's so important for us to deliver the right news to our audience so they can make better investment decisions. San Francisco was built on ambition, a belief that anyone can disrupt any industry and change the world.
What made you want to do robotic surgery?
When I was training to be a urologist, robot surgery was one of the most exciting and developing space. I can show you around. This is the console. Basically, it's like the flight deck where I use my hands to be able to control, to maneuver the instruments in various directions, even move like a wrist. The pedals below looks a bit like an organ, so you must be able to use both your left and right feet all at the same time to control various instruments. The various energies you use to cut or to stop bleeding, etc., and also to control the movement of the camera. You're able to have stereoscopic vision, so you have depth perception.
But what if the robot breaks down? Yoon credits much of the heavy lifting to his team of nurses. Both surgeons and nurses in Singapore are trained in countries like Japan and the US to operate and troubleshoot the Da Vinci robots.
Frank Holland, Worldwide Exchange, CNBC.
Squawk Box, Vice President Vance and Treasury Secretary set to meet separately with Ukraine President Zelensky this week. This comes as part of a broader push to try to end the war with Russia and secure American access to Ukraine's rare earth minerals and energy resources. I want to talk about all of this with Michael Froman, Council on Foreign Relations President. How much closer are we or aren't we?
Well, yesterday's decision to release Mark Vogel was a good expression of good faith by President Putin. This is an important week. We've got Secretary Hegseth is in Europe meeting with Europeans about Ukrainian security, and of course Vance will be seeing Zelensky later this week. I think the real question remains, what's going to be the security arrangement for Ukraine? The Ukrainians going to give up 20% of their territory. They've known that for some time, but they're still looking for something like NATO membership, and if the administration is not willing to support that, what kind of security guarantees can they offer to give the Ukrainians some sense that the Russians aren't going to just come back in as soon as the Americans turn their attention elsewhere?
So what do you think is on the table? What's even possible?
So with a lot of support, particularly from the Europeans and some from the U.S., the Ukrainians themselves can put in place a multi-layered defense system that digs in, creates real defensive lines, provides air defense, makes sure that they have the facilities and the capabilities they need. I think the Europeans need to put some boots on the ground, or at least have them ready to be put boots on the ground. They've done this before. They've got some joint expeditionary forces. They have the ability to draw on NATO troops for European Union.
Do you think this is going to be a long, drawn out, and this is going to go on forever, is what you're saying? Because once you're into the conversation, we need a defense system. Well, the Russians are coming back, basically. This is like a never-ending war, then.
You know, I think there can be an armistice, and I think there can be a defense system that deters Russia from coming back in. But in terms of the conflict is going to be there for a long time. Russia has its eyes on Ukraine, and Ukraine is very vulnerable. I think the question is, if Ukraine is not going to be in NATO, can NATO be Ukraine? Can NATO troops from the European Union?
What about the whole rare earths situation?
Well, some of it is spread around Ukraine, but a lot of it is in the part that's currently controlled by Russia or close to the area that's being decided. So if President Trump really wants access to that, he's talked about $500 billion of access to minerals, then we're going to have that access to that part of the territory as well.
Michael, what do you think of the Treasury Secretary being sent? I mean, that surprised me a little bit.
You know, on issues like the rare earths and oil and energy is the lead economic advisor.
It's indicative that this is a big part of the negotiation.
That's right, and I think leading the international economic peace makes sense for him.
Yeah.
Why hold out for 4 years for medical marijuana? I mean, that's just like in Biden. That just what was that?
Look, it's
Brittany Griner.
Russia has a practice of got unlawful detentions. You know, we've had other Americans held.
To mess with the United States.
Well, you know, what they say is this American went to their soil and violated their law. And so, you know, they believe in the rule of law. They arrest people.
Big believers. Big believers in the rule of law.
But you're right. It's holding hostages for potential trades, and that's what's going to happen now. And evidently, the U.S. is going to release some Russian prisoners as well.
Oh, we didn't get.
They haven't named the person
yet.
They haven't named the person, but they've said there's going to be some.
That's what they did for Brittany Griner too. People who have been accused of espionage here.
Well, we got you here.
Yes.
Gaza, the next, the Riviera of the Middle East.
Yeah.
What do you think?
Well, look, I don't think it's a feasible plan, and the King of Jordan and Saudi Arabia and others have expressed that to the administration. There's no appetite among their countries for a resettlement of Palestinians away from Gaza into their countries, and
what is the impact of sort of ruminating on these ideas aloud, even if they're not accepted wisdom of the crowds from elsewhere? I mean, beyond this sort of, right, can you speak outside the box? I mean, right, he would say, the administration would say, President Trump's an out-of-the-box guy, he's going to throw out all of these ideas, and then there's another wing of the world, I think a lot of liberal Democrats who think this is dangerous to even say these ideas loud because it undermines the credibility of the United States as it relates
what's
to
it really undermine in terms
well, then that's my question.
Of the possibilities for Gaza? I looked at it and I'm thinking, it's unsavable. It
wasn't a great place to live before October 7th.
Now it's so much worse.
And
then you worry that even if you go and rebuild it and get rid of the tunnels and get rid of all the unexploded bombs and everything else, then Hamas is. But look, seeps back in and we do it all again. Israel does it all again in 5 years.
But I think your point is a good one, which is I think the president has this unconventional way of putting ideas on the table, and there's an element of truth, or there's a nugget of something that bears attention. So, buying Greenland, I don't think that's going to happen. But Arctic security important? Should we be paying more attention to it? As Russia and China are paying attention to it? Panama Canal, that's not going to happen. But should we be concerned about China's role in Latin America? Sure. So I think he puts these ideas out there. It changes the dialogue. It gets the attention of the world. And then hopefully we can find a way forward that addresses what some of the underlying truths are.
So you think it's actually good that he's doing this? That's the question.
I think it's highly disruptive. But I think it does change the narrative. And I think it does get people's attention, saying, okay, the U.S. is actually, as you said, thinking outside the box. Now, outside the box can have a lot of negative implications for people like the Palestinians who do that at their home. But I think at the same time, it gets the attention of the other Arab nations to say we've got to do something differently when it comes to Gaza.
What we saw yesterday, I think there was a pretty immediate response that Hamas said they want to work towards the ceasefire. I mean, is it the factor of, okay, there's a little bit of crazy here, we don't know what's going to happen, we want to...
There is a madman theory of relations with President Nixon, Henry Kissinger used it well with others to say, I can't control this guy, you never know what he's going to do. I think at some point it does undermine both the credibility of the presidency and the credibility of the United States if we put stuff out there and then it ends up falling by the wayside.
The red line.
Right.
Yeah, no, exactly right. I mean, you might be critical when a previous president set a red line in Syria and then didn't follow through on it. Now we're creating red lines every week, whether it's tariffs, or ceasefires or something else. And, I think one has to be careful about that.
Michael, I want to thank you for coming in this morning.
Thanks for having me.
Good to see you. Appreciate it. It is just 7 a.m., exactly 7 a.m. right here on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin, along with Joe Kernan and Becky Quick. Got a whole bunch of big stories to tell you about this morning. It's a fire hose of news, as it has been virtually every day the last 20-plus days. President Trump signing executive orders in the Oval yesterday, accompanied by Elon Musk and his son. The president directed agencies to work with Musk's Doge department to slash their workforces and limit hiring to essential positions, one new hire for every 4.
They're getting a good deal. They're getting a big buyout. And what we're trying to do is reduce government. We have too many people. We have office space. It's occupied 4%. Nobody's showing up to work because they were told not to. And then Biden gave them a 5-year pass, some of them, 48,000 of them, gave them a 5-year pass. 5 years, you don't have to show up to work.
We're going to have so much more on Doge, federal spending, tech, and AI later this hour, along with carried interest with Joe Lonsdale. And the markets are gearing up for today's CPI data, giving a first look at inflation in 2025. The core rate expected to have slowed slightly last month. Investors also going to be watching Fed Chair Jay Powell, who's back on Capitol Hill for another day of testimony on the economy, so we'll keep our eyes on that. And regulators, they intend to impose a $1 billion special assessment on private insurers to shore up the state's insurer of last resort. That's also known as the FAIR Plan, following the devastating LA wildfires that could end up costing insurers an estimated $75 billion. State Commissioner saying that the assessment is necessary to continue paying out claims to fire survivors.
Take a look at the futures one more time this morning. Dow futures off by about 45 points. S&P futures down by 3.5. The NASDAQ indicated up by about 10 points. I want to get over to Frank Holland. He's been taking a look at this morning's pre-market movers, and what are you finding? Frank.
Hey, good morning, Becky. We're going to start off with an earnings move. We're taking a look at shares of Lyft right now. You can see they're moving lower, down double digits, more than 12%. After fourth quarter results where they reported a miss on revenue, but EBITDA did beat estimates. One factor on the results, the company said it reduced surge pricing during the quarter. The rideshare company also giving gross bookings outlook for the current quarter that was below estimates, making a number of other announcements, including a plan to increase in-app ads to boost revenue, also a share buyback plan of up to $500 million. Again, shares down more than 12%. Also, Lyft CEO is going to join you guys in just about an hour to talk about the quarter and much more. He joins Squawk Box at 8:20 a.m. Eastern Time. This morning, we're also looking at shares of Tesla. Lower gain this morning. news, partly at least, the Chinese EV maker BYD is partnering with DeepSeek to develop autonomous driving tech. Shares of Tesla down about 0.5% right now. According to this report that's come out, BYD will add partially automated features to new models that will allow for autonomous parking and also driving on highways. Take a look at the chart here. You can see Tesla year-to-date down about 19% on a 5-day losing streak. Again, shares down year-to-date about 19% right now, down about 0.5%. We're also looking at shares. That stock surging, also another earnings move from online beats. EPS came in at $1.19 a share. The street looking for 91 cents. CVS also giving full-year guidance that was in line with shares are up just about 9%, just over 9% right now. CEO David Joyner said the meaningful recovery in its Aetna business that provides health insurance plans. He also added, in part, we have momentum as we enter 2025, and we are making progress to be best in class in total cost of care and customer experience. In my first 100 days as CEO, I see an organization ready to move forward and help customers, clients, colleagues, and patients win. Joyner took the top job back in October, previously running CVS's pharmacy business. Again, shares of CVS, they're up, well, right now about 8.25%, but again, moving higher. Back over to you.
Yeah, it is a big move. Frank, thank you. We will see you in just a little bit.
Shares of Biogen whipsawed just in the last few minutes. Let's show you what's going on here. The company's earnings coming in at $3.44 a share, 9 cents better than its revenue of $2.46 billion. Now that topped expectations of $2.4 billion. But for the full year, Biogen sees earnings of 15.25 to 16.25 a share. Now estimate of 16.34. It's also expecting total revenue saying to decline now by mid-single digit percentages for 2025, and that compares to the estimates of a decline of 2.1%.
Looks like you could ski on that baby there at the double diamond, triple diamond, right?
It's like a double blue.
Double blue.
Double blue. It's not steep enough.
No,
it's not even a black.
I think that is when you're actually on the slope, it looks steeper than it. Not much different in reality than that. Do you think?
You know, as you look at it, just on year 24, coming into like half the year, that could be steep for
okay.
Like black.
Yeah. Okay. All right. Coming up, market historian and Wharton professor Jeremy Siegel on markets. Haven't spoken in a while. I don't know if we've seen him this year. That'll be good. And later, a wide-ranging interview with Palantir co-founder Joe Lonsdale. That's always fun. Squawk Box will be right back.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea.
You'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
Geopolitical stability, I think, is good for growth. It's good for peace.
Our principles are very clear. No agreement on Ukraine without Ukraine. It is impossible to keep NATO safe, the whole NATO territory safe. Yes, for now, yeah, we can do that, but not in 4 or 5 years.
The risk is to the downside when it comes to growth. We will be very attentive to the data.
The structural weaknesses of our economy absolutely have to be addressed. I wouldn't have been as successful as I was without my team.
And I take that throughout my whole career, and I take it to this as well. So with my family, it's all about my team for me.
Before they talk to Wall Street, they talk to John Ford and Morgan Bell.
Welcome back to Squawk Box. During a press conference inside the Oval Office on Tuesday with President Trump, Elon Musk defended Doge.
What meaning does democracy actually have? If the people cannot vote and have their will be decided by their elected representatives in the form of the president and the Senate and the House, then we don't live in a democracy. We live in a bureaucracy. So it's incredibly important that we close that feedback loop, we fix that feedback loop, and that the public's elected representatives, the president, the House, and the Senate, decide what happens, as opposed to a large, unelected bureaucracy.
Joins right now is Joe Lonsdale, ABC founding partner, co-founder of Palantir. There's about 100 things that we want to talk about, Joe, including Doge, including OpenAI, and yes, carried interest, given our conversation on X over the weekend about that. But let me start on the OpenAI Musk front, if you will, because I know that you're a backer of his proposal, or maybe we should call it a hostile bid for OpenAI, which is a not-for-profit. Tell us how it came about, what's your involvement in it. I think we're all trying to understand what's really going on there.
Good morning, Andrew. Well, listen, it's been a really fun 20 days, right? I think this administration, with Elon's help and with President Trump in charge, is winning more than we've ever seen before in 30 years. We've done what we haven't, we couldn't do this much in the last generations. And for me, I just think this is such a cool time for our civilization. I'm really bullish on what Elon's doing. And listen, I know both Elon and Sam, and Elon really helped create OpenAI. What Sam's done with it's amazing. If Elon wants to do something, I'm gonna support him, though.
Just from a legal perspective, I spent the past 48 hours trying to look through what's happening here. It feels like, just so we're on the same page, that the bids have an arrival insofar as the board of OpenAI, which is a not-for-profit, given its current structure at least, has actually zero obligation, fiduciary duty, if you will, to return to the investors who've invested in the subsidiary. So just because there's a bid, it doesn't mean that it has to be taken or even taken seriously, because the only duty they have is to the quote mission of the not-for-profit charter, which then raises all sorts of questions about what the bid is really all about. A lot of speculation that really what it is an effort to try to create a floor or a valuation metric, which would make it tougher, frankly, for OpenAI to become a for-profit, because some of the AGs could get involved and start to look at fair value, and they might get the bid as a potential metric to sort of set against. Do you feel like, can you just speak to what's happening here? Because I think everybody who's looking at it just on its face says it can't really be what it is.
Well, listen, this is obviously a sensitive legal situation, Andrew, and I'm not spokesperson for what's going on, so I want to be really careful what I say. What I will tell you is that Elon really helped create OpenAI, helped create the mission at the very beginning. Probably wouldn't without him. And the mission was that it's supposed to be open, and it's not, but yet it has done amazing things for the world. And listen, if Elon were to be able to buy, I think it'd be a great thing for the world. Some people disagree. He's making a serious bid, and when my friend, who I think is right now the most important person in the world, wants to do something, I gotta support him.
Let's talk about Doge. I think there's a lot of people that are super excited about trying to get to the bottom of and find all sorts of things in the government that maybe we shouldn't be spending our money on. That's the one side of it, and then obviously you've seen some of the Treasury secretaries and others, write public letters in the New York Times and elsewhere, frustrated and concerned about what they would say is the transparency of the process, not about the good news of the transparency of what we may learn, but how this is all being done. What do you think?
Well, what I think is that, like I said, in 20 days we've done what we couldn't do in multiple generations. We have this permanent bureaucracy, Andrew, and it's just shocking what they're uncovering. Like, I knew there was waste. I'm one of the only guys who've been speaking out very boldly the last 10 years about how badly this needs to be cut, how badly we need to get into these things. There's even more waste than even I would play on the most extreme side of people saying this is ridiculous and broken, right? So, I mean, it's just amazing what they're uncovering everywhere they go here. I think they are being quite transparent about the things they're finding. I think a lot more will continue to come out. And I mean, what we know is not being transparent is the mainstream media right now is not being transparent about how ludicrous these things are that they're finding, because it's afraid to offend its readers and its listeners on the left overall. I mean, we're living in different realities in our country right now, because one side's reporting, hundreds of crazy things. There's scams around the world. There's all this money clearly being wasted. There's all this grift being stolen. There's money going to media as well, as you've seen, which is really crazy. And the other side's just not even reporting on the things that are being found. So, in general, I think this is amazing what they're doing. I think they should keep doing it really boldly. The executive order yesterday, 4 employees out for every employee in, they're going to make it more efficient. It's very clear these employees are not working efficiently. I mean, this is awesome stuff. And what's happening, Elon made a great point. I was involved as a kid a little bit. Whenever you'd turn off fraud or grift, or change something, the people who would scream the most were the fraudsters. And so the noise is mostly right now coming from.
Can I think I'm gonna. I hope you will think I'm coming to this from a place. I know you grift, terrible. And I'm very supportive of the idea of trying to expose all the grift, reporting on it quite regularly. Actually, I think that the question, and I think we should continue to support trying to find as much grift as possible. At the same time, I would think for the purposes of exposing that grift and making it all work as a country, you want the process to be as credible as possible. So to the extent that there are people who say to themselves, not about whether they're worried about what the fraud is or not, but to say, are these things going, is data being used in some way we don't know? Is it going into an AI system that we don't know about? Are the people who are finding the grift government employees? They vet it. I mean, isn't it best? Couldn't you walk and chew gum at the same time? Meaning, get all the grift, expose all of it in the best way possible, and have the process be so credible that everybody says, "Oh my goodness."
Never. You could never have everyone say that.
Well, that's what I'm asking.
Joe's right, they're going to be angry. But listen, Andrew, I mean, what we had to do here is that there's been layers of bureaucracy. Like, I have mentors in the Reagan administration who came in looking for these things, and those people were not technical. And so when they went to the bureaucracy and they asked questions, there's so many ways of obscuring and blocking and deterring. And so what Elon did is he got root access, and he went to the tech systems themselves. No one has done this in ever. Like, no president ever has had tech people around him. And they went to the systems, and they started finding things like, oh, my goodness. And these people who work for the agency tried to confront them and said, no, you can't look at the systems. You're getting around all of our ability to block all this stuff. We thought you'd never actually get to see any of this. And they're freaking out because they're looking. And so it's very transparent. They went to the systems. They actually saw the payments. And the payments were all crazy shit. There were payments to people with same social security numbers. There were payments to people with no social security numbers, to 100 billion. It's everywhere. There's payments to Internews Network, which is training media all around the world how to have a certain point of view that's a very left point of view. There are payments to protesters around the world. There's all this stuff that's crazy, and they're being very transparent. Yes, we went to the data, we found it. It's only 20 days. Like, give them a chance. They're gonna put all of this out. They already are putting a lot out. I mean, I think this is amazing, but people want to slow them down. They want to slow them down from stopping their grift is really the biggest question here.
Hey, Joe, I am all in favor of stopping all of those things that you just listed. My concern comes in with the idea of freezing payments, let's say, to the NIH, to cancer payments, some of the legitimate aid that was going out through USAID to help starving kids in Africa, some of those things. I'd love to go after the grift and the fraud and the crazy wasteful things that you just laid out without freezing everything and assuming everything is guilty until proven innocent with some of these issues. There are legitimate expenditures.
I think the NIH thing you're seeing is that we're changing overhead to 15%, as opposed to, if you and I were going to start something for cancer research for our family, we'd give them the money to see if you use a little bit for overhead.
Right. 15
or 20%. Fine. But it used to be 60, 70%.
I have a problem with that, but we're talking about some stuff that was already promised from last October with the fiscal year and different things. I get changing things going forward. I think retroactively changing things is a little more complicated. Makes perfect sense to lay that out. And in the meantime, there are freezes and serious questions at universities and at research institutes about what they can and can't do. And it's creating a backlog for stuff in some cases. Again, where people are going into trials thinking that this is their last try. I mean, that to me, Joe, I get it, and I understand getting to 15 or 20% because that is what private donors pay. Understand all of those things. It's just the chaos that ensues in the meantime around stuff that is very legitimate.
I think the legitimate stuff needs to be turned back on. I think you'd be surprised how much is actually not legitimate and how much is actually being wasted. And I think there's going to be a lot of yelling, pretending things are legitimate that actually weren't. But you listen, my friends work with the Bush administration, and they save millions of lives in Africa. I do think Africa can now pay for more of this themselves. South Africa is spending money, suing Israel is spending money, supporting political parties calling for the death for white people. Maybe they should redirect that money to pay for their own clinics. And so in some of these cases, we shouldn't be paying for them anymore. But I agree with you. There were some very good things that went on too. I think the good stuff will get turned back on, but there's a lot that needs to be turned off first.
Do you think one just related thing? Do you think just in the whole process that there should be either not more sensitivity, but to be more careful? We were talking earlier about this comment that Elon had tweeted out about the $50 million of condoms that was originally sent.
It said there for Gaza. Turns out there's a Gaza in another part of Africa, Andrew. It's still probably too many condoms
and I get it. But, and the reason I mentioned this though is, I remember when that tweet went out. It went out everywhere. I remember reading about it. Everyone was reading about it, talking about it, saying this is crazy. There were people talking about, is this an effort to control population growth among Palestinians? I mean, it turned into this sort of wild conversation, and then we realized after the fact that it's not accurate. And of course, most people are never going to realize it wasn't accurate. I mean, maybe they will now because we're talking about it, and it was in the Oval Office.
Listen, there was also stuff going to Gaza that was ridiculous. This is obviously slated.
By the way, I'm not suggesting I'm not suggesting the underlying question about whether we should be spending $50 million on condoms in Mozambique or in Gaza. Gaza is the right thing. That's not. But
the substance is. And why worry about on the edges? That's not the first. Yeah, that's not the first thing I think of. First thing I think of is, wow, there's a lot of grift. This is ridiculous. Shouldn't be happening. And there'll be some mistakes, as Elon said yesterday. But that's not what I focus on. Is just talk about throwing the baby out with the bathwater.
No,
that's what you come away with.
I just think it's a question about how careful either Elon or others need to be, given the
slash and burn a lot of this stuff.
Careful for 50 years, right? You have a bunch of white flag Republicans. You have a bunch of people on the left making money off of it. People on the right making money off of it too. Everyone wants to be careful and keep it going. That you're not going to get perfect answers in life. I think this is by far the best thing for civilization is to very boldly confront this. And this is more, I guess, of a tech world way than a DC way. You're probably right. There are going to be some things that need to be turned back on. There's going to be some things that were mislabeled that no one knew what they were. But it's a mess, and so it's a mess, and it's such a mess that I think being bold is the right answer. I get it's going to have a few mistakes, but I'd rather have those few mistakes and fix them.
And I think, look, part of this may be very deliberate, because part of the Washington grinding machine is, don't worry, we will survive this too. We'll live through this, because the Washington grinding machine always slows everything to go stop and nothing gets done. My guess is that this was a pretty deliberate attempt, or a pretty deliberate decision to do it this way, just to make sure that you actually make progress.
Being careful and slow in how we get to Mars. So, yeah, it is what it is.
Joe, I mean, the deep state's still going to win, no matter how. Don't you think, Joe? I mean, despite.
I think met their match.
Maybe they met their match,
but I think they met their match.
You can't. I just don't think you can possibly go too hard.
We were going to talk, and we still want to talk about carried interest. That's what we originally had this debate.
Yeah.
Make your case, because a lot of people, you said it. Even in your business, don't like to come out publicly in favor of carried interest, or at least to speak, vociferously about it. You think it is a very important tax treatment for your industry. So the floor is yours. Make the case, and we can talk about it.
Listen, I think President Trump is winning every day right now. I'm a huge fan. Tax policy is a great way to use, like you said, to piss everyone off of me. But listen, there's a couple things I'm thinking of changing. The biggest one is the state and local tax section. That's $1 trillion question. The carried interest one is like a $10 billion question versus a $1 trillion question. So it's a very small amount of tax. And what people are saying is that it's unfair that we get long-term capital in general is not because of a fairness issue. If it's about fairness, let's give more money to middle class and working class. Percent aligned. President Trump's going to do that with tips and et cetera. The reason we have long-term capital gains as a framework is it unlocks capital freeze problems. And so when you venture capital or in long-term private equity, when they have a win, they've been building the company over multiple years, then the shares as the carry. So just like the founders, just like the employees, just like the investors, they get those shares. And if you have a 23% rate, it's much likely to reallocate the money than if you give a 60% tax hike and have a 37% rate, which is what some people are talking about. And so that's the same reason we have long-term capital gains in general. You don't want to do capital freeze. It'd be crazy to do a 60% capital gains effectively tax hike on these people who own shares, who are the innovators in our economy, right when, as JD's talking about, AI is going to make us more prosperous. It's going to be really good for our country. We want to reallocate to new projects.
Okay, Joe, here's where I'm going to come on the other side of this. Capital gains was built to incentivize, as I think it should, more investment. We are trying to get Americans to invest their own capital, not other people's capital, but their own capital, and we give a better tax treatment for that. Ordinary income is for your labor. Everybody's labor, I believe, is the labor. I don't believe there's a special form of labor for one particular class over somebody else, which is, by the way, what carried interest at this particular moment is. As for incentives, to me, assuming that you and everybody in the private equity and venture capital business actually are committed to your own fiduciary duty for your investors whose capital you're allocating, it shouldn't matter what tax it is for you personally, because the argument should be that you would be making those investments, buying and selling assets based on your fiduciary duty to those whom you represent.
You're missing something there, Andrew. When we have a big win, what happens is you distribute the shares for almost always in the biggest wins, and so you end up with shares actually, and it's not. And you've been both both a new tax and old tax. You don't get taxing on those shares right away. You end up with those shares. Now the question is, when you sell those shares, are you going to get the 23 or the 37%? The reason it's 23 is because you might own those shares another 5 years, and then you pay when you sell. That's how it always works now. It's going to work even under the new code. And so that's really important. It's like you're owning this thing you've been working on. You want to have the capital gains tax be the same reallocation incentive. I'm talking about system incentives here now. Totally agree with tax rich people more. Stop letting them take money offshore for reinsurance scams and hedge funds. There's so many ways that we should tax rich people more, but the incentives are long term when we get shared for something.
Well, with the exception of founder shares, I was going to say most employees don't even get this benefit, which is to say, if you have RSU, in most cases, most options, there are certain kinds of options, but that's limited to $100,000. Even those folks are not getting the benefits. So to the extent that the venture community or the private equity community says, well, look, like we're an employee of the company, we're giving our sweat equity. Every employee in America is giving their sweat equity to all sorts of businesses. That's what they're doing. And they pay ordinary income on their sweat equity. If you put money into the company, and if you do, which I know you do, that portion of your capital obviously should get paid at a capital gains rate, but I'm not sure why this particular construct is the one construct in the universe where effectively the sweat equity should be paid at a different rate.
Well, I've helped thousands of employees who work for me buy their options and get long-term capital gains, and so there are thousands to do that. You're right. Later stage in the company, it's harder. But look at the system incentives. We're arguing about $10 billion here at most over 10 years. I think the bigger thing that'll piss all your viewers off is the state and local tax deductions. It's $1.3 trillion. I don't think they should get that in New York and California. But now my partners in California will be angry at me.
Joe Lonsdale, we love the conversation always. We deeply appreciate it, and we love doing it here on TV, and I enjoy doing it. See you, sir.
All right, still to come this morning, former House Speaker Kevin McCarthy on the budget battle in Washington. And later, Lyft CEO David Risher joins us after reporting results last night. Shares of the company are down after a disappointing outlook. Squawk Box will be right back.
Delivering alpha. Getting the highest return on your investment.
Our goal: provide our viewers, listeners and readers with the smartest ways to navigate the markets worldwide.
We highlight alpha opportunities from
by speaking to top investors with a proven record.
Getting the highest return on your investment.
Stocks to fixed income, ETFs to alternative asset classes.
Where will the next great alpha opportunities come from? And how can you make sure you're ready? Delivering alpha Coming soon to Squawk Box.
Standard Chartered Global Private Bank, where your life's work lives.
For people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world. Squawk Box and CNBC, it is my home. It's the greatest job in the world. As the futures, this one, not much happening. 22 minutes till we get to CPI, so things could change after that. NASDAQ's up. As far as treasuries, we did see a little bit of a bump yesterday on some, maybe the Jim Powell comments. 454 now on the 10-year. President Trump just posting on Truth Social. Interest rates should be lowered, something which would go hand in hand with the upcoming tariffs. Let's rock and roll, America.
Huh.
Hard to disagree with the last comment.
So, well, let's rock and roll, America?
Yeah. You're going to disagree with that?
No, it's just interesting on this day that Jay Powell is going before
And we'll see
Congress
what the
again.
inflation.
We'll see what he has to say about it.
Real guy. I mean, the beautiful Gaza Strip. I mean, he's a real estate guy. For more on the markets, let's get to Mike Santoli at the NYSE. What's going on, Mike?
Yeah, Joe, I mean, look, this market is just incredibly well behaved, if you want to call it that, in balance. Look at the S&P 500 kind of taking in all of these sort of policy hints and all the sort of volatility and maybe what's going to come on that front and staying pretty steady. We've gone above 6,100 a few times each of the last 3 Fridays, never held above there. So we're kind of bumping up around that level. You do it with fewer very large stocks propelling us to the upside. Take a look here at the S&P 500 excluding the Magnificent Seven. Yeah, there's an ETF for which year to date is handily beating the S&P 500 itself. So obviously been weighed down by things like Tesla. Microsoft hasn't really done much. And so this broadening of the market away from those mega cap tech stocks, everyone's been calling for. It's sort of happening. It's a little bit below the surface. I've been skeptical that it can happen kind of on the fly with the overall trend just continuing undisturbed. But so far, that is what's going on. Did want to point out, too, though, there's still this really active retail trader segment of this market. Every day, there's some kind of new penny stock that starts to fly. Crypto, obviously, very active. Take a look at Robinhood, which is going to be reporting earnings after the close today, alongside its competitors, Interactive Brokers and Schwab. This is a 6-month chart. Robinhood up close to 200%. It's just massively valued per account and per dollar of client assets relative to those other guys. But everyone feels like it's a leverage trade on that retail excitement, Joe.
Okay. They told me to no crosstalk, Mike. I'm sorry. We're both.
Well, we always listen, right?
We're both poor for that, but we got to go. Thanks.
Coming up, we got CPI inflation data. 8:30 Eastern Time. Next, former House Speaker Ken McCarthy is going to join us, talk about the GOP and how it's preparing to kick things into gear on President Trump's biggest priorities. We'll break it all down with him after this.
CNBC. Live ambitiously.
I just took a shower above the couch. You know why? Because it is the MRA 380.
Watch the markets open. Brought to you by Emirates.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CNBC. because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side, putting on the news. I love bringing transparency to complicated topics. I think it's so important for us to deliver the right numbers to our audience so they can make better investment decisions. San Francisco was built on ambition, a belief that anyone can any industry and change the world.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities
When we took a break, I thought that was the end of it.
to the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo. A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
We are seeing more agility in many other territories than the European one. Luckily, the good is that I think not only we in the foundation, but I think in general in Europe, people have woken up to that.
27 different countries, even my home country, Germany, they are way too small to have that seat on the table. And that's, I think, what the European Union missed out on, to have a joint foreign economic policy and say, look, there are the standards, there are the rules, we want to engage together for the greater of the world. And that's that basically means that they need to get their act together quickly.
Europe is lagging in growth. The UK is ahead compared to Europe, still not as strong as the United States. But both these economies can use growth. And part of getting that growth is to unleash the capitalist instincts and what we call animal spirits into their economies, which means a better balance between regulation and opportunity.
Lyft shares dropping sharply after the company released fourth quarter results. Lyft forecasts current quarter gross bookings below estimates. Joining us right now for us on CNBC is the CEO, David Risher. It's great to see you, David. Let's talk about these earnings because in many ways, you know, it's been still a remarkable up. And yet, in terms of what the expectations were, a little lighter than some had expected. What say you?
Well, good morning, Andrew, and I have a lot to say. So today, you got a big audience. I'm not going to be talking to traders out there. Traders, you are on my fecal roster today. But I do want to talk to team members and investors. Here's what happened. Team members crushed it, right? So this is the year that we delivered over 44 million people and got them where they need to go. Those are the riders. We did $16 billion in bookings. That's an all-time high, of course. We have more high-frequency riders than we've ever had. We've got drivers who like 60% of the other guy. We profitability this year for the first time ever. We printed $766 million of cash this year, free cash flow positive for the first year ever. So it's a frigging machine, what we have built together. And I think what the future holds is great because it's a huge market and we're doing a great job. So then we got to figure out how to get the traders sort of on the bus. But that's the
that's what I was going to ask. Do you think that the analysts, do you think that you missed, or do you think the analysts missed?
Well, I mean, look, I can't speak for the analysts. I can tell you this: we have never been in a stronger position, right? As I say, we're executing. Look, we will pick you up. Here's the fact: we pick you up now a minute faster on average than we did a year ago. By the way, that's actually about 30 seconds faster than our bigger competitor, which is a big friggin' deal. And we're just getting started in terms of upping service, which is really our focus. Right. And we did it profitably. We put in cash. So that's kind of my focus.
Talk about it just from an operational perspective. How do you do that? Meaning, how is it that you're getting to the rider a minute earlier than I think what you're arguing Uber is doing without telling them?
I mean, we earlier did it a year ago and about 30 seconds faster than the other guys. You know, we do it in so many ways. From the minute you open your app, our math guys are behind the scenes trying to figure out what the closest match is. We're trying to give drivers offers. Here's the thing. If you give drivers better offers and pay them more, they will accept rides faster and they'll cancel less. So it used to be 2 years ago when I started, drivers might cancel 15% of the time, you know, which is you get that kind of weird thing where it says your driver's canceled, we're finding a new one. Super irritating. Now people do that a lot less because we give better offers and we do it more clearly. That means they can pick you up faster. So it's everything from modeling to sort of human behavior, and we're just doing it in an excellent way.
Okay, so that's on the operations side, and that's the good news. Walk us through just what the impact of this Delta partnership going to Uber, though, means, because I know that's there will be an impact in Q2.
Yeah, it'll sort of be a 1% to 2% impact over the rest of the year. Look, partners from time to time change. You know, I always say I've been married 29 years, so I'm not a big change out the partner guy. But sometimes people reevaluate, they kind of see something different, or they kind of want to go a different direction. We've got a great set of partnerships that we're super proud of. DoorDash, one of our newest partnerships. By the way, we just launched the DoorDash partnership a couple of months ago, and we've already given 8 million rides to people who are Dash Pass members who want to ride on Lyft and get a great deal. So, you know, partners kind of shift around a little bit, but the Delta piece will cost us maybe a point or two.
Do you wish that you would be able to keep that? Would it have cost you too much to do it? What happened?
It wasn't so much that. I think they were looking for something a little bit different as they refreshed their SkyMiles program. We've got other partners that we work with just as well. Yeah, I'd say that's kind of reaching sort of the bigger point. I think a lot of people, of course, it's human nature, right? You focus on sort of the short-term stuff. But when we look at our 3-year goals, we're so much on track on that. I think that's the bigger thing that we tend to look at.
Okay, so let's go out to maybe 5 or 10-year goals and talk about autonomous, because it's the other. I know it's a ways away, but it's not that far away.
Right.
You have a partnership with Mobileye. Uber, obviously, partnering with Waymo. Make the Mobileye argument to us.
Sure. Yeah. So Mobileye is one of the world's great sort of tech companies when it comes to self-driving and really driver assistance technology, right? I mean, driver assistance is lane assist, it's smart cruise control, all these sorts of things, and they're in 800 different vehicles today. They've been early pioneers in self-driving. They were actually Tesla's earliest partner before Tesla decided to go their own way. And they're a good company. So we have created an arrangement with them where as they build their tech, when their tech shows up in, pick a car, might be a Volkswagen, might be a BMW, might be a Hyundai, who knows. those cars will be Lyft ready. They'll all be able to go on a Lyft platform and start, kind of earning money for you as a self-driving car if that's what you're looking for. We also added a new partner 2 days ago called Marubeni, big Japanese trading company, and they're in the lease financing business and the sort of fleet operation business. And so they'll be great partners to help commercialize these types of deals.
David, we got to go because we got data, but I do have to ask you, and I think you know this, Waymo, just their technology is way out front. I think it's almost empirical right now in terms of what they've been able to do, even relative to Tesla.
Yeah, look,
and
Waymo
you would put
is
Mobileye even behind them. I mean, just in terms of where things are.
No, for sure. Look, Waymo's doing amazing work, and we talk to all these companies all the time. There'll be a lot of different technologies when it comes to self-driving. Already today you've got Waymo, you've got Cruise, of course, although they're not operational.
David, I'm sorry, we got to run. The futures are tanking based on some data that's out right now. You're now looking at the Dow futures off by about 222 points. Let's get right to Rick Santelli. He has that CPI number.
Yes, it's hot data. We look at yields moving up, pre-opening equities moving down. January read on CPI up 0.5%, up 0.5%. We're looking for up 0.3, in the rearview mirror up 0.4. And I do caution, the annual revision come out may change, but at this point, to find a higher number than 0.5, you're going all the way back to June of 22. We had plenty at 0.5s, but that's where your number is. And if we strip out the all-important food and energy, also hotter, up 0.4, double what's in the rearview mirror, equals several occasions, but the highest number, to be a higher number, 0.5, would be April of 23. If we look at the year-over-year data, up 3% on a headline year-over-year, 1/10 hotter than both front and back. And if we look at 3.0, it would be the warmest going back to May of 24. Now let's look at year over year and strip out the all-important food and energy. Also hotter, 3.3. We're looking for 3.1. Rear view mirrors 3.2. To find a higher number, you're going to May of 24. On the indexes, remember, these go back quite a ways. And are we making new highs here? Yes, new high, 317.67 on the non-seasonally adjusted. If we look at core, 324.74, also a new high. There's never been higher indices on either headline or core. And I also would like to throw a little water on the conventional wisdom. January is this big important reset. I looked at 21, 22, 23, and 24, 4 years post-COVID. And maybe one time in every synopsis, so whether it's headline, year over year, was January the highest. There was many where it was equal to months, but predominantly we saw many February, Marches that were higher. So the reset, I don't know that I buy into it, but in either case, if there are resets, this month certainly looks like one. Back to you.
All right, Rick, stay with us. Let's very quickly look through these boards again. As Rick was pointing out, we looked at the equities tank. You're now looking at the Dow futures off by about 400 points, just over 400 points. S&P futures are down by 57. NASDAQ indicated down by more than 220 points. If you've been watching treasuries, we did see a very significant tick up in treasuries as well. The 10-year, which was trading, I think, at about 453 this morning when we started, so all the way up to 461. The 2 years, 437. Joining us right now for more on this information is Priya Misra. She is the fixed income portfolio manager at JP Morgan Asset Management. Drew Mattis is the head of global economic and market strategy team at MetLife Investment Management. Drew, let's just start with you. Markets didn't like this.
No, the focus was going to be on the core year over year. 3.2 would have been bad, and what we got was worse, right? So, it's really disappointing news for the Fed that they were hoping for continued deceleration. It's disappointing for the markets. They're hoping for continued deceleration. And the fact that this is a January number and doesn't include any potential, tariff impact yet, means that, the risk going forward is for potentially higher inflation.
It comes just after Donald Trump put out on Truth Social the idea. This puts the Fed in a pretty tight box. It's hard pressed for them to be able to lower rates at this point.
Well, it does. I mean, you need to, they shouldn't have been lowering rates in the first place. So they kind of got themselves into a box. They tried to get in front of things heading into the election, and they went a little too far too fast. And then they continued easing even when, everything should have been telling them that they should have been stopping.
This is that nascent inflation that we were worried was in the back of our minds, we were worried that it was still there. Well, isn't that what we're seeing right now? This is like our worst nightmare coming true. We didn't do tariffs yet. This was already coming, wasn't it?
But what I would say is the last mile of inflation. There's some research that's hard. I mean, we have
last mile's hard.
8-9% on inflation to 3%.
But we're going back up. We're not going.
Well, I think January.
It's now a mile and a quarter. It's now a mile and a quarter.
So there is this seasonal aspect to the start of the year. The first quarter has been high. I think there's some of that. Look at the totality of inflation. PCE is that it's decelerating. I think the Fed is going to be on hold. I completely agree with you. And I think we're going to watch the data. But I would say for the Treasury market, one of the reasons we got to that 480 was talk of fiscal stimulus. I mean, there's this inflation fear. I hear you. And I think that's why the market's reacting. What do we hear on taxes? Are we going to hear deficit finance tax cuts? We're going to go up a lot more in rates. We're not hearing that. We're hearing DOGE. We're hearing where are we cutting spending? We're hearing about offsets. I think that's what's going to contain the Treasury market beyond this inflation fear that I think is legit and it's going to keep the Fed on hold.
Well, and the risk with inflation right now, and you're seeing the data, you're seeing it in consumer credit data for December, which was crazy, which is people are cutting their savings. They're boosting the amount of money they're borrowing than they can keep up. And so there's a lot of pressure on consumers right now, and this just keeps the pressure on consumers. And it's a problem, and it's going to be a problem the Fed's going to have to address at some point, which I think you're seeing in the market response is the idea that not only are the Fed not going to be cutting, but it's only a very short step to the idea that the Fed's going to have to reverse course.
That's what I was going to say, Rick. We spoke with Jeremy Siegel half an hour ago, and he had me convinced I was going right along with this whole idea that the Fed is less important at this moment, that that's kind of on the back burner and we're watching everything in Washington. But a number like this puts the Fed front and center again.
Well, if the professor was saying on the back burner because Trump is going to take the front burner, that may or may not be correct. It's kind of a political statement. Joe's right. At this point, what we're seeing is at the feet of, okay, and I'll tell you what, in many ways, the Fed hasn't done a really bad job. I think that, there's no crystal ball here. And on some level, there is a reduction of debt when you have inflation. And when we talk about the policy of Trump, I know it's all going to be about the dark side, but let me tell you, if the average American's got any chance to keep up with these type of inflation rates, and it isn't only the net change. Now, if you go back to January, February of 2020 and you look at the cumulative compounded path of inflation, it's pretty rough on many people in the country. The best way to help them out is grow the economy. You cannot possibly contemplate the negative consequences of letting taxes go up at this point, in my opinion. I think it's all about trying to do growth. In terms of tariffs, listen, I'm no tariff expert. We haven't really gone and seen them have a front row seat yet. The data will show some of these effects 2 or 3 or 4 months down the road. But at this point, it's pretty clear. Inflation is metastasized in the U.S. economy. We still have strong fumes of the overspending of the Biden administration. Now the real issue is with the Fed's target rate at 2%, and pretty much all the year-over-year data shows us that 3% is probably a new floor. We have to draw our own conclusions from Fed policy will change. But I'll tell you this, I don't contemplate them moving rates much at all. So the other side of the professor's argument is correct, because I think you're going to see the yield curve steepen, and I think that all things being equal, the Fed's balance sheet's too big to get aggressive.
Yeah, I think that was his point. He said that DOGE is doing a lot of really good things. We don't know what's going to happen with tariffs. DOGE, the markets love at this point. But his point was the Fed was not going to be the center of the action. But I think we have to watch this pretty closely. I think President Trump wants the Fed to be kind of going along with part of these issues. This just puts them in a box.
I don't think there's any doubt about that. I'm not sure. Listen, everybody wants something. I'd like to have a new Ferrari. The president would like to have lower rates. His background is in an industry that, of course, thrives on lower rates. But wanting them, hoping for them, and doing anything to actually make it happen in a direct way, I don't think that's on the menu at all. But yeah, I don't see the Fed doing much at all. And I think the current rate can work even if inflation stays on this kind of steady, not going much lower path.
You know, Priya, part of what we're watching is the 10-year now at 463, the 30 years at almost 483. Actually, it just ticked at 483. That raises questions about mortgage rates, too, and just the affordability of housing and the idea that that was going to be part of what brought down inflation to begin with, the rent component getting a little cheaper on these issues.
Exactly. I think the fact that the 10-year sort of getting stuck here or rising is going to hurt housing. You know, the Fed cut 100 basis points and the 10-year actually went up 100 basis points. So they ease financial conditions, they help the equity market. Financial conditions are probably where they were before they started cutting rates. So I think
for small businesses and for consumers.
Exactly.
Yeah.
And I think this bifurcated economy remains. I think there's so much policy uncertainty. What I'm now watching is the job market, is business sentiment. Do companies say, with all this uncertainty, let's maybe cut back a little bit? And so what's holding up the consumer has been the strong job market. If that starts to slow down a little bit, hiring intentions slow down, capex slows down, then you're going to see the Fed saying, we've got a dual mandate. PCE is still not that high. And look, the job market's starting to slow. And that's the argument for them to, I think, retain that easing bias, which is why I think these level of rates, you're getting all-in yields in fixed income, high-quality fixed income, 5.5%, 6%. You go a little bit down the credit spectrum, 7%. Amidst all this policy uncertainty, I think this is why fixed income has so much value.
True, a 450-point drop on the Dow is not what it used to be. But you're still looking at equity markets that are very highly valued and lots of questions about what comes next. What do you do with the information and watching the market's reaction to this?
Well,
What do you tell people?
I think the market reaction's overdone.
Yeah.
I think, you know, if we talk about a little bit of inflation, the idea that it was going to stay sticky is not unusual, so we're really talking about 30 or 40 basis points of additional inflation. You know, for me, the real key is what's productivity over the next 10 years. And we're going to see play out in the equity space, right? We're going to see the companies that are going to drive productivity for the next 10 years in the equity space. And if we get productivity high enough, the most doesn't matter, because we will get potential growth high enough that we can actually then grow our way out of a deficit story and the debt story. And so for me, you know, and this is to Professor Siegel's comments, you know, DOGE matters. If they can somehow reduce spending and kind of get us there, and then if we get the boost from AI that people are expecting,
what do you think
everything can work out
on DOGE?
I mean, it's been since my Lehman Brothers days with Priya that I've looked at the budget deficit that closely, but you know, $500 billion I think is kind of a reasonable number. That'd be a very rough guess in terms of
annually.
Annually.
What does that do to growth? That's the concern, right? If they're going to cut that much, is growth going to struggle? I mean, I'm all for efficiencies, but what's the collateral damage? In trying to get that efficiency, if you're going to cut a bunch of spending, that's an immediate hit to growth.
Well, I guess I'm assuming that, you know, I'm taking the government efficiency component of it at its words. You don't actually cut the spending, but you actually don't really cut the services being provided.
Hey, Rick, I'm seeing it already. It's the animal spirits of people anticipating the tariffs, even though there aren't any tariffs.
No, but is it pulling forward, ordering stuff?
There it is. They're raising price. This is eggs. And the eggs that I don't know how he did that, but.
Look, Jim Farley and these other guys,
so even though this is January, and it was come in on January 20th.
Right, but think about
you don't think this is any Biden? This is
all of the automakers in the U.S. are going back and forth between the border 100 times a day.
So they've already raised prices.
Trying to bring as much stuff into the country.
I know, but are you saying this?
Now let's
ahead,
bring
Rick.
some balance here. Let's bring some balance here. Let's say everything you're saying is correct. And people's hair's on fire in a multitude of industries, even though at this point this does look like a January reset. As I said in the past, it really doesn't seem to be something that works. But let's say it's all true. And in the end, 6 months, 9 months, a year down the road, after we break some eggs to make the omelet, we see that there's improvement, that his strategy is bringing improvement. So then we reprice, and we reprice better than we started. I don't know how bad these tariffs are going to be. I have faith that what we are doing is the right thing. And when our guest just now, Priya, talked about spending and growth, just look at what baseline spending was in 2019 and 2020. Look what it is today. We could easily be less than more than $1 trillion and still be providing the same services pre-COVID. The problem is, I don't think Doji's going to be able to do these numbers. Trying to get $1 out of any place the government gives it is nearly impossible.
Rick, is there any way that since January 20th, the narrative and the discussion about tariffs seeped into the CPI numbers for January, and this is not residual from the Biden? I mean, could you really make that case with a straight face? Because I know it's going to happen.
No, absolutely not. It's impossible.
They're going to do it. Because it's...
Of course they're going to do it. But like I said, look at the burpers that are in our society. Oh, the January reset. Go back and look at January 2020, 1, 2, 3, and 4. In every category, it's rare that January is the highest. So, listen, they can't even look at history and get it right.
Rick, we will do this again tomorrow with the PPI. Priya, Drew, thank you guys both for being here.
Coming up, former Fed Governor Rick Mishkin is going to join us on the new CPI data. There goes our 125 basis points that we were counting on from a discussion earlier. Squawk Box will be...
In addition to hedge funds and registered advisors, Interactive Brokers also serves individual investors. We give you all the tools and technology we built for our institutional clients for free. Let Interactive Brokers assist you with your market goals. The best informed investors choose Interactive Brokers.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
The climate crisis is come to our head, so we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating. We've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution.
Soil is not our problem. Legacy that's come to us from previous generations, it's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future only on CNBC.
on the takeaways for the Federal Reserve. Former Governor Rick Mishkin, he's now a Columbia University professor and a CNBC contributor. And, you know, things come in vogue, things go out of vogue. There was a time after the 50 basis points sort of surprise, shock and awe cut, and then a couple more, there was a time where people said, are you sure that inflation had been put to bed? And the last mile is tough. And, you know, the economy, are you sure the risks are symmetrical? Because the economy, jobs market were holding up pretty well. So there's a question as to why cut. I mean, is that being borne out now? The mission accomplished that banner was put up too soon?
Yeah, you know, I actually thought that I mean, in hindsight, but the 50 basis point cut was actually a mistake. You know, it came after they thought they made a mistake when they didn't cut, and in fact, the numbers came in a little weaker than they expected. But the bottom line is that the mission is not accomplished. The inflation has fallen, but on the other hand, it's sort of stalled at a level which is above the Fed's 2% inflation target. The job market, if anything, the labor market's still slightly on the tight side. And the Fed's maybe a little bit restrictive in terms of its numbers, but not that restrictive. And then, you know, we have a lot of uncertainty about what's going to happen, particularly in terms of tariffs. And that's like a supply shock, a negative supply shock. It's going to hurt the U.S. economy, but also raise inflation. And it's being done, you know, usually we get those because something bad happens, but in this, something that the Trump administration is pushing very hard.
Right, and with what's maybe still in the pipeline, combined with in the proposed tariffs, which, you know, some are coming even sooner maybe than March 1st, the president saying that interest rates should be lowered. I mean, that is maybe interest rates should be actually, if you got tariffs coming and you've got residual inflation from whatever caused it, you know, 40-year highs, it's not a time you're going to be cutting rates. You might be raising rates.
Well, yeah, I don't think the Fed has to think about raising rates at this.
There's another couple hot prints.
Yeah, the tariffs are complicated, but they are a supply shock. And typically the Fed looks through those supply shocks. It doesn't try to react to them too much. But on the other hand, you know, look, these policies are not particularly helpful, that Trump is a low interest man. You know, he's a tariff man. He loves tariffs. He also loves low interest rates. This is one of the reasons why it's very important to have an Fed that is able to look to the long term, not sort of get into the short-term type thinking. But, you know, politicians do this all the time. Trump is a little more extreme on some things, but he's certainly no exception to the typical politician who always would like the Fed to goose up the economy and create jobs. But that's not the Fed's job. The Fed's job is to basically keep a good long-run policy that keeps inflation under control, which is a pro-growth policy. That's what the Fed's supposed to do. And I think, you know, Jay certainly understands this, and the Fed as an institution understands this. And, you know, Trump can say whatever he wants. The big issue is going to come up when he's getting ready to appoint a new Fed chairman. That's when things really become much more complicated. Right now, the Fed's just going to ignore what Trump is saying. Not what he's doing, because that can affect numbers, but what he's saying and his push on them. They resisted very well in the past during his first administration. They're just going to do it in.
Why wouldn't some of the cool numbers we saw in inflation, you know, not this month, but previously, why wouldn't those be the lows? Why should we have any hope that we're not now, that we haven't, maybe the inflection point hasn't been reached? It'd have to be a weaker economy. Would there be any reason for inflation to come down from where it is right now? And if not, we are not 2%. So I don't see why, you know, I don't understand why we're going to have more cuts. You think we'll get a weaker economy that will help? Otherwise, inflation's headed back up.
I think this is why the Fed basically knows in a pause phase, that they're basically just going to be wait and see, that they're still mildly restrictive. And also, one of the things that as long as the Fed has credibility to get inflation down, inflation will gravitate to 2%. That 2% target really does help in that regard. To basically give an anchor to where inflation is going to go. And in fact, you know, when I was on the Board of Governors, and people frequently say, what was your prediction for inflation? I would say, well, I think inflation expectations is rock solid at 2%. They'll head there. So I think it depends a lot on what the numbers are. The Fed, I think, has been handling itself quite well since 2022 when it previously made bad mistakes, but turned things around very quickly. And I think they'll do the job. And I think the markets understand that they'll do the job as well.
We got PPI tomorrow. All right, Rick Mishkin, thanks. Squawk Box coming right back.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Oh my, David Letterman! Yeah. Jimmy has David Letterman. Anybody else? Plus Jim Gaffigan and Adam Lambert. And Super Bowl champs Jalen Hurts and Saquon Barkley this weekend.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives.
Before they talk to Wall Street, they talk to John Fort and Morgan Brown. Closing bell overtime.
All right, welcome back, everybody. Take a look at where the markets stand. A bit of unraveling after that hotter than anticipated consumer price index number. Inflation showing up at 0.5% month over month for January, 3% year over year. Both those numbers hotter than anticipated. And you saw what happened to the Dow. It's now indicated down 400 points. S&P futures are down by 58. The NASDAQ futures off by about 229, 230 points. It's all happening while Treasury yields are on the rise, 4.63%. We started 10 points below this 3 hours ago, so we'll keep an eye on that.
We go back to not knowing what's going on.
I don't know.
You liked that, the rudderist thing?
Look at ignorance is bliss. The first data point we're getting is not.
Tomorrow we get the
good.
PPI, we get producer prices, and we will see. Make sure you join us for that. Right now it's time for Squawk on the Street.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Sarah Eisen and Mike Santoli at Post 9. They are exchange Kramer and Faber have the morning off. Futures do fall out of bed here as January CPI comes in hotter than expected, up 0.5, biggest jump since 22. Year-on-year core ticks up to 3.3, and the 10-year yield's now 4.62. That's almost a one-month high. A roadmap begins with Elon Musk defending Doge in the Oval yesterday, making the case for the group's aggressive actions in this new administration.
Speaking of Musk, shares of Tesla trying to avoid their sixth straight day of losses. Stock already down 50% in February on growing concerns over Musk's focus on the company and rising competition. And we will take you down to Miami for CNBC Bank of America Chairman and CEO Brian Moynihan. His reaction to this morning's CPI print, the Trump administration, and Powell on the Hill again this morning.
Let's Begin with market reaction to CPI ahead of the chair's second day of testimony on the House side today. A lot of discussion about whether this number was front-loading tariffs or whether there were wildfire effects. But year-on-year headline, Mike, since August, 2.4, 2.6, 2.7, 2.9, and now 3.0.
Yes, and market also was leaning into this being a little bit of an unfriendly, sticky, hot print. But then it actually was even hotter than that, probably, as the bond market is off, as you mentioned. So whether it is wildfire effects, obviously bird flu, but the other, and a tariff pull forward, but also just this annual tradition now of hot January numbers, seasonal effect. So all that being said, you can't explain it away fully. He said, we've been sideways at best on inflation for a while, well above the Fed's target. It does sort of reinforce the idea that they should just be in wait and see mode. Stock and bond markets, interestingly, are kind of just testing recent ranges. So it's not as if it's sort of okay, the entire game is changed, but it could be a lot more suspense around every data point and around every interaction with Jay Powell from here.
I mean, there were a lot of ugly, hotter numbers in this report. For instance, I mean, pickups food away from home and food at home in the grocery store and in the restaurant, both perked up on the month. We're talking about 0.5% increase for food away from home. It was 0.3 in the monthly number before. So you don't want to see those kind of numbers going in different directions. Auto insurance continues to be problems. Insurance numbers, which have been hot. Airfares, hotels, they all contributed. Airfares gained 1.2% on the month. Hotels increased 1.7%. It was a number that suggests that the Fed is not making as much progress as it is hoped or it is thinking on inflation. Does it mean that last year 100 basis point cuts were a mistake? I mean, that debate is going to be out there. We've been having that for a long time. But it also means that they are not going to be able to do much in terms of cutting from here. So now the market yesterday was pricing in the first cut in September. We've gone out to December of this year for the first cut. So a complete rethink of when the Fed is going to be able to cut, if the Fed is going to be able to cut. And remember yesterday I said day 2 Powell testimony should be more interesting because of this. Hopefully he'll address it. And that's why we news this time, because he didn't say anything new yesterday.
The questioning yesterday was a lot about deregulation and banking.
CFPB. That was the whole testimony. And he couldn't answer a single thing about it.
Right. So hopefully we get to some discussion of rates, though. But Sarah's right on food, eggs. I know eggs are sort of this weird football, but 15% month on month. You got it back a decade to get.
And some people are also even pointing to things like the hotels and car rental as, you had these massive spikes. I want to explain it away because it obviously is a challenge in terms of getting Fed policy back toward what they think is new, even if it's higher than what they thought before. It's only a real problem if it paralyzes the Fed and leaves them unable to respond to a slower economy.
Here's the other problem. The other problem is we have a president who is now pursuing a very pro-growth agenda, inflationary, and a tariff agenda, potentially inflationary as well. So I think that you have that combined with the fact that we're already starting to get prices perking up here. I'll just add one more number at you, which I think would be very disappointing for Fed Chair Jay Powell, which is Supercore. He put Supercore on our radar at the beginning of this cycle. It's services inflation. It's a whopping 0.76% on the month. That was the highest in a year, and it definitely kind of raises the question of about whether it is a seasonality issue, Mike, or there's something deeper going on here,
by the way,
which they have to assume.
Yeah, also 3-month annualized 3.85. And this is coming on a morning where the president does post on Truth Social, quote, interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock America. It comes about a week after Treasury Secretary Bessent said the president was not calling for rates to be lowered.
Isn't happening this morning because the gut instinct here is sell bonds, yields go up, dollar strengthens. I mean, it's everything that the Trump trade started as that was given back in the last few weeks. Sure. Interestingly, there's been this big rally in bonds
since like the end of November that has unwound a fair degree. That's absolutely true. Yeah, I think it's true that the intent is to run a growth-friendly agenda. It's not clear that in the short term tariffs qualify as growth friendly. It's not clear in the short term that less fiscal spending is growth friendly, even though, you know, everyone would say, sure, get more efficient. So I think it's a little bit of a push-pull on those fronts. And, you know, I don't know that what the president is suggesting here about, you know, rates should go down is going to carry a lot of weight. We know that's his orientation. If you look back, actually, at the history of President Trump's comments on this, he actually seems to think about high interest rates as a form of inflation, right? Because if you're a debtor, you're paying more, and it seems like your cost goes up. And so he sometimes is characterized it that way.
Well, Elon Musk yesterday, when he was talking about what Doge was doing, trying to be really transparent about the intent and trying to relate it to average Americans, was saying, okay, we're going to cut government spending so that the government doesn't have to borrow as much. So interest rates will come down, and that will mean you will be able to afford more on your mortgage payment, at the grocery, because for borrowing costs being very high, people can relate to that.
I mean, that's
and I think
fine,
that was
but
his
that's
core
not where
argument.
the numbers are. Right? The civilian federal workforce is not where the major swing factor in how much the government has to borrow is. It helps if you spend less, but it's just funny that it's being treated as an emergency, and people in the market would be like, I don't see an emergency on that particular part of the government spending.
The government workforce relative to the population has stayed pretty steady over the years.
In fact, that thing local, that's where the bloat is.
Speaking of that Oval Address, let's move to the president's EO. Given President Musk defended Doge's efforts, and our Eamon Javers has the latest on the optics of that presser, the AP getting locked out, and of course the coverage today from multiple outlets on how Musk is literally deregulating himself.
Yeah, that's right, Carl. The AP was locked out because their style guide does not acknowledge the name change for the Gulf of Mexico to the Gulf of America. So that is a spat between the news agency and the White House. But what we saw yesterday was an impromptu press conference in the Oval Office with Elon Musk and his young son X standing just to the side of Donald Trump at the Resolute desk. Musk on some of his critics who have blasted his Doge efforts as a hostile takeover of government by painting those efforts as just an innocuous fact-finding mission designed to cut wasteful spending. He highlighted a couple items found so far, including that the Treasury Department's software systems sometimes don't include fields describing the nature of the payment, and the government's employee retirement system is still largely paper base and therefore inefficient. But he also conceded that some of the things that he has said so far are just not true, including the widely repeated the United States was sending millions of dollars in condoms to Gaza where they were used by Hamas. In condom effort was in Mozambique, and it's helping prevent the spread of AIDS.
Some of the things that I say will be incorrect and should be corrected. So nobody's going to bat 1,000. I mean, we will make mistakes, but we'll act quickly to correct any mistakes.
And although Musk has resisted basic disclosures about those, such as the names and duties of the people who work there, he said his efforts will be maximally transparent.
You can see everything that's going on. And then you can see, am I doing something that benefits one of my companies or not? It's totally obvious.
Musk, all of Doge's efforts will be posted to the website so that the public can judge for themselves whether he has any conflicts of interest. Back over to you guys.
So what are his next steps? I mean, he's been really focused on the USAID office, the CFPB, as we've heard from some of the Fed reports, and expect more commentary today from the House Financial Services on that. Where else is he targeting as far as these federal workers and cuts?
Well, what's interesting, Sarah, is this, the whole ideological project here has been really focused on areas of government spending that Republicans generally disagree with. Foreign aid is a big one. We'll see that what the president said is that they're going to target the Pentagons. We'll see how aggressive they go after wasteful spending in the military-industrial complex. It's been an area where Republicans have been reluctant to poke around too aggressively over the years. But we're also seeing, and I want to bring up a graphic here that we prepared, just a couple of examples of some of the real consequences that we're already seeing in terms of the cuts to federal spending around the world at USAID. So we're seeing funding delays, according to the LA Times, funding delays to Head Start programs nationwide. According to the New York Times, at least Kenya are going to lose jobs as result of USAID cuts. Also, according to the New York Times, medical trials are halted in Mozambique, Bangladesh, and Malawi on different diseases that USAID was working on setting up in those countries. So those are some of the real-world impacts of these cuts that have happened so far. And the debate here is sort of both a moral and a practical one. Morally, it's a debate for the American voter. What kind of country do we want to be? Do we want to be a country that provides that kind of help or not? And Elon Musk was arguing yesterday that debate was decided at the polling place back in November. And then the other question is practically, what does that impact have on American soft power around the world in terms of creating an opportunity for China or others to step into the void as the U.S. pulls back from all these countries and say, hey, wait a second, China is actually the strong, wealthy country that can help you out. The Americans are weak and declining. You should turn toward us. Foreign policy analysts and sort of the big geostrategic game will say this creates a big opening for the Chinese as well.
Yeah, either the Chinese or alliances, Eamon, that are just ex-U.S., whether that's Canada and other partners. Big piece in the Journal today about Scheinbaum's popularity in Mexico. I do have a question for you about some of these court challenges which are now making their way to the appeals level, and this notion of what happens if the executive branch simply continues to defy a court order, and where that leaves economic certainty, business certainty, and all the rest.
Well, I mean, it's a fundamental question of rule of law. And what was interesting about that presser yesterday, Carl, is that both Trump and Musk seemed to dial back some of the criticism of the courts. We saw, J.D. Vance very aggressively going after these lower court judges. We saw Elon Musk saying, these judges are simply anti-democratic, blocking what we're going to do. They should get out of the way. We should ignore them. That kind of argument. In the Oval, though, what Trump said is, I've always abided by the courts and will continue to abide by the courts, and we'll appeal that. I think there's two basic things going on here. One is, I think the White House realizes that, ignoring courts is sort of not a popularly defensible thing, even among Republicans broadly. And two is that they largely control the Supreme Court ideologically. And so if they appeal all these things up to the Supreme Court, they have a very good chance of winning there. So I think what's going to happen is a lot of these states are going to get expedited up to the Supreme Court, and Trump's going to win a lot.
Eamon, appreciate that. CPI, of course, the main story here. Although, we'll talk tariffs with Peter Navarro. And yesterday, we had multiple Griffin, Sarah, who you know quite well, saying that the tariff, quote, chaos is an impediment to growth.
No, this has been consistent from Griffin. And yes, he's conservative. I mean, he probably agrees with a lot of what Trump is doing and saying, but not on the tariff. And he says, from my vantage point, the bombastic rhetoric, the damage has been done. It's a huge mistake to resort to this format when you're trying to drive a bargain, because it tears into the minds of CEOs, policymakers, that we can't depend on America as our trading partner. It makes it difficult for multinationals in particular to think about how to plan for the next 5, 10, 15, 20 years, particularly when it comes to long lead time capital investments that could be adversely impacted by a degradation of the current term as amongst the leading Western countries when it comes to terms of trade. Basically, that it's bad growth, that companies and CEOs cannot plan and leaders cannot depend on America, that the tariff strategy is different than some of the other pro-growth strategy and harmful for growth, potentially when it comes to CEO confidence as well, which has been going strong lately. That doesn't seem to have stopped Trump. I mean, we could be getting reciprocal tariffs as soon as today. Yeah.
We're going to be on the lookout for that as well. When we come back, SoftBank's a big story today. A surprise loss amid Masa-san big push to invest in AI, and that does, of course, include the Stargate initiative. We'll talk about that after the break. Meantime, futures got a bunch of movers, too, whether that's MCI, Biogen, QSR, Tesla's the story once again. Don't go away.
Live ambitiously.
Look, in my view, generative AI is going to change the world bigger than the Industrial Revolution, television, and the internet combined. And I think there's a few reasons for that. All the world's biggest tech companies are spending billions currently on making that the case. The world's investors are saying that's the case. The world's people are saying that's the case. Fastest technology in history to get to 100 million users with ChatGPT 3.5. There's not a single thing we do as humans using our brains today that you cannot already do better, faster, and cheaper using generative AI. Look, I think the biggest mistake that a lot of marketeers are making today is to think that this is a future thing, not a current thing. And they maybe tried something 12, 18 months ago, thought it wasn't very good. But if you're late to the party and you don't wake up and do this and, immediately, you'll be playing catch up and you're going to be really losing out.
The Power Place here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, Days, CNBC.
This is a good global debate.
There is no place in the world where we get the kind of access to so many amazing interviews.
To be able to solve problems at a scale that nobody's ever imagined.
This industry is going through its renaissance.
How big a game changer is this?
Let's go.
more than 18% here. Elon Musk's politics and OpenAI unnerving some investors. It is a reminder of what happened years ago when Tesla shares fell sharply after he disclosed his stake in Twitter, and that did fuel concerns it was a distraction from him running Tesla. We continue to point out the split between BYD and Tesla year to date going in opposite directions. There were some Ward's numbers yesterday as well on sales, down 13% in North America in January. So we're going to track all of that.
For sure. I mean, it's in like a 30% drawdown. Looks like it's going to try to bounce this morning. It's just an amazing stock the way it runs in streaks, and these seem to be dictated by the degree to which, you know, investors are captivated by just sort of the long-term vision, or they want to sort of reset the focus on the here and now. Earnings estimates for this year ago were 433. Now they're 293. So it just keeps chasing the estimates down, and we're declining to a times current earnings.
That's why I don't buy that it's about that he's not focusing on Tesla or that he's in the Oval Office, because he's been focused on that for a while during the entire run-up too. I mean, the fundamentals are changing. And the announcement yesterday about BYD making this driver assistance technology available to models, including that are under $10,000 a car, and that's the market share game in China, and potentially why stock is lower. I mean, they offer a car for $9,600. Now they're going to have all this self-driving technology in it. That's hard to compete with.
At the big board today, it's Cosmopolitan Magazine celebrating its new love issue with Macaulay Culkin on the cover. At the NASDAQ, JetBlue Airways celebrating its 25th. A discussion yesterday about staples outperforming consumer discretionary, and whether that ratio continues to change and what that means for the consumer and markets.
There's been a subtle defensive turn, although I would say that's mostly based on market weighted, which Tesla's really been, you know, doing a job on. So if you look at it equal weighted, it's a little bit less worrisome. On the other hand, I do think the market is in this kind of frozen spot of not really being able to price in an imminent acceleration in the economy, but also not seeing the idea we're benefiting from a very strong starting point in terms of economic conditions and where rates are and things like that. I do find it interesting, you know, the reflex move higher in Treasury could be hot CPI number, put the 2-year yield above the effective Fed funds rate. Right, back above effective Fed funds, which is like 433. Yep. That just essentially means, you know, we're wait and see for the indefinite future on whether Fed funds moves, and can we digest that? I mean, that's been one of the big questions. I don't know how much lower you think rates should be at 4.5, 460 in the long end. When inflation's where it is, growth's where it is, you want to have a steep yield curve, not a flat one. And, you know, it can't really give you that much help.
Although that does bring, you know, that raises the discussion of, you look at how tariffs are getting priced, there is some inversion. They think it'll be a shock. Right. And then, so does that lead you to a curve inversion over time? And would that be good or bad?
We're not far from it, I guess. Yeah. I mean, look, Sarah and I have talked about this. I don't think of tariffs as being real rocket fuel for actual and self-sustaining inflation. It's much more just like this frictional force out there. It's going to create a lot of switching around, short-term noise in the data, you know, that kind of stuff, as opposed to it being somehow accelerant to it.
But even if it's inflationary, it's the hard kind for the Fed to fight, because it's not demand-led inflation, which I kept saying. But look, if you were hoping for rate cuts this year, those hopes are diminishing this morning with this hotter CPI number across the board. And you mentioned consumer discretionary. You know, in that report, the one place that is not seeing inflation is apparel, which actually saw a negative number month over month by more than 1%. So a real dip there. And that does not bode well for the consumer discretionary sector that sells clothing, right? If you're seeing disinflation there, it means that they're not, you know, it's not as in demand, and that's not where people are spending, as opposed to, say, airfares and hotels, which is continuing to see these monthly jumps in inflation, and people are spending. Jeffries put out a note about how, you know, after a strong few years here for consumer discretionary, one of the best retail environments they say they have ever seen, it changes now. There's more uncertainty. We're going to see tougher comps, a less robust consumer combined with increasing inventories and peaking margins. Trouble for the sector in 2025. They like defensive growth stocks here, what they see as better fundamentals and little downsides. They like TKO. they like PL and T, for example, but just potentially adjusting to this different kind of environment for retail. And I think today's CPI gives you a little bit of glimpse of that.
Yeah, I mean, core good does not know where inflation has been, and so that's obviously sort of yesterday's story to a fair degree. Was going to mention Supermicro. It was such a story yesterday. It's a mover this morning. People waiting for this business update. You know, they've not yet filed their required filings. They say they're going to do that within a couple of weeks. I guess the was sort of near consensus, a little bit muted, but it was enough to suggest that they continue to say they won't have to restate their financials. Stock up 6%. Remember what a moonshot this was for a few months when it caught the kind of NVIDIA GPU installation train. S&P 500 installed the stock as a component right near the highs. It just chased it up there. I noted yesterday it replaced Whirlpool, and it's radically underperformed Whirlpool since the time.
Reassurance that delisting is not in their future, right?
They say they're on track to have their audited financials by February 25th, which would forestall any delisting move from the NASDAQ.
Right. Yeah. A lot of rate-sensitive names obviously leading the losers list. You see Masco and Lowe's.
Yeah.
We talked about the home builders a bit yesterday. Any stocks that were being bought on the promise of lower rates getting a setback today?
And, you know, there's this camp out there that's very focused on the impaired housing sector as a drag on overall growth. If you look at how construction job openings, they were really weak last year. So all this undertow of a stuck residential housing market getting exacerbated if there isn't a lasting uptick in rates. And again, whether that feeds into a little bit of check on consumer and economic demand, general demand, and then we have a slowdown or a growth scare.
Yeah.
And what happens there?
I mean, construction job openings are at like a 7-year low.
Yes. Yes.
You got to go back to
a long way.
2017.
Yeah. And so, you know, we've been doing that for a while.
Yeah.
I mean, obviously, it's not been a real engine for a little bit, but you know, I mean, Sarah, I'm sure you look at like Neil Dutta's work where he's really on growth scare watch here.
Yes.
He just thinks there's kind of waning momentum and the fundamental growth drivers of the economy, and the Fed is maybe distracted by where inflation is and the prospect for tariffs.
We just haven't seen it in the job market.
That's right.
And so the Fed hasn't reacted to it, but
exactly.
That will be tricky if we do start to see sort of unemployment rate move higher, layoffs pick up, because Fed Chair Powell has said that he will react to that and they could lower interest rates, but you can't do that if inflation is perking back up. So that's something.
Listen, you can always build your case using what you can in terms of the data, but yes.
How about Kraft Heinz, which is a loser today off results? I guess profitability is the one thing that was better, but if you look below in terms of the sales trends, it's not pretty. Organic sales 3.1%, a 4.1% volume mix decline. They're struggling. You know, all these consumer staples did well in the last few years of COVID because they had pricing power and people were eating more at home, and we're just giving that back. And if you don't have strong guidance was lower, organic sales in the range of down negative 2.5% to flat. Pricing flat to slightly positive. So again, it speaks to they're kind of the poster child for the struggling consumer packaged good company where you just don't have the volume recovery because either prices got too high or brands aren't in vogue, and that's what's happening here on top of all the other added layers like GLP-1s and RFK Jr. potentially as HHS secretary and what that might mean for food companies. Stocks getting punished again. It's been an ugly looking long-term chart, as you can see.
Yeah, the difference, I think, really, if you compare, say, a Kraft and a Procter is, they never say we're losing to trade. You do get that sense and invest either in marketing or in revamping some actual product to stem those losses to private label.
I mean, it's been a radical split between food and non-consumer staples. Packaged food has just, you know, accepting beverages has just been, you know, kind of the worst of the worst. Kraft Heinz, I mean, in terms of how this company's being valued, as if it's kind of in permanent shrink mode right now. It's at like 9 times earnings.
There's a Berkshire element here too, right?
They've owned a chunk for a while.
I mean, there's been chatter about what would an impairment look like if they had to go that way, yeah?
Remember when they split from Mondelez and Berkshire with Kraft, and Ivan Rosenfeld went to Mondelez because everyone was hopeful for Kraft because that was the North American business and the global business was more uncertain. Turned out snacks was a much better place to be. of those brands because it has outperformed. I would also just note Coke is again today after a strong quarter, and it shows you the divergence here between which brands are winning and more resilient and showing growth. And Coke showed volume growth, pricing, and sales growth because of it. Something in stark contrast to say what Kellogg reported yesterday and what Kraft Heinz, even worse, reported today.
Yeah, I mean, Berkshire still owns 27% of Kraft Heinz, and the thing about it is it's a small piece of the Berkshire portfolio because the company is obviously, valuation has gone down so much.
I mean, every sector now is lower, which I guess isn't surprising when you see bond yields jump like we're seeing, the dollar strong, like we're seeing, I guess, reaction to the CPI report, which does come just as a surprise. And yes, food prices were elevated in both grocery and away from home. And yes, eggs had an outsized impact, and everybody buys eggs and everybody feels that. But you did sit kind of across the board. So I will be interested to see if Fed Chair Jay Powell addresses that today, why it's happening, whether it makes him think differently about interest rate cuts and the trajectory, whether there's the seasonality impact in January. Hard to know all of these things, but it is new information that would be great to get him to respond to.
It is. And
I don't really trust any of the members of Congress to do that after yesterday's questions were just totally off base and irrelevant.
I have a feeling there's going to be a lot of questions about, from one side or the other on the shouldn't government spend more or less on this or that and get his endorsement, which he's not going to give on any of those questions. But I share that hope. I'm also interested to see just if the market preserves this ability to kind of just get through these rough patches with rotation and not really let it fall out of the range. So far we're doing that. You're still above, kind of last week's low, I would say, in the, which came on Monday of last week in the S&P 500. Market trying to sort of keep the CPI move in perspective. Yields are also still below their highs, even though they've had this big pop.
Right. Lyft is a big story, especially now that we've gotten the Uber print last week. It was an EBITDA beat, a little buyback of $500 million. One was a miss, and that's going to be a 9% drop. It's going to take you back to, say, October of last year, but that continues. Ride sharing continues to be a mix of the future and autonomous versus the current real day demand for say travel and mobility.
Yeah, it's really hard to know, what the real path is for Lyft in particular. It's like 1/30th the market cap of Uber. At this point, it's kind of just out in the business because it is so purely focused on that one part.
And they don't have the food delivery, which is doing well. I mean,
Yeah.
did you see DoorDash last night? I mean, Uber Eats had a quarter also.
As we go to break, deep banking was one of the big issues brought up during yesterday's Capitol Hill appearance by the Fed chair. And who better to hear from then B of A Chief Brian Moynihan. Various topics on tap, including the president's message to the banking community about debanking last month in Davos. First, though, watch Treasuries, of course, on to a Powell. We'll get Boston at 12. Waller will be interesting at 5 p.m. And then, of course, a 10-year note auction at 1. Stay with us.
Live ambitiously.
I think it's really easy to become led by the technology and to think that because you can do something, to quote Jurassic Park. And so what I find is a good defense against that is just being obsessed with the client or the customer. So we really try to think, we could do this some cool Gen AI thing, but does it make the experience better for our audiences? Is it something they need? Is it something they want? And if it isn't, we go there. So for me, I think being really focused and disciplined about remaining that pure marketing concept is let's be obsessed with the customer, needs to through to technology. As soon as we start being led by the technology and what it can do, I think we risk losing our minds a little bit.
If you're watching CNBC, it's because you want to get in, you want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Good Wednesday morning again. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and Mike Santoli. Today we are live from Post 9 of the New York Stock Exchange. Day 2 of Fed Chair Powell's semi-annual monetary policy report. He's going to be testifying today before the House Financial Services Committee. We'll take you to the Q&A when it begins. Will he address today's CPI inflation report? That is the question. The market is certainly reacting to it. Big disappointment, and you can see that in the stock declines, down 0.6 on the S&P. We have come back a little bit from the lows, but you've got every sector lower right now, and some are getting more than others, especially the rate-sensitive ones like real estate, utilities, materials, industrials, also under a lot of pressure. Tech is holding up a little bit better. The NASDAQ down 0.5%. Amazon, Microsoft, Nvidia, Micron weighing on the tech sector. But you do have gains today in Tesla, Palantir, Intel, DoorDash off better earnings, helping offset that. Treasuries, big move lower in bonds, pushing yields higher. We're looking at 4.65 on the 10-year yield. On the 2-year, 4.36% as those hopes fade of a Fed rate cut as soon as this fall. It's now getting pushed out to December in terms of pricing with this hotter inflationary number. And guys, that's where we're going to start the conversation today. We're back to 3% inflation. That's not what the Fed wants to see. It's not what investors want to see. We were making a lot of progress. Does it throw off completely off the trend line? Not necessarily. As Mike noted earlier, there is some seasonality to pay attention to. We usually get hotter numbers toward the beginning of the year, and this is the January report. We've seen this in the last 3 years. But if you go beneath the surface, you know, core CPI comes in firmer, super core, which is services, taking out housing, comes in a lot firmer. Food higher. We know people feel that. Yes, egg prices jumped 15% on this, you know, crazy supply demand issue with the avian flu. But it was kind of across the board. And that raises questions, Mike, about the market's assumption that the Fed is in cutting rates mode, also with the outlook that we could potentially get more tariffs and a pro-growth agenda, and both of those could be a little bit inflationary.
That's the way the markets are definitely treating it, although the market's attempting to take a little more of a measured response here. You mentioned the buying the dip in the indexes. You know, the 10-year back to 465 is basically a 3-week high. We were here in late January. The 2-year note yield I mentioned back to 436. It sort of freezes expectations for where Fed rates are going to be for a while down the road. Shelter is just not cooperating by disinflating the way a lot of prognosticators thought that it would. Right. And, you know, people thought it's lags. So it's not giving its full benefit of disinflating. So, you know, it's not also, we have to keep in mind that the Fed's target's based on PCE inflation, not CPI. So PCE is not running fully at 3 headline at this point.
Okay, so here's where the inflation was this month. What contributed the most in terms of monthly jumps? Oil prices. We know they've been firmer. Used cars and trucks, a 2.2% jump in prices there. Transportation services. I'll just throw in some other ones where we saw medical was up, airfares gained 1.2, hotels almost 2% monthly jump. Where the inflation is not, though, apparel was down 1.4%. That was mostly women's, actually. Medical care services, new vehicles, and electricity all flat. And then for those saying that it was, you know, all food was the egg prices, there were some sort of hotter pockets inside the inflationary report about on food prices. I mean, it's not universal like it was in 2022, but there are spots like chewing gum and candy and meat, whole chickens. I mean, they really break it down, which is great.
The cocoa prices are driving chocolate, you know, way up.
Cocoa prices, coffee prices. I mean, we've had some interesting stories here on the supply side, keeping food costs high.
How do you think, I mean, at least the of rates like Waller respond to this kind of number? He'll speak tonight.
Maybe that it's there's seasonality. 1 month does not a trend make. We're still a long way from the, I don't know, 8-9% of inflation where we were post-COVID.
But can you keep a forecast for 4 cuts this year?
I don't know if you can keep his first half cuts. Remember, he was on with us a few weeks ago saying, I'm still thinking first half. Not sure you can keep that with these inflationary numbers. But then again, you also have to look at PCE, as Mike said, which is Fed's preferred. We'll get PPI tomorrow, the wholesale inflation number. That feeds more into PCE. So that'll be a good tell. But
the other way you could do it is essentially say there's probably some weather modifier. You want to see this spread out over more months. But, you know, you can't do that perpetually.
The other thing is, you know, we haven't really seen a deterioration in the overall economic data.
Right.
We're seeing confidence high, economy's better, all of that bodes well for demand.
Right. I mean, well, it does, but we were in immaculate inflation mode, a few months ago, where you just didn't think you needed any softening up of labor conditions further or for demand to really wane. But
I know. I just wonder how much of that was supply side coming down. There's also the tariff issue. President Trump's trade advisors reportedly finalizing plans today for reciprocal tariffs. Trump said he wouldn't put on any charges duties on U.S. imports. Let's get the latest from Peter Navarro, White House senior counselor for trade and manufacturing. Join us live from Washington. Peter, it's great to see you. Welcome.
Great to be back. Just wondering, is Kramer going to spend like a week in the Big Easy celebrating the Eagles? I mean, what's the deal?
Probably.
Come on,
no,
brother.
Yeah, he gets a vacation. He can get one vacation, but he is probably in celebration. It's also his birthday week. Peter, what can you tell us about the reciprocal tariffs? Where are you on that?
I can tell you why the president might act. I can't tell you when. That's not my job to break that kind of news here. But the reciprocal issue really goes back to the first term. The president had the Reciprocal Trade Act up in front of Congress. He's been talking about how governments and nations around the world stick it to this country. The simple idea here is that you have the U.S. with the lowest tariffs in the world and, importantly, lowest non-tariff barriers, what the president likes to call non-monetary barriers. And that's not fair. And the notion here is that if in the first term was that if they won't lower their tariffs to ours and non-tariff barriers, we're going to raise ours to theirs, or vice versa. It's the most common sense thing in the world. And if you just go around the world, you have India, the Maharaja tariffs. They have some of the highest tariffs in the world. The EU particularly has a VAT tax, a value-added tax, and it's not well understood. Punch. When they're sending us stuff, it acts as an export subsidy. The net result is we don't sell any cars there. And then, of course, you got the problems with all the other countries around the world. So reciprocity, Trump has embraced that. Yeah. First term is his philosophy.
I get the issue of fairness, especially on places that haven't been fair to us on trade, Peter. The question is, though, if it's going to have a damaging effect on business, because that they've been doing business this way for a long time, and now there's great uncertainty pay, changing their cost structure, and also potential more reciprocal or retaliatory tariffs when we do that.
I think you have to step back and look at the broader structural readjustment we're having with the whole global environment here. The birth of the external revenue service is going to take us back to a future that looked a lot like McKinley and Jefferson relied almost exclusively on tariff revenues, and we prospered and our nation was secure. And what the President Donald John Trump wants to do is get to that kind of world, and it's going to be a world. If you look just macro at what happened this week in the steel and aluminum tariffs, we've seen billions of dollars added to market cap of companies collectively, Nucor, Cleveland Cliffs, U.S. Steel, Century Aluminum, and those companies to prosper as they did back in the first term, but we're also going to see a lot of investment come both domestically and from abroad to come inside the perimeter of the United States to be able to produce. So this is
Steel companies may have rallied, Peter, but the auto companies are warning about it, and they are not rallying, and this could be a huge headache and a huge expense for them. Not to mention other companies. I mean, we were talking to Coke yesterday. Aluminum costs are going to go up. Cans are going to go up. I mean, there are others affected by these.
Sir, here's the beauty of this. If I were sitting here as I did back in 2018, you would say the same things based on the things that those industries were saying. The problem they have, and now I can share with you, is none of that happened. We didn't have inflation. We didn't have any problem. Everybody prospered in the Trump economy. And so crying the inflation wolf this time around, and I can walk you through the reasons why we don't observe inflation when we have tariffs, despite the seeming logic of it. And the first thing that happens when we put a tariff on is that these export-dependent economies, the producers, lower their prices significantly, so they don't lose share. The next thing that happens is a currency adjustment. Both the governments do manipulation and adjust because we have a lower trade deficit. Some chains adjust, and then as we get more investment in the industries, we get higher productivity, real wages go up. And I remind you here that one of the proudest things I think that we have for the first term was real wages. Real inflation-adjusted wages went up significantly in the Trump term and down significantly in the Biden term. So this whole inflation thing, I mean, CPI comes out today. I mean, this dog bites men. It's Joe Biden bites the American people. It's a combination of a mismanagement of our supply chains by Biden and dramatic overspending. I mean, it's like Rick Santelli's worst nightmare to watch Joe Biden for 4 years add trillions and trillions and trillions to the deficit. And look, help's on the way. We're going to have drill, baby, drill. That's going to take care of a lot of what happened today in the CPI with things like fuel oil costs. We're going to have deregulation, plus the plus being the Doge effort. That's a positive supply shock. So that's going to come on down. We're going to have a lot of investment here. Tax cuts, which are going to be paid for in large part by the tariff revenues. And folks, this is the time of bullish in the Trump economy. I know the day traders are having a little fun today, but the future looks bright. What do they say? I need shades, right?
Peter, how all these things fit together? If the tariffs are not inflationary because they're absorbed by the exporters and the currency, and it kind of comes out in the wash, that doesn't create an incentive for domestic production because there's no price signal effect, there's no opportunity for market share. And then on the other hand, if you're relying on a across-the-board tariff on last year $3.3 trillion in goods imports, I mean, to even become a material bit of revenue for the federal government, you're going to have to keep that level of imports up and put tariffs across the board, and there's going to be no demand impact on it. I mean, not everything can actually come out favorably from imposing tariffs on the revenue side, on the inflation side, and on the domestic production side.
Yeah, Mike, I've always loved the way you think. Going back to the columns you used to write and everything, it's like the macro way of everything fits together. So let's like talk about how some of these adjustments are going to take place. I mean, again, history's on my side on this. During the first term, the capacity utilization rate in the aluminum industry up to 80%, which is above that threshold. That's where you have profitability and investment. Right down now, and we got there. But then Biden came along, gave up all these country exemptions, product exclusions, didn't let the customer look at things, and they slid back to near 70% in steel. It's astonishing, Mike. It's 52% in aluminum. And meanwhile, Australia is at 90% capacity utilization, dumping stuff in. What this policy does, Mike, is protect these industries from dumping. The bigger problem in steel and aluminum, massive global overcapacity propagated by massive government subsidies and predictable dumping. So what the steel aluminum tariffs do, it's not just that we have the tariffs at 25%, raising aluminum from 10 to 25, it's that we eliminate all country exemptions, eliminate all preclusions, and importantly, this wasn't noticed very much, we expand significantly the amount of downstream products that are covered. Because, as you know, what countries do when you put tariffs on slab is then they turn some slab into something else and they send it over here and they're non-tariff. But I'll tell you, I mean, Brazil's dumping slab at the low end. Japan's dumping high value-added stuff at the high end.
Peter, you're different on the micro here on these couple of import categories. I get it. You know, we kind of worked it, most of the tariffs, but we're not talking about across the board. You know, first of all, trying to counter European value-added taxes, which kind of aren't really a tariff, with tariffs of our own. It just feels as if you can around, and we're not really sure how this actually plays to our benefit down. I mean, are we going to be making T-shirts in North Carolina again? What's the ultimate goal here in terms of reworking our own economy?
Well, okay, the ultimate goal is rising real wages for blue-collar Americans, a thriving middle class. We have a strong defense industrial base and manufacturing base for our economic security and our national security. And when we are in times of crisis, we aren't dangerously vulnerable to foreign nations for medicines or metals or anything in between. And the $1 trillion trade deficit, this is a big thing with President Donald John Trump. We run a $1 trillion trade deficit every year. As Warren Buffett, of all folks, has pointed out correctly, that's a transfer of assets to foreigners of $1 trillion every year that turns into purchases of land and things like that. We got to stop draining that problem. And so the end state is a much more robust and secure American economy,
Peter?
and I think a better world, because these imbalances aren't good for anybody.
Peter, on the world thing, I mean, Mitch McConnell has an op-ed out today sort of warning about the isolationism and how we have to protect American interests and tighten our friendships and be a reliable partner. Do you think about the broader implications here of the geopolitical sphere at a time where we need our allies, imposing tariffs, surprise tariffs, getting them all upset about this, having them it makes us an unreliable partner. Do you worry about that?
Not at all. Not when I hear it from Mitch McConnell. I mean, come on. Mitch McConnell, these are the folks for the last 30 years that have encouraged our jobs to move offshore and open borders to welcome illegal immigrant labor to drive down wages for the benefit of a small portion of America. And all that has done, following the Pied Piper of the Mitch McConnells of this world, is decimate our economy and export our factories and jobs.
No, but there's security issues to be aware of, too.
It's time for Mitch to
I think he channels something
go
other
gently
investors
into
think.
this good night, because he, of all people, has been responsible for a lot of delays in up on the Hill in terms of getting good policy. So I'm not Mitch has a lot of credibility. He should look at some of the metals industries and energy industries in the state of Kentucky that are going to boom from President Donald John Trump.
Peter Navarro, thank you very much for coming on to talk through the motivation here. Good to talk to you from the White House.
Meantime, we're keeping an eye on Powell's testimony in a moment before House Financial Services and waiting for the Q&A to begin. Joining us this morning, former Kansas City Fed President Tom Honig's with us. Tom, one big question is whether or not we think the Chair is going to address some of the seasonality issues that we tend to see in the first half, and particularly in January. What do you think?
Well, I think he's going to, I mean, the CPI numbers came out this morning pretty strong. The CPI is up 3% overall, and core is 3.3. This is in the wrong direction. He's been arguing for some time that inflation is going to come down gradually, that monetary policy's modestly restrictive at least, and therefore this report is going to, I think, get him a lot of questions about what he's going to do, speculation on, well, are they not going to lower rates this year? They're going to actually raise them. So that'll be a big part of the discussion, I think, in the Q&A that follows his testimony.
Right. How do you think committee is going to be viewing tariffs. We've had a few discussions with some members. Goolsbee is a good example where they're going to have to find a way to determine what they filter through and judge in trying to decide what is demand driven right now.
Well, they're going to have a hard time because they have you modestly eased. So you're going to have that inflationary pressure. Tariffs certainly will have at least a one-time effect on prices, and how they react to that will determine whether that continues on. So if they see it as a cause, their rates will slow down. But if they say, no, we're going to continue to stay on our path to maybe lower rates, that could actually continue inflation higher. So they're going to have to sort that data out. And my own view is that Powell will keep his cards very close to his chest. Part of the reason being he doesn't know the answer to those questions yet. And he'll say more than once, we're going to be data dependent. We're going to follow this carefully, but he's not going to play any hands right now.
Did they make a mistake cutting too much last year? I mean, they went out of the gate with the 50, which was kind of a head scratcher, and then did 2 more 25s that felt sort of even hard to justify at the time. The economy was doing so well. Even though there was a lot of progress on inflation, it wasn't clear that it was going down to 2%.
Well, I think there was a little, I think they were too aggressive. I mean, where they've lowered it 100 basis points. They probably could have lowered it 50 basis points and still been restrictive. But by lowering it 100 basis point, the first time, as you said, 50 basis point, they've actually brought real interest rates down below 2%. So their policy rate is 4.25. Inflation is now 3%. So they are. I said 5.25. Anyway, their real rates are now below 2%, and that's modestly easy. And so they're going to have to justify that, or they're going to see inflation continue to rise, and then they will be in a hard place. If they have to raise rates, it will really shake up the markets. There's no question about that. And I don't get doing that anywhere in the first half of this year, and it'll depend on where the inflation numbers come out in the next 2 to 3 months.
The Fed chair, I think, is wrapping up his...
They did do too much, yeah.
Fed chair is wrapping up his prepared remarks. We're going to take Q&A in just a moment, Tom. He did say yesterday that he would not answer any questions about what the president has said about rates or the Fed. I assume he'll get asked again. The president did post this morning saying interest rates should be lowered immediately. How do you characterize the Fed's reaction function when it comes to outside pressure, especially from the Oval?
Well, he's going to, like I say, he's going to keep his cards close to the vest. He's not going to say anything. What he said yesterday, he's going to repeat today, because he can't commit to any further rate cuts right now with inflation going the wrong way. And I think even the committee knows that. And so they're going to be fairly quiet until they see them out more through the first half of this year. And there's so much uncertainty. You know, what is going to happen to tariffs? What are they going to do with it? How, is he going to stay with them or not? What is going to happen to labor costs? These are things that no one can answer at the moment, and therefore he shouldn't try. And I think that what they need to do is be more cautious in of their forward guidance. They should, when they have a meeting, they should announce their action and stop there. This forward guidance only makes matters, I think, more confusing.
Yes, that does bring...
And get rid of the dots, Tom. I think the dots are confusing.
I'm not a favor of the dot plots at all. They're all over the board, and they're everyone's guess. They're not really a good indication of what's going to happen in the future. It's a dartboard.
That is an age-old debate. Tom, appreciate you helping us raise the curtain on today's here. Talk soon. Thanks.
Thank you much for having me on. Take care.
You too. Let's get to Bob Bassani now. More on what's moving ahead of that Q&A. All sectors lower. We're down on the overall indices. Bob, on that disappointing?
Well, look, here, you can see obviously defensive sectors doing a little better. So healthcare, consumer staples holding up better, energy, interest rate sensitive stuff, no surprise, down. So real estate's down, bank down this week, but not that week. If you look at what's going on here, this is really quite remarkable. We're right near the highs for the day. A bit of a fight here going on between the bulls and the bears, because This is a very difficult moment. We have two problems. We have tariff uncertainty, and now we have Fed policy uncertainty here. And yet you look at the stock market here today, we are 1.8% off of an historic high. That's virtually a rounding error at this point. So the market seems to be trying to price out Fed rate cuts this year, and they seem to not want to believe that there's going to be really serious tariffs, because we're still looking at 14% growth 2025. If you believe there's going to be tariffs of these kinds of magnitudes, that's not going to be 14%. That number is going to be maybe the high single digits. So the market obviously believing some kind of deal of tariffs is going to be made. They may be wrong on that. So today the game here is watch Powell. If Powell leans dovish, that's going to bring the markets. You may even go positive on that. I'm not sure, but that's going to be the game to see whether Powell leans in that way. And if he does, I think the market's going to recover even more here. So it's kind of a jump ball on how we end the day. On the earnings front, these numbers we've been getting are just fantastic. And by and large, we're not seeing a serious drop in 2025 estimates. The final 2024 numbers are way above expectations. The beats are above expectations. We're beat by 7 or 8%. That's way above the historic norm. The numbers on 2025 are not dropping dramatically right now, even though we have been hearing about tariff uncertainty. Nobody's been putting a number on it. Nobody's been coming out and saying our numbers are going to be clearly lower. The companies doing that are very, very small right now. So I put the main risk right now on the tariff uncertainty, and we'll keep an eye on that. But let's watch Powell and see what happens here.
Yeah, I guess, Bob, we should definitely see if he does address with any directness. But I wonder if the market is really dying for an ultra dovish message, or just if wait and see is good enough. Right now, there's only one cut price for the rest of eternity at this point. But I guess we have to get into the Q&A right now.
Over the past 2.5 years, the outgoing vice chair for supervision has pushed new regulations that would move the United States towards a one-size-fits-all approach to prudential regulation that disregards the congressional mandate that's been quite clearly established for regulators to tailor bank regulation based on an institution's size, complex. Earlier this year, the bar would be stepping from his position as vice chair on February 28, 25, or earlier, should a successor be confirmed. Significantly, the board also announced at that time that it does not intend to take up any major rulemakings until a vice chair for supervision successor is confirmed. I've discussed this with you. I've got concerns about that. You're not abdicating your supervisory response while we wait around for a vice chair for supervision. Do you agree that it's the Board of Governors that has the responsibility for bank supervision policy?
I do, and I would also agree that we need to carry on with our regulatory supervisory duties. We can't take a holiday, and we will pursue things that we should be proceeding with.
You testified in the Senate yesterday, and I know you enjoyed time with the senators, and you talked a little bit about Basel III endgame. And again, in my opening statement, I talked about that the intent was to harmonize those rules, true, for the largest institutions in the world, but also do that in a way that's capital neutral. Chairman Barr's approach was gold plating already high standards for American banks. You testified yesterday that you think bank capital levels are about right for those large institutions. Would you tell the committee today that it's your intent to repropose a Basel III endgame approach, just speaking on behalf of the Fed only, not the others, and that it be take into account the comments, and that it be generally capital neutral?
We do intend to repropose Basel III endgame, and we intend to do that just as soon as we can get together with the new leadership at the two other banking agencies. And as I mentioned, I think we can do that pretty promptly once those people are in place. I look forward to doing that. My long-held view, as I've said in many of these hearings, is that capital in the banking system for the largest banks is at about right, and that would be my starting point on going into these discussions. But I do want to defer. I want to lead for my upcoming new leadership at those agencies to have their own views on that.
I think that's important. I think it needs to be coordinated and harmonized among the supervisory agencies, and I do take into account how Basel III endgame proposal interacts with other pending rules, whether they're on liquidity or the other things like operating risk in the companies. I think that was a lot of centrality of the comments that we saw on your bar proposal. Turning to monetary policy, looking back at 2020 and 2021, I was looking at all the monetary policy rules that were in your semi-annual report. And had you followed any of the monetary policy rules that you track, they would have had you tighten sooner in the cycle rather than waiting. And I think that could have reflected maybe not seen us have a 4-year high inflation. Using the benefit of hindsight, do you think you should have looked at those rules more closely in the open market operations? And
said before that hindsight suggests that it would have been good if we had tightened earlier. I don't know how much difference would have made, but I'd be very careful with those rules. Those rules in the middle of last year suggested that our policy rate was a couple hundred basis points too high. You know, so we need to, they're a starting point, not an ending point.
Right. But we've had this conversation before. The point is that they do offer a roadmap. You do mention them in writing in your monetary policy reports, except for one time during the pandemic. And I think, though, that you're adding that to your reference point in your forward guidance and in your communications, I think would be important. Can you tell us about the review of the inflation targeting and when you expect to complete that?
Expect to complete it by the late in the summer this year. We're just beginning it now, and we're going to look at all the decisions that we made when we made them back in 2020. We're going to ask ourselves what's changed. We're going to be open to criticism and good ways of thinking about it, and we'll make appropriate, discrete adjustments.
I thank you for being with us today, and I turn to the ranking member of the full committee, Mrs. Waters, for 5 minutes for your questions.
Thank you very much, Mr. Chairman. It is no secret that President Trump, what he wants to do, that he wants to do away with the Federal Reserve altogether. He said he knows interest rates much better than you do. I want you to know that some of us here have been fighting to make sure everybody understands the importance of the central bank. Every country dealing with crypto, their central bank is involved. Of course, Trump and the opposite side of the aisle fought us. And that's one of the reasons we were not able to come together with a bipartisan agreement on stable coins. You previously said that you would not resign if Trump asked you to do that. Do you stand by that commitment?
I have no changes to that.
I can't hear you.
Yes.
Thank you. Please let the record record that adequately. I appreciate it because you have a right to your position not to be interfered with by law, I believe, or even Constitution. When Musk comes knocking at the Fed's door, you going to let him in?
I don't have anything for you on that.
Would you like to tell us today that you won't let Doge into the Federal Reserve or have access to the systems and the data?
So we don't have any, we've had no contact, and I don't really have, I have nothing for you to report today on that.
Well, you know what happened to Treasury, and you know what happened over at the FEB, and the people of this country are being violated because all of our privacy is being taken up by Elon Musk and Trump, and we don't know what all they have on us, our bank account, everything that in our lives. So I want to protect it in the Fed. Mr. Powell, the last time you testified before this committee, you said, and I quote, really successful institutions in the United States generally are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table. That is the way we feel about it. And at the Fed, and that is what we've been doing and will continue to do. Chair Powell, how will you ensure that the Fed continues to attract the best and most diverse employees?
We're institutions like ours, private and public, are in a constant contest to hire the best talent in the country. And we've all learned, I think, and certainly we have, that we will go anywhere to find that talent. and including places that we didn't go 25 years ago. And we'll just continue to do that. You know, we're recruiting, as you know, at many, many, many universities and colleges, including historical black universities and colleges, and others. And that's what we find, and that's our practice. We think that's the best way to go about it.
Thank you very much. And that's what I've always felt about the Fed. No matter what they call it, you only attracted and hired the best qualified people in your operation, no matter what they refer to it as, what they call it, whatever way they define it. Is that right?
Yes.
Thank you very much. Sir, how are you willing to provide my staff with an immediate briefing from your agency on the status of your OMWEs and Equal Employment Office?
Yes.
Thank you. I believe that you know that the OMWEs were created with Dodd-Frank reforms. It's in law. And as I understand it, any attempt to dismantle OMWEs would have to come before the Congress of the United States of America. Is that your understanding?
Well, yes. Section 342 of Dodd-Frank, which is the OMWE section, is the law.
Thank you. Chair Powell, to what extent have you consulted with other board members in determining how your agency is complying with Section 342 of Dodd-Frank and as well as any other federal anti-discrimination law?
I think we've consulted with senior staff and board members quite a bit.
Chair Powell, days after his inauguration, President Trump issued an executive order on digital assets, which includes a prohibition on central bank digital currencies, or CBDCs. The executive banned any, quote, form of digital money or monetary value denominated in the national unit of account that is a direct liability of central bank. I'm concerned that this extremely broad definition could go far beyond CBDCs. Well, thank you very much. My time is... Stand up for your right
Gentlewoman's
to be the
time
chair.
has expired.
And
But
I now yield. Thank you.
But I do invite the chairman to respond to the gentleman's question on CBDCs in writing. And now we turn to the vice chair of the full committee, Bill Heisinger, the gentleman from Michigan.
Thank you, Mr. Chairman, and Chair Powell. Good to see you again. You had talked a little bit about your review. I'm going to start there. Obviously, a lot has changed in the last 5 years. Pandemic, inflation, higher interest rates, to name a few. However, I believe your dual mandated maximum employment crisis should remain the ultimate objective. I assume you agree with that. Let the record reflect slight head nod on that, I guess. This committee is going to be very focused on monetary policy, and with my good friend from Oklahoma, Mr. Lucas, chairing a task force that I'm happy to be a part of. We're going to be addressing some of those issues. Chair Hill touched on some of the rules that have been discussed. I, for one, have always been particular to the rule, but there's a number of rules. I know you go through those. At one point, I suggested that we could call it the Yellen rule with Chair Yellen, but there needed to be some sort of public declaration of what to benchmark against, and I still feel that is of some importance. You outlined your timeline on this particular review, but I'm curious, do you believe that the last policy framework limited the Fed's response to raising inflation, thing that you talked about over the years?
No. I'll tell you why we didn't raise rates. We thought the inflation was transitory. I can show you forecasts from the end of 2021 by us, by staff, by the blue chip. Everybody thought it was going to be transitory. That's why we didn't raise rates.
And I also distinctly remember a hearing where you and Secretary Yellen at the time were sitting next to each other, and it looked like you visibly scooted away when I asked you both whether it was still transitory, and you had, for the first time ever, a separate answer. Her answer was yes, it still was transitory. You gave a very Fed's answer of, we no longer believe the data shows that. So no. And to kind of go to Chair Hill's point, a little late on that. On back to the review, I'm curious, what sort of input are you looking for from the public and from Congress as you go into that review?
So from the public, we'll do a series of Fed Listens events, which were very successful the last time. And it involves us sitting down and meeting with people, some of whom know a lot of what the Fed does, some of whom just tell you what's going on in their communities. It was really, it was a very successful part of our outreach last time. In terms of Congress, you know, we'll keep you informed of our progress. We welcome anything you may offer. But, you know, it's a public, we're open to the public on this. It's a public review as distinct from what we were doing before, and so we're welcoming views from all over.
And not to get ahead of the chairman, but I look forward to us having more conversations about that with the working group. I want to switch topics and focus a bit back to the bank supervision. Michael Barr has stepped down from his position as vice chair for supervision effective at the end of the month. And whether, frankly, President Trump fills that position is entirely up to him. But in the absence of a vice chair of supervision, you're still working, I think, on it. I think your quote to the chairman was, "There's no time for a holiday." Now, this vice chair of supervision is a Fed governor that has, frankly, extraordinary powers and responsibilities. And ultimately, my question to you is, does the Fed really need a separate vice chair to complete its work? Now, I got here after the 2010 election, 2011, shortly after Dodd-Frank was passed. I know this vice chair position was created by Dodd-Frank. I've just been dealing with the echo effects now for the last going on 15 years of Dodd-Frank. Do we really need to have a separate vice chair of supervision?
So for many years, as you know, we did this without a vice chair for supervision. What that means is everything goes through the full board.
And it was effective?
I think it was, and also there was less volatility.
Explain that. Why was there less volatility?
Well, because you've got a group of 7 people on the board, and there will be some as appointments change. There'll be some changes in the approach regulation, but putting it all in a single person, admittedly just to recommend to the board, can lead to sort of some volatility in these things, which is really
larger swings in policy.
Larger swings and the kind of things, and that's not great for the institutions that we want to regulate. We want to have a good set of regulation that doesn't back and forth very much. The question of whether it's a good thing to have in the law is really one for you. But I will tell you, we will once Vice Chair Barr completes his term in a few weeks, we will continue on until there's a new Vice Chair for supervision, and we can very much get our work done.
Or if there is one. So with that, Mr. Chairman, my time is expired.
I thank the Vice Chairman. Mr. Heisger yields back. Recognize the gentleman from California, Mr. Sherman, for 5 minutes of questions.
Chairman Powell, you are the only bipartisan person or thing left in Washington. You were appointed by Obama. Trump gave you a promotion. Biden reappointed you. And you are the only Biden appointee not to hear the words, "You're fired," from our president. So I hope we listen to what you have to say, because you're the only person that I can identify in Washington that has support on both sides of the aisle. Mr. Huizenga mentions the importance of your dual mandate. Project 2025 calls for abolishing the dual mandate and eliminating a mandate that you focus on employment. If we were to give you just one mandate dealing with price employment, over the next 10 years, would our GDP be higher or lower?
It wouldn't be possible for me to say.
Does the fact that you focus on employment as one of your dual mandates lead to lower unemployment, higher employment in our country?
It may do so. We do balance those things. To some extent, that may be right.
Chair Hill spoke about how important it is that you maintain your independence. I noticed that in light of the hiring freeze, the Fed has removed all its job postings. I'm hoping that your personnel policy will be as independent as everything else at the Fed. But I'm more concerned with the president's statement at 7:58 this morning, where he said interest rates should be lowered. He said it. Will that influence what the Fed actually does?
as a practice, never comment on anything the president says, but I think people can be confident that we'll continue to keep our heads down, do our work, make our decisions based on what's happening in the economy, the outlook, the balance of risk. That's correct.
Thank you. And he went on to say, he said interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. I certainly agree with the rock and roll America, but the Peterson Institute says that the policies that the president ran on will raise CPI by between 4 and 7.5 points. And I think the biggest element of that is the proposed tariffs. If we have higher tariffs across the board, say 10 to 25%, would that increase the cost of living? And would an increase in the CPI or related index to the cost of living lead to higher interest rates?
You know, there are many organizations, public and private, whose role is to speculate publicly about what this might be. What we're doing is we're reserving judgment until we actually know what the policies are.
But if we have a higher cost of living, does that lead to higher interest rates? The CPI goes up, or CPE, excuse me?
Well, if inflation goes up in general, forget about tariffs. In general, of course, we will use our tools, which is the interest rate, to bring it back down to 2% over time.
Okay. Yesterday, you told the Senate we're going to release the stress test scenarios before we implement them. Will you take a holistic look at large bank capital requirements, including the risk-based capital ratios like Basel III Endgame, stress testing, to make sure that you don't have a contraction in the ability of credit to Main Street businesses? There's a proposal in Project 2025 that we abolish Fannie and Freddie. If there was no explicit or implicit federal guarantee for those who invest in mortgages, would that lead to higher mortgage interest rates?
Since you're no longer be borrowing on the credit of the United States, in other words, so Fannie and Freddie would be privately funded, it could lead to that. I think privatizing Freddie and Fannie might have other virtues too, though, as has been considered many times by this committee and others.
Might have some virtues, but it would lead to higher mortgage rates.
It could.
The CFPB has been put on ice, but all the regulations remain in force. So if you're a bank that wants to comply with those, and if you're a bank that doesn't want to comply, the next presidential election may put into practice a CFPB that enforces all the regulations that the Trump administration has tried to eliminate. Does that cause confusion for banks?
You're speculating about what the situation might be. I would say that it could.
Yeah. I yield back.
Gentleman, use back. I now recognize myself for 5 minutes. Chair Powell, let's talk about the balance sheet. As we've discussed several times before, the consistent and massive growth of the federal debt creates long runs and saddles future generations with an onerous burden. The Treasury market expands in kind. As the Fed engages in quantitative tightening, allowing the Treasuries to roll off, the Fed is careful to ensure that there are ample reserves for the balance sheet. Could you briefly discuss the conditions that determine the ideal level of reserves?
Sure. So let me say that we intend to slow, and we have slowed, but then stop the process of shrinking our balance sheet at a time when we think that reserves are somewhat above the level that we judge to be consistent with our ample reserves framework. So what that means is we want reserves to be ample, meaning we don't want to suddenly appear to be shortages of reserves. So we're going to think of where those shortages might appear, and we're going to put a buffer on top of that, because nothing good happens when there's not enough liquidity. So that's our overall framework. And right now we feel like all the evidence suggests that reserves are still abundant, which is more than ample.
As you know, in early 2021, the Fed stated that it would invite comments on the supplemental leverage ratio. That has not happened yet. I've made the point that the growth of the U.S. Treasury market paired with a decreased willingness of banks to act as intermediaries is a major issue on the horizon. When former Treasury Secretary Yellen was before this committee last year, I asked resiliency of the Treasury market, specifically about the wisdom of permanently modifying the SLR. She said it's something that the banking regulator should consider. Does the Fed plan to finally look at the SLR?
Yes, I believe it will. I have, for a long time, like others, been somewhat concerned about the levels of liquidity in the Treasury market. The amount of Treasury has grown much faster than the intermediation capacity has grown, and one obvious thing to do is to lower, is to reduce the effective supplemental leverage ratio, the bindingness of it. So that's something I do expect we will return to and work on with our new colleagues at the other agencies and get done.
Because I think my colleagues are aware that over the course of recent times, literally we have 8 times as much debt to process, but only half as many major market makers. The Federal Reserve is not immune to politics. You, like every Fed governor, go through a lengthy confirmation process, and of course you're required to answer to Congress in hearings like this. I can trace a major political turning point at the Fed to the passage of Dodd-Frank, which greatly expanded the Fed's regulation and supervision authority. Chairman Powell, do you worry that the independence of the Federal Reserve's monetary policy function is in any way hindered by its role as a bank regulator? Can you do both?
Well, we can and we do, and we'll continue to do that. Clearly, the regulatory and supervisory side is more contentious in political circles, but we will continue to carry it as best we can and to do so in a non-political way as best we can.
And clearly that'll be a major discussion topic in the task force. In our remaining time, could you discuss the Fed's 5-year review of monetary policy? What are the categories of issues you think that will be helpful to receive feedback on?
So a good part of it will be looking at the changes we made in 2020, which were made in an environment where we had been stuck at the effective lower bound at 0 for 7 years. And the highest we got really was sustainably was 1.5%, and that was the highest of any advanced economy. So the concern was that at the slightest downturn, we'd be back at the 0 lower bound and we'd be stuck. So we were looking for ways to make up for that. So then the question is, we got this inflation out of the pandemic and the events related to it. Are we in a different place now? And I think the chances are pretty good that maybe that the effective lower bound is still a concern, but it's not the base case anymore. So we need to look at that and decide how what are the implications of that for our framework.
Thank you, Chairman. I look forward to several more discussions on these topics. And with that, I yield back the balance of my time, and I recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Chairman. Chair Powell, thank you for being here today, and you've indicated in past hearings that geopolitical tensions pose important risks to global economic activity. In fact, around this time last year when you appeared before the committee, you and I discussed how conflicts in the world, specifically the war in Ukraine, had impacted the cost of things like groceries in the United States of America. At that time, you indicated that the war had caused commodity prices to move sharply back home. Does that sound correct to you, or unfamiliar to you?
Yes, it does.
So just to reiterate, in this interconnected world that we live in, would it be safe to say that economic instability in other countries has the potential to impact economic factors here in the United States?
Sometimes, yes.
And so, given that move for the United States government to remove one of our most effective strategic tools that, by mandate, assist U.S. commercial interests by supporting developing countries' economic growth and building countries' capacity to participate in the world trade. Would you agree with that?
It's not for me to be the judge or to say on that.
Well, we do know that a number of, like USAID, they buy a lot of their agricultural products, etc., from American farmers. And in fact, it helps the U.S. economy when you look at the volume of agricultural products that are being bought so that we can continue to be a part of the rest of the world. Would that be correct?
As far as I know, yes.
So, today we find ourselves facing a situation where the president and his Dodge buddy Elon Musk seem hell-bent on dismantling USAID, no matter the consequences, even if they are dire. To me, the assault on this congressionally authorized body represents an attack on the rule of law and should outrage every member of this body. Every member, Democrats and Republicans alike. And I know that your interest is squarely within your dual mandate and not foreign policy. I sit on both committees. I'm here, but I'm also the ranking member on the Foreign Policy Committee. And so I can't sit today and pretend what we're doing won't impact employment and economic stability right here in the United States of America. Weakening USAID will fuel global crises, endanger American security, embolden other nations like China and Russia, and leave us here in the Trump administration solely responsible for the fallout. So I have to take this opportunity to urge my colleagues on the other side of the aisle to also stand up for USAID. Anytime we travel, we go visit what they do. We go visit the good that they do. We go visit what their and how their economies improve so that they can be part, if not because people just care about the rest of the world, then because we care about our country and recognize that instability elsewhere threatens our stability right here. It is extremely important in an interconnected world because the economy is interconnected around the world. We cannot isolate ourselves from the rest of the world. I thank you, Mr. Chairman, and I yield back to my time.
Gentleman yields back. The chair recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. With greetings from every single member that we appreciate and respect you taking the time, even though you're respected here. We think you show up and we admire you. Mr. Chairman, you and I both know that way back when, and we assume 21, that there was a decision made by the Fed that gets close to quantitative easing and then the term tapering. And we know that it was sold as a monetary stimulus to help the country, and I get that. There was about, in my opinion, $2.33 trillion that were taken out loans. And Chairman just spoke a minute ago about the term debt versus growth. Debt versus growth, about this amount of money that sits out there on the debt side. Could you please take a minute and discuss this issue and how we should be looking at it? Thank you.
Sorry, Mr. Sessions, are we talking about asset purchases that we made during the...
We are. We're talking about went and sold treasuries.
No, we bought treasuries.
Yeah,
we bought treasuries. So, it was a situation, I'll tell you why we did it. We were just out of the worst part of the pandemic, and we didn't know frankly, how good things were going to be, how strong the economy. We were very concerned COVID is still raging, and it actually, had a very strong wave right into 22. But we wanted to we didn't want to stop buying treasuries too soon, because that has a stimulative effect on the economy, because we didn't want to provoke an unwanted tightening in financial conditions at a time when we thought the economy was still vulnerable. You look back in hindsight, we probably could have done that earlier and halted purchase earlier. In any case, we turned right around and started shrinking the balance sheet, and we've done.
You moved it from about 120 a month to 110.
Well, we're down now. We've been tapering for 2 years now, and we're down more than $2 trillion. So, and we're still going. So that's why we did what we did.
Tell me what that looks like in the longer term aggregate versus with what Chairman said, debt versus growth, because we believe the debt remains and the growth is not equaling that ability to pay it back.
So what is we borrow money to cover the spending that Congress has done. Our purchases don't affect that. We're basically issuing reserves, which is cash, and we're retiring Treasury securities. And the effect of that is to drive down long-term rates. That's the whole reason for QE.
And what are you paying for those long-term rates?
Market rates. We're paying exactly the market.
And what would that market be approximately a year ago or to now?
Well, 10-year, we're not, of course, going in the other direction now. We're shrinking now, but
we are.
Buying, the 10-year was yielding a very, very low yield, and it was quite low during the pandemic, extremely low, because, growth was slow. There was a lot of demand for treasuries. So we were pushing down rates to support economic activity. That's when you can't lower your policy rate anymore and you want to do more stimulus, that's really the main thing you can do. It's actually the forefather of that was Milton Friedman, who came up with that thought way back in the past. But that's what we did. And then, as I mentioned, we turned around. As soon as we lifted off and started raising rates, we immediately started shrinking the balance sheet, and we shrunk a lot, $2 trillion and still counting.
You have shrunk it $2 trillion?
Yes, we have.
What you believe remains, and you believe you're now able for moving forward?
So I think we have a ways to go. Actually, the level of reserves, which is the thing we're focused on, hasn't really changed. All of that has come out of what's called the overnight reverse repo facility. I'd be happy to spend some time with you on this. This stuff is very complicated.
Yes, I'm trying to find new data on it, and the last I found really was a CRS report of 22. So
what's very big
27, 22. And so the changes that you speak of are important.
Yeah.
And so I would appreciate that time.
Be happy to do that.
Great. I want to thank you for being here. The confidence that the American people have that we will turn not just the economics of their lives, but of the country is very important. Today spoke about the country, and I want to thank you for your service and time. Mr. Chairman, I yield back.
The gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Chairman, and welcome, Chair Powell. Chair Powell, I'm worried about these tariffs with us. Your thoughts on these tariffs? I'm worried about, I think, the president is wrong here. Tariffs can cause a terrible situation to the economy. I'm concerned about the inflationary impact on tariffs. And where cost increases from the tariffs, there's a cost to these tariffs. And we need not move into this area blindly. And some of these costs will be absorbed by business companies, but there are other costs that will be borne by the American consumers. We don't even understand it. And yet you have the president just using these tariffs as a means of fight or like a war. And this is going to do it. Everybody is not going to be Mexico or Canada. And while we got a little time, I want your thoughts on the dangers of these tariffs. The stock market is anticipating rate cuts. What will these tariffs do about that? Does the Fed see financial market stability as a factor in its decision-making process when considering the rate cuts? And here is specifically what I want you to get to. In light of the president, and politely I will say, his ill-crafted tariff strategy, do you foresee future rate cuts as a result of inflationary issues or due to a weaker labor market? And what do you consider to be promising inflation data? That's a big fight. And these tariffs are going to just add to inflation like a rocket ship. Your thoughts.
So,
and share with us, give us your opinion of the danger of these. There's a cost here. Tell us what you think about this.
The president has certain authorities over tariffs. Congress has authorities over tariffs. The Commerce Department is involved in some ways, but the Fed has no role in setting tariffs. And we don't comment on decisions made by those who do have that authority. We try to stick to our own knitting. In this particular case, it's possible that the economy would evolve in ways that, because of tariffs, or partly because of tariffs, that we would need to do with our policy rate, but we can't know what that is until we actually know what policies are enacted. And remember, it's not just tariffs. There are significant changes to immigration policy, fiscal policy, and also regulatory policy. You put all four of those, and all four of those were things that the president was elected to do. We will then try to make an intelligent judgment about the overall effect on the economy of those, and conduct our policy accordingly. But it's not our role in any way to comment on the wisdom of the policies that are enacted by Congress or by the administration.
Will he have an effect on whether or not you will resume your plan to cut the interest rates this year or continue to hold?
So we'll make our decisions as we go about what to do with interest rates. It's on data that we see, the outlook, the evolving outlook, and the balance of risks. And we'll be considering all of those things. It won't be focusing on any particular policy, and I can't tell you what we'll be doing, because it will really depend. It's fairly uncertain environment right now.
Yeah.
The underlying economy is very strong, but there's some uncertainty out there about new policies. We're just going to have to wait and see what the effects of those policies are before we think about what we can do.
Well, I want to say, God bless you. I know your strength. We've worked together over the years on many things, and this nation is grateful that we have you, your wisdom and intellect at this time.
I agree, but the gentleman's time expired. Chair now recognizes the gentlelady from Missouri, Ms. Wagner.
I thank the chair, and it's good to see you again, Chairman Powell. Chair Powell, under the Biden administration, American families were hit with a huge stealth tax from, as we've spoken about, inflation that drove up grocery prices and led to high rates on things like mortgages and car loans. Since 2021, the average Missouri household is paying about $1,100 more per month due to inflation. To put that number into perspective, the median family income in Missouri is $69,000. These families have had to spend $13,000 more of their annual income on the exact same goods. What specifically is the Federal Reserve's plan for making life easier for everyday Americans?
So the best thing we can do for Americans is to vigorously pursue stable prices and maximum employment. That's We're trying to get back to a long expansion where prices are stable around 2%.
You seem to be on labor, as you've pointed out, so tell me what else?
Sorry?
You seem to be there on labor, so what else?
You know, I would say we're close but not there on inflation. And you just see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress. We're not quite there yet. So we want to keep policy restrictive for now so that we can see.
We're definitely not there. 30-year mortgages, you know, it's 7%, Chair Powell. So let me switch topics. I continue to believe that, as we've spoken about, and as was brought up prior colleagues here, that the federal banking agencies, including the Federal Reserve, should scrap the flawed Basel III endgame proposal and start over. You talked a little bit about how you plan to perhaps do that, and a timeline potentially. But how will the public, Chair Powell, be able to provide comments on any revised proposal as required by the Administrative Procedures Act?
I fully expect, I think it's a good idea for the United States to finish Basel III in a way that's, you know, in keeping with Basel and also with what other jurisdictions are doing, comparable jurisdictions.
The key there is end game. This has been going on for 2 decades.
Where's the end already, right? So, you know, we'll put all that out for comment again and welcome the comments for all commenters.
I should make sure we're following the Administrative Procedure Act.
Oh, yes.
As you move forward.
We will.
I understand you are interested in making the stress test scenarios that assess how a bank will perform through a crisis more transparent. As things stand now, while the Fed may make some information public, it doesn't show its math, which makes it difficult to assess the robustness and analytical rigor of the stress tests. Recently, the Federal Reserve announced that due to the, quote, evolving legal landscape, it would begin to take public comment on its stress test models and annual scenarios. Can you describe describe the changes in the legal landscape that have caused the Federal Reserve to suddenly seek public comment on its stress test regime, and why it did not seek public comment from the beginning?
So we're an agency that's strongly committed to following the law as written by Congress and as interpreted by the Court. In the past years, we've seen a string of administrative law cases from the Supreme Court which are dealing with different issues, but there's a common theme. That is significantly less deference to the views of agencies as compared to those of courts. Also just a raised expectations for compliance with the Administrative Procedures Act. We take that very much to heart, and this is one of the things that, and we feel
you can look at things like Chevron deference. You can look at the EPA ruling by the courts, and they're returning the power back to the people and the Congress, not the administrative state, not those agencies or rulemakers.
So because of those things, you know, we are putting, as you went through it, we're putting the models and everything else out for comment and taking similar steps.
Well, I'm glad to see that. I understand the Fed intends to complete a comprehensive review of its monetary policy strategy, tools, and communications practices. You mentioned that. What is the timeline?
We expect to complete our work and announce the results by the end of the summer.
Thank you. I yield back.
Gentlelady yields back. Chair recognizes the gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chair Powell. Good to see you. Thank you for your good work. Chairman Powell, the Senate just filed a bill called the Genius Act. I'm always worried about anything that comes over from the Senate with the title Genius in it. But it is an attempt to provide a regulatory framework for cryptocurrency. And in that proposal, which is similar in some respects to the House proposal, it would allow individual states to oversee issuers, and there would be no central federal authority. The idea is to disperse the responsibility from state to state. My concern, my overriding concern, is that with that spread of an expansion of crypto, and the president is 100% behind it. He just started his own meme coin. He's making a lot of money off of that, which is another issue. My concern is that the spread of an expansion of crypto will infect the traditional banking system because it's a volatile, speculative asset, and we've seen some very sudden disasters with crypto. I'm just wondering, are there any backstops that we can use, any firewall that we can put in place that might insulate the traditional banking system, because they have access to the discount window and they're FDIC insured, so there may be, second order impacts if we have a collapse of a major crypto issuer. Are there any extra things that we can do to protect the traditional banking system?
Yes. So, first, I would say there are really two things that are happening. One is banks are serving crypto customers, and we don't want to get in the way of banks serving perfectly legal customers as long as they understand the risks and that sort of thing. We don't want to single out any particular.
Are you speaking to custody?
Well, custody is more, the second thing is undertaking activity on their own. Right. And in that case, I do think it's appropriate to as usual, as bank supervisors, make sure that we understand and banks understand the risks that are involved in the activity that they're taking inside an insured depository. On the other hand, you don't want to go too far. I think there were a bunch of disasters, as we all remember, and we don't want to, and we were reacting to some extent to those. You don't want to go so far as to overplay your hand on that. So I think we need to be mindful that many of these activities can very well be done inside of banks, and custody may well be one of them. In fact, in Fed-regulated banks, there are lots of crypto activities happening now. They just happen under a framework where we made sure that the bank understood and we understood exactly what they're doing.
Right. We also have the example of, Silicon Valley Bank and Signature Bank, First Republic Bank. One of the triggering events there, the risk management was very poor in that respect, and they got on the wrong side of interest rates. But there were also some failures of issuers who had huge deposits at Silicon Valley, I believe, or Signature, or maybe both of them. And the suddenness of their collapse caused a run for the exits. And luckily, with a scramble, we were able to sort of save that situation, so it didn't create a greater contagion. But are there steps that we can take that might strengthen our ability to respond to that type of collapse as well?
Yes. So in the wake of Silicon Valley Bank, we did work with many medium and sized banks that had any of the characteristics that we saw. And you mentioned, a long position in long-term security that was underwater, along with a very unstable deposit base made up mostly of uninsured deposits. And in the case of Silicon Valley Bank, it was a lot of similar private equity and venture capital and hedge fund companies where they all just pulled their money at the same time. So it was a bank run, which run very destructive whenever they happen. So we looked for that pattern. We worked with companies who had any aspect of that pattern, and it was definitely, I think, in not having crisis spread very broadly, and that was a good thing. Looking forward, though, we need to not forget that lesson and make sure that funding bases are stable and that we're focused on the basics of banking, which is credit risk, interest rate risk, liquidity risk.
Gentleman's time has expired.
Thank you. I yield back.
Gentleman yields back. Chair recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Chairman Powell, let me ask you a quick monetary policy question and then turn to bank regulation and treasury market structure. I know hindsight is 20/20, but it's important to learn from mistakes, as you know, and you've conceded that the Fed miscalculated on inflation, mischaracterized inflation as transitory in 2021, 2022 time period. Given that inflation remains stuck above the Fed's 2% target, will you commit to scrapping the flexible average inflation targeting framework? And if not, why wouldn't you commit to returning just to a simple 2% target?
So we're just beginning the review. It'll be done, as I mentioned, by the end of the summer, and that's the exact question we'll be asking. I can't commit to a particular outcome. I need to listen to the views of the other 18 participants on the FOMC.
Yeah, I appreciate that, and I just hope that in that process that you and your colleagues recognize that that framework allowed rising inflation to persist and allowed the Fed to mislabel it as transitory. Let me turn to bank regulation. In October of last year, I led a bipartisan CODEL to Basel, Switzerland, met with the Basel Committee on Bank Supervision, and there the committee actually conceded to us, agreed with me, that the Michael Barr proposal of July 2023 actually gold-plated capital requirements, and instead of actually promoting international harmonization, actually made American banks less competitive. They conceded that to us. So I applaud the Fed for not moving forward on that July 2023 proposal that would have made it harder for large banks to, among other things, facilitate the smooth functioning of the U.S. Treasury market, including holding treasuries on the balance sheet. Couple questions. One is, should the goal of our bank capital rules, should it be regulatory harmonization internationally, or should it be American economic competitiveness?
I mean, clearly American economic activity and growth, that's the ultimate goal. What you get from Basel is a global floor so that the other banks can't run on less capital and sort of have a short-term advantage. That was the whole point of Basel, was to get everybody to the same kind of level so that it wouldn't be the risk of the bottom.
And I see that utility, but I think the goal of our regulatory system should be America first, and it should be about American economic growth and competitiveness. But let's talk about the Treasury market issues. Obviously, we're issuing a ton of debt right now. In fact, according to BlackRock, we're issuing $573 billion of Treasury bonds every week. To put that in perspective, the entire national debt of Australia is $573 billion. So we're issuing Australia every week in this country, if you want to think of it that way. Would reducing excessive capital and liquidity requirements on U.S. banks for intermediating U.S. Treasury market take the heat off of U.S. capital markets and increase Treasury market liquidity and stability?
I strongly think it would help.
Well, I think that's especially an important comment in terms of your regulatory approach. Maturing bonds were being financed at an average of near zero during COVID, and now they're about double the cost of the average of about 3.5%. So now is not the time to make it more difficult for banks to hold treasuries. Let me just drill down with a little bit more detail on this Treasury market structure issue. Do you agree that the supplementary leverage ratio and the enhanced supplemental leverage ratio, the ESLR, are problematic as they create incentive for banks, especially large banks, broker-dealer affiliates, to serve as intermediators in the primary, secondary, and repo markets for U.S. Treasury securities?
I do.
And so you would commit to reviewing the SLR framework to create greater capacity for our banks to provide liquidity in the Treasury market?
I think it's time to move on the ESLR. And, we proposed doing so several years ago. We just didn't follow through on it. So I do think it's time.
Thank you for that. Finally, yesterday in your appearance in front of the Senate Banking Committee, Senator Warren asked you about the future of consumer protection laws the CFPB abolished. Isn't it true, Chairman Powell, that prior to Dodd-Frank, consumer protection laws were implemented by financial institutions' primary prudential regulators?
Yes.
And so if there were a decision by the Congress and DOJ or whatever to repeal the CFPB, we could return the consumer protection law enforcement function to other financial regulators.
You could, yes.
Thank you. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, and would like to associate myself with comments of the ranking member. And Ms. Powell, I would like to compliment you for standing up to the president, for literally preserving the independence of the Fed. It was one of those pivotal moments in time. It would have been more than simply resigning. It would have been the president taking control of the Fed with one of his Pluto puppets. Mr. Powell, I'd like to speak to you now about the process of collecting tariffs. When the tariff is collected, at what point does that actually happen? If we impose a product that's coming into the country, where is that tariff collected?
Great question. I'm not an expert on that. I'm going to say the Customs Bureau collects it, but I stand to be
I believe you're correct. That's what my research reveals. Permit me to extend this. When it is collected, it goes into a coffer. I believe we call it coffer, the general fund. Is this correct?
I don't know, actually.
It does. The tariff goes into the general fund. A tariff is another way of saying tax, I believe, for many people. Is that a fair statement?
It is sometimes characterized as a tax.
So if the president imposes a tariff, which is a tax, and the tax is collected by some entity before it actually, on the product before it gets into the country, then the president is putting tax dollars into a general fund such that they may at some point, and these dollars, by the way, are coming from the consumer, at some point they may be used to cover some of the appropriations of this very House that the president has enormous control over. So in a sense, what the president can do is aid with the payment of what he would call a tax break, but aid with their buddies that he collects on the tariff that the people in the country ultimately have to cover. I think that the president, while he seems to always avoid the question of how the tariffs are going to disperse, he knows that he can at some point use that money to help pay the taxes that he plans to return to his billionaire buddies. I think that's a very sinister way of doing business, to require a consumer to fund tax breaks. I think this president knows what he's doing. I think he believes that the very wealthy need more to do more, and the poor can do more with less. I don't agree with it, and I will do all that I can to prevent it. I yield back the balance of my time.
Gentleman yields back the balance of his time. The chair recognizes the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman, and we're here. Well, thank you. Good to see you.
How are you?
All right. The Federal Reserve recently withdrew from the network for greening the financial system, stating this work had extended beyond the Fed's statutory mandate. While I agree with this decision, I still have concerns with how previous Fed policies may have discouraged lending to traditional energy sectors like oil and gas, winners and losers. So my question is, can you clarify whether the Fed will ensure that financial institutions are not pressured to making lending decisions based on political or climate considerations rather than sound financial risk analysis?
I confirm that is not our policy. That would be inappropriate, and that absolutely not something we should be doing.
Okay, thank you. The Basel Committee on Banking Supervision intended for the Basel III Endgame proposal changes to be implemented in a capital-neutral manner to ensure a level playing field for U.S. banks. Following this intent, the previous Federal Reserve Vice Chair for Supervision initiated implementation efforts with capital neutrality in mind. However, his successor politicized the process, imposing harsher requirements that exceeded BS recommendations. And this approach not only made the proposal more difficult for banks and their customers, but also weakened U.S. banks' global competitiveness. Ultimately, he took his eye off and went in the wrong direction. So, Mr. Chairman, will the Federal Reserve commit to conducting a more thorough economic impact analysis before finalizing any capital requirements to ensure that they do not hinder economic growth?
Yes.
Regulatory overreach disproportionately impacts community and regional banks, which do not pose systematic or system risk, for yet they face many of the same capital and compliance requirements as the largest institutions. So many of these banks serve as lifelines for small businesses, rural communities, and the first-time home buyers. And it's key for the Federal Reserve to protect these institutions and ensure that they are not subject to one-size-fits-all regulations. So, Mr. Chairman, what steps is the Federal Reserve taking to ensure that new regulations do not force consolidation in the banking industry, therefore make it a little harder for smaller institutions to compete?
So like everybody else, we see the consolidation that's happened really over the last 30, 40 years, and community banks going out of business and just fewer and fewer banks. And we know that may be happening due to technology and various things, but we also just people moving to cities and away from rural areas. But we don't want our regulation to in any way foster that. So we try hard, I try as hard as we can to make sure that we're not letting the heavier regulation that we apply to the GSIBs and even to the regionals slip down to smaller institutions that are serving their community and generally doing a good job at that. And we try hard to do that. This is tailoring. It's very much of a basic value that we have, and it's also what we're instructed to do under the law. And I won't say we're perfect, but we do keep this in mind.
Well, I'd like to say thank you for being here. Good to see you. And with that, I yield my time back, Mr. Chairman.
Gentleman yields back the balance of his time. The chair turns to the gentleman from Missouri. Mr.
Chairman, thank very capable and courageous ranking member. Mr. Chairman, thank you for being here today. As you know, my words, the CFPB has been disemboweled over the last 10 days or so, which probably people, there may not be much concern here on the Hill in certain quarters, but there are two things that I want to ask you about. Rules over at CFPB must be from time to time updated. Right now there is no system for updating any of the rules. And one of the other issues is that is there a regulatory gap, or are there regulatory gaps that you can see clearly, that people can feel, because there is essentially no CFPB for the first time since the end of the Great Recession?
So I don't think we know where this comes to rest. You may have seen last night that the administration nominated somebody to be the permanent head of the CFPB. So I don't know I'm not sure what the end intention is here. But if you assume that it goes away, then yeah, there would be a gap. But there wouldn't be any federal agency that can examine banks above $10 billion, whether they're state member banks or state non-member banks or national banks. That would be the case. But I'm not sure we know what the end game really is here.
In terms of regulatory gaps that are created when the agency was essentially shut down. Now, I'm assuming that there's been somebody appointed to complete the murder of the CFPB, and so if I'm correct, that means that there are some there have to be, or either regular, or they've been tricking us all these years that they were not doing any regulations. But that's my political position. I was very proud in my community to get the Hispanic Chamber and the Black Chambers to come together. We got a building, they're functioning, big celebration all across my congressional district in Missouri. And then about 2 weeks ago, I started getting these phone calls, as I think many of us on both sides of the aisle have received, about 64% of small businesses have invoices unpaid for more than 60 days. And the Fed now, the Fed's real-time payment system allows individuals and small businesses to send and receive money instantly, which is a step in the right direction, Mr. Chairman. What is the status of the Fed now adoption for financial institutions?
So it's coming along, as was the case with ACH back in the day. It takes quite a while, investment that has to take place on the part of banks, and so we're working with with a lot of small and medium-sized banks to get them comfortable with the rules of Fed now, so that this can build up over time. It's it's something that we expected to be slow in terms of uptake, and it has been a bit slow.
Well, is technology adoption a barrier for smaller community banks and mission-based lenders?
Yes, it is, and so we work with there are non-bank service providers that do and do a good job with smaller institutions, and we encourage that. Those institutions can't actually have direct access, but their business is to they have the information, and they can go to smaller institutions and show them how to do this, and there's a lot of that going on. So, and we encourage that.
Thank you. Let me just say, I've been here on this committee for 20 years, and I've seen chairmen, Republicans and Democrats, and whether they're Republican or a Democrat, they need to be independent. Mr. Chairman.
Gentleman's time has expired. Gentleman yields back. The chair recognizes the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you. Thanks for joining us today, Chairman Powell. First, I want to reflect on our hearing on February 24th here in this same room. Frankly, for a lot of people because it was in the height of COVID. And during my 5 minutes, you felt confident that inflation being at 1.4% would stay under control. And it wouldn't be an issue despite the very large increase in the supply of money. We talked about M2. In a subsequent meeting, in my office, we discussed Milton Friedman's quantity theory in depth, and you believed that it was no longer relevant, that inflation would not hit consumers. We debated asset prices during the hearing, and you claimed that the Federal Reserve's massive purchases of treasuries did not distort the market. Lastly, during the administration, you were actively calling for more fiscal stimulus at times. And at some point along the way, more dollars chasing fewer goods seems to have actually resulted in higher.
Today's Most Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Frank Holland, Worldwide Exchange, CNBC.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward. The number one soft skill is flexibility, preparation.
Confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
Jimmy has David Letterman. Anybody else? Us Jim Gaffigan and Adam Lambert perform, and Super Bowl champs Jalen Hurts and Saquon Barkley this weekend.
Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the markets, that sticky inflation report, what all of it means for this record-setting rally. We'll discuss and debate, as always, with the Investment Committee. Joining me for the hour today, Joe Terranova, Shannon Saccocia, Steve White. We will check the markets. We well off the lows, as you know. Those guys are just talking about that. Yes, it was a hotter than expected CPI. The Fed are still on the hill. We're monitoring that. Mostly the same of what we got yesterday. No hurry to do anything on interest rates, and obviously the CPI underscores that. I mean, markets sort of looking through this, taking this ride. I mean, you had kind of the same thing at the beginning of 23 and 24, which is why the market knows that, obviously, and is trying to keep its eye on the prize, so to speak, of what's likely to come in terms of tax cuts and everything else.
So you're accurate in saying the market is looking through this. I would agree with that, but
mostly.
I think it's more about certain stocks which are looking past this. Meta higher once again today. Palantir higher. Spotify higher. Apple and higher. So I think there's some resiliency when you're able to go bottoms up and actually look at individual stocks itself. And I've been encouraging the viewer year to date to think about doing that. Let's not focus on where the overall market is. I think that's going to be a difficult game to play in 2025. In fact, if you go back over the last 60 days to December 12th. I think we have a chart here to show of the S&P and the NASDAQ. We're basically running flat. We're basically flat in the overall indexes themselves. So I think it's about where can I find some opportunities in the market. I agree with your overall assessment. Look, Scott, there's a lot of uncertainty right now. There is so much uncertainty. The last several weeks, we've had to deal with DeepSeek. We've had dealing with tariffs. Now we're dealing with an uptick in the CPI. And all of that should give you rightfully so some form of trepidation. We're still in an overall secular bull market, but don't focus on, hey, I'm just going to ride the index higher. Try and find some individual stock opportunity until you get further clarity, by the way, if you do, because I don't know where you're going to.
The S&P and NAS are on pace for their third straight negative week. I mean, it underscores, Chan, some of the problem that has had and why it's dragged everything like that a little bit lower. Larry Summers, the former Treasury Secretary, posts on social, we're now in the riskiest period for inflation since the early Biden administration. Ken Griffin yesterday, I'm sure you've all seen the quotes by now from that UBS conference talking about the president's rhetoric and some chaos and tariffs, et cetera, saying the damage has already been done. From my vantage point, he says, quote, the bombastic rhetoric, the damage has already been done. It's a huge mistake to resort to this form of rhetoric when you're trying to drive a bargain because it tears into the minds of CEOs, makes it difficult for multinationals. And I mean, look, it's a big Republican donor. He voted for the president, but he's telling it how he sees it. He's one of the world's great investors. The market doesn't seem to be hung up on that. It doesn't seem to be hung up on what Summers had to say. It doesn't seem to be hung up on what Mr. Griffin had to say. As I said, earnings are better than expected. We're more than 2/3 of the way through. And that's where the eye on the prize remains. Good earnings, good economy, tax cuts coming, so why get negative now?
Well, I think that's what you really need to focus on is if we look at the last couple of years, it's really been a majority of gains last year were driven, by multiple expansion. And so if we're looking and anchoring ourselves, to Joe's point, on looking at the underlying fundamentals and the ability to grow their earnings, and think about some of the thrusts that are behind that, taking tariffs aside, because our view is that they really are negotiating tactic, and he's looking to, the White House is looking to extract some concessions from our allies and our trading partners. If you look beyond that, what you're looking at is you're looking at an environment where things like deregulation are going to benefit smaller companies. If you think about if you think about regulation in general, it benefits bigger companies, right? They've got the funds to be able to have that competitive mode on their businesses. So we think this will be more competitive. Around the other parts of the economy, to Joe's point, think about technology and where people have been trying to position themselves within technology. You're looking for, which of these Mag 7 do I want to own? And now we're starting to see some divergence. Opportunities to get outside that in tech, but more importantly, you're seeing earnings growth in other parts of the economy. So I think when it comes down to it, you're looking at where is the potential for the market to potentially go up and down. I think that's less of the argument today. The last thing I would note, Scott, is that when we look at this dynamic around the potential for broadening of the economy, a lot of the forces that have been looking for this economic momentum, it's already in place. We're seeing it over the last few months. Small business confidence, Scott, you talk about CEO confidence. Small businesses are much more confident in this environment than they have been. And I think all of those things really point to, don't spend as much time looking at these larger indexes, look at the underlying fundamentals, look at things like even in the Russell 2, I know you're going to come back to me on this and pressure me on this, but that index is not very high quality. So looking within small companies that are higher quality in that universe that are growing earnings this year.
Weiss, you look at the sector breakdown year to date, it's not really split. Discretionary is negative. Tesla has a lot to do with that. Technology is negative. Really, those are the only two spaces to look at, in large part because of what, I wish I came up with this, because of what the Wall Street Journal talked about yesterday, the lag 7, not the mag 7. And it really has been lagging performance from most of these names outside of Meta, which, as you know, is going for its 18th straight 7 stock. Any NAS 100 constituent going all the way back to 1985. That run's been extraordinary. Everything else is negative, though, year to date. The market, does that matter if you continue to have a lag 7?
It doesn't matter to me, candidly.
Does it matter to the market?
I don't really care. I care what the fundamentals of the Mag 7 are and how they're going to perform going forward, not how they perform for a moment in time over an investment horizon. So we can make all we want of it because they're a large part of the S&P, a large part of the Qs, but the facts are they're permanent compounders, most of them, and a momentary lull in their performance or execution. I shouldn't say execution, they've been executing pretty well. Is going to disturb me. I don't think you look elsewhere.
Okay, the operative word is what you just said, momentary.
Yeah.
You know what it is?
Believe it is.
Because that's the whole game. Right. I mean, if it's not,
yeah,
you got a problem. If it is, no big deal.
Right, and I believe it is. So if you do bottoms-up work, you'll have conviction that it's momentary, and that all the drivers are in place. The spending, which some could argue is way too large, is there for the growth. It's not to backfill on mistakes that have been made. It's to say, okay, here's where the puck's going. We want to drive continued growth. So, look, I like the Mag 7 in terms of the overall market. I'm just not as sanguine about it. Sure, earnings have been good, no secret. Sure, a lot of companies take price increases in January. Typically, we've seen that before. A little more than usual here. Here's the commentary continues to be, including from this desk, the Fed is on hold. Well, guess what? Is it on hold for a hike or is it on hold for a cut?
I think it's on hold for a cut, and there is no evidence at all from either the data, frankly, or what they've said or any of the members have said that it's on hold for a hike.
That's not true.
No, it is true.
No, it's not.
Why do you think it's on? Why do you think a hike?
What about today's number? That's not evidence.
What do you think the market is? If that was the case, if the market thought that
you think
a hike was
investing's
next,
that easy? Where it's one number, oh, the market says hurrah, you know?
I said at the beginning of 23 and beginning of 24, you had inflation spikes as well. There's nothing
so all we
from
need to do to investment is look what happened last quarter.
Are you invested if you think the next move is a hike? Just put it on the table then. Don't argue. Just put it on the table.
Am I? No,
you're not. You're not.
Scott, that's not the point. The point is, your point is, we got one data point that was high.
No.
Let me finish. We got one data that was high. The market's looking through. Hey, we're all clear.
I say we're all clear?
Well, you just said that. The market looked through it. There's no data that shows that the Fed may hike. So let me point you what Powell said. Powell said we're very close to the neutral rate, which means that don't expect a lot of cuts. Now, if inflation keeps going higher, we'll see PPI tomorrow. That'll probably be explained away as well. But if you see this march higher, if tariffs, maybe it's not 25%, maybe it's 10%, that's inflationary, despite what the clown car of the cabinet members say. So you could very well see increased inflation. Larry Summers is not a fool. He's speaking what's accurate. Ken Griffith's not a fool. So I do think the risk to the market is not maintaining this narrative that's got us here. But what can go wrong? As a responsible fiduciary, I'd like to look at what can go wrong. I'm not saying I'm investing on that.
I'm not suggesting that you shouldn't prepare for any scenario. We're talking likely outcomes. The likely outcome is not a hike. That is not the likely outcome. Maybe it works for you to have this argument with me, which I would you, but that's not the base case.
You've just made my point. It's not the base case. So the risk to that base case of the next move is lower. It's not
close to that.
It's extended, right? Scott, I'm pointing out the risks in the market. You're saying, hey, they're going to cut eventually. Yeah, they could cut eventually, and then they cut from 6%, or they're going to cut from where it is right now. I don't know the answer. So if everything continues to go as rosy as it is, if earnings continue to grow, you don't think that that's going to be inflationary? Of course it will be. When the economy gets heated up, it's inflationary. So I'm saying don't be sanguine is that.
I would say the offset to that is that I think a risk that we should be talking about, we talk about tariffs, is that there's a point in time increase potentially in prices. But if we see an expansion of tariffs, Steve, to your thesis, we're going to see growth deterioration. So you go back to 2019, Fed had to cut rates.
Yep.
That was tariffs did not create, they created an inflationary impulse initially. Growth slowed down. So say, Scott, the real risk to the market from a tariff perspective, short term may be inflation. I don't think that puts the Fed off of their pause. I don't think, to Scott's point, it puts them on a high. Tariffs are short point in time, as I mentioned earlier. We want to talk about risk to this thesis and risk to the market. It's growth.
So let's talk about
inflation.
risk to specific sectors. Financials, for example, right? The thought process was last year, financials did well in that eventually the Fed's going to cut, and they're cut to a level where M&A makes sense, financial sense, because it's on a balance sheet. Now, that scenario of rates being high continues to be, in my view, a governor against M&A. You don't know what sectors are going to be. I'm all for cutting costs. There are way too many excesses, way too much overspending in government. But I'm also for a cogently communicated plan of doing it, not sensationalism. And that's what we have. And that's what puts CEOs back on their feet. I've spoken to private equity firms who mentioned it yesterday. They're not making any big acquisition in certain industries because they don't know what the rules of the road are. So that's a growth slower as well for the financial industry.
Financials are among the best performing sectors year to date.
Yep.
On the expectation of an environment that's going to be more conducive to deal making, which they still believe it will be. Just because you've had the slowest January in decades for M&A doesn't really portend anything. Obviously, there's been a little more uncertainty introduced because CEOs don't know what's going to happen with tariff policy.
Exactly.
More tariff policy than interest rate
It's not only
movement from
tariff policy. It's not only our policy. Department of Defense, what programs are going to be cut? Where are they going to focus
Yeah, but you're
their
thinking,
spending?
but that's so stock specific to things that you have
It's
like
a sector
Leidos
specific.
and Booz Allen and things like that.
Not only them, General Dynamics.
Well, but that, you get my
Lockheed
point. In those
But that's why I'm talking
areas,
sectors. Healthcare. Let's talk about healthcare.
another really good performer.
Right. Why? Is biotech a great performer? Look at healthcare. You can see where are things going to be cut. So right now the market's on autopilot saying, hey, you know, cut and regulate, et cetera. But there are real cuts going on.
So I feel like we're having a conversation about the Giants winning the Super Bowl next year, because if we do have to raise rates, I think it's because I think there are some of these magnificent seven that you want to make sure you have in your portfolio. Absolutely Amazon. I think Amazon is on the same trajectory that Netflix was in terms of what it's going to do with streaming. Al Michaels talked about this last week. Live sports, they are only going to further engage with live sports. It's going to add upon the businesses they have right now with e-commerce and cloud. You turn your attention to Meta. Clearly, they have gained an advantage as a result of what's going on with TikTok. The algorithm's ultimately going to change if the U.S. buys that company, so I think you want to stay with Meta.
No one has suggested at all, at any time, that you, to use your words, should have these in your portfolio. No one has said that you shouldn't have them in your portfolio. They're two different conversations. The suggestion is, as a group, it has been the Lag 7.
Yeah.
Because I told you year to date, that's why tech is among the worst performing groups. Most of the Mag 7 stocks are negative.
Except for the two I just mentioned.
Yeah, except for the two.
Right, and I'm highlighting the two. So I'm trying to encourage the viewers, if you're looking at the Lag 7,
You think the viewers are sitting there thinking, so I should sell the Mag 7 because they're lagging?
Let's not look at them in totality. Let's not look at them in totality. Let's try and identify in 2025, they're not all going to go up universally the same as they did in prior years. They're going to be some of those names that are going to perform well. I'll tell you a name that I don't think is going to do well. Tesla, and we own it in Joe T. I am concerned about Tesla with the tariffs as it relates to graphite. Graphite is a real problem for EV makers when you're thinking about the need in batteries. China is the largest. They have much bigger problems, but the graphite issue is a huge issue, and Elon Musk isn't going to like what he continues to see as we have these tariffs continue to be applied because the margin's going to happen.
Let me just get to a news alert quickly with Pippa Stevens.
By 15 to 20% beginning this year, with most of the cuts complete before the end of next year. The company said is in keeping with its prior announcement to reduce costs by between $2 to $3 billion by the end of next year. It, of course, comes as Exxon also looks to cut the company reporting Q3 profits that were on lower commodity prices. This news was first reported by Barron's, and Chevron is cutting its workforce by between 15 to 20%.
All right, Pippa, thank you. We'll keep our eye on shares of Chevron, obviously, for the remainder of our program today. Let's talk about some other groups, rather than continue to have this debate about inflation and otherwise, because I do want to get to some things. We've talked a lot about, let me just silence that, about momentum of late. Jeff DeGraff today says it's not overbought, even though a lot of these stocks are up a lot. Joe mentioned Palantir is up 67% over 1 month, and AppLovin, he's about up 18. Goldman's up 16. Weiss, you're in that. Welltower, a new record high today. Walmart is up 10% in a month. It's in the Joe T. Price target today to 115 from 105. Carvana's up a bunch. Robinhood, GE, Costco, Royal Caribbean, AbbVie, Netflix, some of the cyber stocks. What's going on with momentum?
So you want to use the term overbought? I would say I disagree with that.
DeGraff said it's not.
Well, I would disagree with that because I'm beginning to see in the last several days, as we see the overall index kind of teetering, that a lot of momentum names and momentum strategies are underperforming for the first time this year. So I can tell you, if you look at the factor of momentum, the last 2 or 3 days have been a difficult day
Al likes your shout out, by the way, to him.
Relative, tell Al I said thank you very much. Relative to everything else, okay, momentum is struggling. Now, are there areas, as I mentioned at the top of the show, like Spotify, like Apple 11, like Palantir, like Walmart, that you could still find opportunities? Yes, without question you can. But you're looking at the factor overall of momentum. It does appear to be a little bit tired. It does appear as though it needs to catch its breath, and price action the last several is absolutely reflecting that.
I mean, Vertiv is part of the momentum trade, which is getting hammered today as our chart of the day, but you bought more.
Well, keep in mind, I think you were going to going into the earnings. I sold part of it.
And you bought it back on the dip?
I bought it back this morning. It was down more this morning. I bought it back this morning. Look, the quarter was pretty good. The issues were a couple of things. Quarter was actually, I thought, excellent. Where you see companies growing at 30 and 50% in different metrics. But the book-to-bill for the fourth quarter, not unusually, was 1-to-1. It would have been nice to see that higher. And the conference call really hasn't done anything, which has to partially for me on air, to, dice cast that it's down. But everything remains in place for this company to continue its growth. So, so I'm still there. I bought back what I sold. That was a good sale. Would have been better sales. I said if I sold it all and came back in, but I don't know. Quarters are just very, very fickle as is the reaction to them. And there's no rhyme or reason. We see stocks miss and the stock goes up. We see stocks that execute and they go down. So the best thing is pay attention to the quarter for trends. But if the trends are in place, then don't get knocked out.
That's an important point. You mentioned before how important earnings have been to where price has traced out over the last several weeks. There are a variety of stocks like Vertiv that actually have reported really good earnings, went into their earnings at or near highs, 52-week highs or all-time highs, and subsequent to that, the response left you puzzled because they're adequate earnings, but maybe they weren't good enough. So if you could pull up a chart of Eaton, you'd see the same thing reported at the end of January. Chart looked really good. Earnings were good. Stock rolled over. Look at Deckers. I mean, you and I have talked about Deckers for the better part of the last 6 years. If you pull up a chart of Deckers, it has literally hit the deck after earnings, and the earnings on it were not very good.
I do have some breaking news from Washington, and we will get to Megan Casella for that. Megan?
Hey, Scott, we're just learning from President Trump posting on Truth Social that he just held what he called a lengthy and highly productive phone call with Russian President Vladimir Putin. Now, a lot of details here from the president saying that they discussed Ukraine, the Middle East, energy, AI, the power of the dollar, among other subjects. And he also says that the two countries have agreed to work together very closely, including visiting each other's nations. We've also agreed to have respective teams start negotiations immediately, and he would start those including by also calling right now Ukrainian President Volodymyr Zelensky to inform him of the conversation. So that's coming out. As we know also, Scott, that Treasury Secretary Scott Bessent is in Ukraine meeting with Zelensky today, so potentially launching those negotiations. Trump saying in his Truth Social post that Secretary of State Rubio, John Ratcliffe of the CIA, Michael Waltz, the National Security Advisor, and Steve Witkoff, the Special Envoy, will be leading those negotiations. So we don't know exactly yet the contours of those, what exactly that they will be discussing. But of course, this follows the prisoner swap that we saw American Mark Fogel coming home last night from. Just following on all of that and building Bessent's trip to Ukraine today, Scott, that's what we have for now. Back over to you.
All right, Megan, thank you very much for that update. That's Megan Cassell, an important conversation that the president just had. A couple more moves, Joe, if we could. So you bought CVS.
Yes,
CVS.
I bought CVS.
Why did you do that?
And kudos to Larry Robinson, Glenview Capital, who took a position in this stock a few months back. So finally, you're seeing some positive momentum here. You have the earnings growth, you have a reduction in cost, and I think this is an easy trade. Remember, I used the word trade more than anything else. Well, this is yesterday's closing stock price, which was 55. If you're trading it, if you're an investor, you have enough here to believe that there is a fundamental turnaround in the story. I haven't owned this stock in years, and I've been waiting for an earnings report like we got today, where you could say to yourself, okay, fundamentally, this looks like an inflection point, and certainly technically with that large gap open higher, it's worth taking the risk.
The Tepper convinced you on Alibaba? Is that why you bought that?
There's clear
I'm
right
completely
now.
serious.
No, I know you are. You don't go against David Tepper, but we had a nice conversation about it Monday.
Weiss is the only one influenced by what he says?
I think everyone who trades and who invests is influenced by David
Why'd
Tepper,
you buy it?
for sure. The reason why I bought it is we discussed it on Monday. We talked about JD, we talked about PDD, we talked about Baidu.
Yes, we talked about all of those, as a matter of fact, because he upped his positions from Tina.
What I did was I went to hijack.
That's great. Continue, please.
I went back and I looked at where are we with momentum and where are we with the potential for momentum to extend itself. And if you look at BABA right now, it just took out its recent high from the last 6 months above 118 and change, and it looks like now it's a half towards 150. So more than anything else, you could say yes. Thank you, David, for introducing the concept, the idea to me. But looking at the momentum, it looks really strong. And it looks like it could go to 150, and I want to try and capture it.
All right, good stuff. We'll take a quick break, and when we come back, Carrie Firestone is going to join us. She's just made a number of moves in her portfolio, some new buys, new trims of positions, and she sold a name as well. We're back right after this.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there's something at stake and asking them fair but tough questions in which answers are important. I could not imagine covering anything else.
Von Furstenberg's name is synonymous with the wrap dress. This iconic piece of fashion made its debut in 1974 and is an immediate sensation, with a million of them being sold in just 2 years. 50 years later, the wrap dress is still a bestseller and a wardrobe staple seen on everyone from royalty to celebrities.
I created the dress, but truly the dress created me. So, why? Well, first of all, the fabric. The fabric was jersey that molded the body. Then it was the prints. They always moved, changed the body language. And so the more people notice it, the more happy you are with yourself. Somebody said something very funny once. It's the dress that you get the man in and his mother doesn't mind. So it's both sexy and proper at the same time.